highly responsible for your own trading decisions. And as this is the last episode before the 25th, I'd like to say please have an awesome Christmas, enjoy time with your family and friends, and prepare yourself for a big year in 2017. Merry Christmas. Now let's go. Here's the conversation I had with Alex. Usually on this podcast, we don't talk specific about particular trades or certain events because it sort of tends to date things a little bit, but DRYS, the ticker for dry ships, this one we can't ignore.
Yeah, it's all over everywhere. Everyone's talking about it. CNBC is even talking about it.
Yeah, this is one for the history books. So, I mean, I'm really keen to get your take on it. How have you been trading it? When did this first come onto your radar?
I mean, okay, so basically I first saw it, I think it was that day, it was like very low volume. I think it went from 8 to maybe 16 or something like that. Slowly started to fade off. And then I really started to pay attention. I think it was the day after when it had a little bit of a weak open and then pushed towards 18. And then from there, I think just it trapped everyone. Everyone got stuck. It was just weird thing. Like I thought it was just going to be like a normal, a short squeeze after a couple of days, come back down. Nothing crazy. We've seen it a million times. All like these big traders that I speak to or I know of, they're all shorting, they're very comfortable. It's like nothing crazy. And then out of the blue, it rips faces off. It just blew my mind. I luckily did not have to borrow for it. So I'm sure I would have been one of those guys that got their balls squeezed too.
So why did that happen? Like, what was the driving force behind this? I mean, even to start off with, $8 to $16, that's a pretty big move in itself. Like, what was the driving force that led it to continue? Because, just to put things in perspective for people who might be unfamiliar with this or who haven't seen the chart, I think it was early November or even October, it was just trading at it was less than $1.
It's a reverse split. It just keeps selling off and then reverse splitting.
Right. And, it went from under $1 to over $100 within a matter of a couple of weeks?
Yeah, not even a couple of weeks. I think it was Friday to what's today? Today is Wednesday. It hit 115 today, pre-market.
Yeah, it's a ridiculous looking chart. What was the driving force?
So what I think the driving force was the short sell restriction. I think was a big part of it. So the float is already low. I think it's less than a few million shares, whatever it is. And the problem with SSR is that once it goes high enough, the stock goes high enough, there really is no more sellers to push it down because they're not going to be selling on the bid. They're all comfortable. Everyone's fine. It's just going to be shorts putting it on the offer. As soon as the shorts are done, it's just going to keep ripping and ripping higher. And it's been a long time since we had one of those black swan squeezes. So a lot of shorts just felt really, really comfortable and they just got destroyed. And I mean, I would have been one of them too. If I had to borrow, I would have been smoked as well because we're all used to seeing these charts. We're all used to seeing these parabolic charts. And I guess just sometimes if you don't stick to your rules, all it takes is one day to blow you up forever. It's a scary thought, honestly.
So were you involved in trading this at all? I mean, you said right there you couldn't get the borrows for it, but were you trading the long side?
Yeah, I couldn't get the borrow, but I was trading the sympathy plays. I think it was EGLE was one of them. SINO was another one. TOPS was another one. So basically, the way these sympathy plays work is that they fuel off the main runner. So call DRYS the head of the snake, and everything else just falls in its path. So as soon as the head of the snake gets cut off, these stocks collapse with it. So my thesis was I couldn't get the borrows on DRYS. Why not short the sympathy plays? DRYS is not going to last forever. It's going to fall down. So these stupid stocks should fall too.
Okay, so these other stocks were up significantly as well?
Yeah, I think they were up 30, 40%. This was on Friday, so even before the crazy squeeze started. As soon as the massive squeeze from $30 to $60 to $90 to $100 started, these things started to go ridiculous. For example, I was short SINO. I think I had a $1.90 average or something like that. I managed to cover a few $1.60, and then I started adding near 2, near 230, and then I was forced to cover. I was losing too much money. Turns out the next day, trading at 3 pre-market, then goes to 4, then goes to 5, 6, 7, and like it almost hit 8 the same day. And then sold back down to 5. And now today, in after hours trading, it's above 8. It's at 860. So that could even go even higher. It just blows my mind that, a couple hours ago or a couple days ago, I was covering my short at $1.60 and I couldn't fill all the way. And now it's at $8. If I didn't stop out, that would be the end of my trading account. It's just so scary to think that 1 or 2 days of just stupid trading or irresponsible trading, not sticking to your rules, could destroy you. It's scary. It blows my mind.
Yeah, I think there's a number of traders who have probably been hurt by this quite badly. So these other stocks, when you're talking about these sympathy plays, these other stocks really have no reason to be up by the crazy amounts that they do, other than the fact that they're in the similar sort of industry and sector as, in this case, DRYS. Is that what you're saying?
Exactly. So most of these stocks they're like garbage. So they have to raise money. They have ATM, warrants, everything. They're looking to raise as soon as possible. So my thesis on these sympathy plays is they're usually not going to run as hard or as fast or as high as the main one. So they seem a little safer to short. But when craziness like this happens, where DRYS hits 115, these things just lose their minds. They have low floats, some of them under 3 million shares. And it's crazy. For example, SINO has a float of, 2.8 million. And today it traded almost 42 million shares. The float rate rotated almost 12 times, 13 times. And it just keeps going up and up. Shorts get trapped and they have to keep covering to get out. It's crazy. It really is.
So, I mean, a lot of these stocks are still up quite a bit at the time that we're recording this podcast. I mean, how do you anticipate this is going to play out from here on?
So I guess I want to backtrack a little bit. So if these stocks, are going up, like, why would I short them? Why would I not buy them is what I guess a lot of people are talking about. Like, why not buy it? You have 200% upside rather than, blowing your account or something. And the reason for that is I'm terrified. I'm terrified of buying because today DRYS was halted. What if the next shipper gets halted? And I feel like I'll have that bad luck where the day I buy that stock, it's going to halt, so I avoid it.
Okay. Now, I saw you posted on Twitter, it was either yesterday or the day before, again, before when we were recording this, and we're recording this after the close, which on the 16th of November, 2016. You mentioned that you lost $40,000 the other day.
Yeah.
I got to ask you about that. What happened?
Yeah, so I was short one of the sympathy plays, EGLE, and I had some SINO as well. So EGLE, I had around 35,000 shares at something in the 7s average. And when DRYS was starting to pull back near like 45, I was confident that the stock was just going to fail back to 5 or whatever, Like I said, we've seen it a million times. Why is this time going to be different? And it just blew my mind when DRYS went from 45 to 65, broke a new high of the day, and I just had to get out of this EGLE stock. I took my loss on that. I took my loss on SINO, and before I knew it, I was down 40 grand. It sucked. It was a terrible feeling. But looking back now, I would have been down 100 grand or 120 grand if I held like an idiot,
Yeah. So obviously, I presume that you didn't anticipate to lose that much money going into this trade. Like, you weren't prepared to risk that much money in these trades or that day. What went wrong?
What went wrong? I underestimated the staying power of DRYS. The stock is truly a black swan stock. It's like the KDIO, AQXP, all combined. It just, for a stock to go from 5 to 115 in less than a week is just something that you don't see every day. So these stocks are acting the way they don't. So in my mind, I say, I'm going to short it. I could be a little bit patient. Maybe I'll be down 10 grand. It's not going to be really much of a big deal. But if you don't stick to your rules, if you don't respect the chart, then, you could blow up in a day. It's really as easy as one bad day could screw you forever.
It's very true. It's very true. Anyway, man, let's get into some more. Let's rewind a little bit and let's talk a bit about how you got into trading. I know you've got a unique story around this. So, I mean, tell us what led you into trading. How'd you get into it?
Yeah, so basically it starts with my dad. So he came from Turkey to the States in the 1980s with his brother. So he didn't really speak any of the language. He didn't really have much money, but he was an entrepreneur at heart. So he started his own electronics business with my uncle, and it took off. In the 80s, electronics was hot. Everyone was buying left and right. Like, he really made a name for himself, and the money started pouring in. He started making a lot of money. And I guess for as long as I can remember, money was never an issue in our family. My dad had a lot. He worked really hard, and everything came really easy to him. So I think it was in the 2000s or whatever. He had a little extra money on the side, and he said, what do people with extra money do? Put it in the stock market. So he put his money in the stock market, and I guess I was younger at the time. I didn't really understand it, but all I can remember is he just kept making money. He would put in like some blue chip stocks, like nothing crazy, just like, I guess, watch it over a couple of days, not really day trading, it just, I guess, investing. But long story short, 2008, 2009, whatever it was, when the whole economy went to shit, people weren't buying things anymore from the electronic stores, and quickly our lives changed. Everything changed immediately. From having a lot of money, we went to having almost no money instantly. It was just big change. I think I was 15 or 16 at the time, and I didn't really understand it because I was so used to like everything coming easy to my dad. And it's I guess it's just a crazy story. So when I turned, I think it was 16 or 17, I had like a pretty decent car. I bought like some rims for the car, nothing crazy. So I thought in my mind, if my dad was making money in the stock market, why can't I do the same? We don't really have that much money anymore. I don't want to ask him for money. So I sold my wheels for, I think it was like $2,000. And I put it into like a TD account or an E-Trade account. And I just started like playing some stocks. I heard, I didn't find like much traction. I was mostly buying stocks and just losing. I was the guy buying at the top, and it was a terrible time. So I guess I was looking on like the online forums and whatnot, and I found like a penny stocking guru or whatever. So I subbed to him for like $100 or whatever it was. And I said, if this guy could do it, why can't I? What's stopping me? I'm sure I'm smarter than like most people. So long story short, I followed his trades and I lost a bunch of money. So I said, screw it. Trading's not for me. Whatever. I'm done with it. So I got a job at Starbucks. I started working a little bit more. And I said, I'm a smart kid. Maybe the first time it didn't work. Let me research a little bit more and let's see what happens, So I took the money I made from Starbucks. I put it into, I took the money from Starbucks. I bought a subscription for another chat room, and I learned about what shorting was. And this concept blew my mind. I said, if I'm buying at the top and the stock is going down, what if I just short where I was going to buy and, make some money? So there was a light bulb that went on in my head. So I found a broker that allows shorting, an offshore broker. And I put what money I had in there. And I think the first short trade I ever had was, I shorted 2,000 shares of VGGL at like $4. And within like 10 or 15 minutes, the stock went from $4 to $3.50, and I was up $1,000 instantly. And just, I can't explain to you the euphoria I felt. It was just, I was on top of the world. I felt like a king. I made $1,000 like from one trade, and I was hooked forever. I couldn't stop. Shorting became everything to me.
What a story, man. So just backtracking a little bit, when you first opened up that trading account, did you blow up that first trading account, or did you just decide that you were losing too much and that it wasn't for you?
The 2000 account, I blew it up. I blew it up after a couple trades. It was gone before I knew it.
And was that the only account you've blown up to date?
I've blown up a lot. I can't even count. So after that VGGL trade, I started to pick up traction, and then before you know it, I was doing stupid stuff again. You know, I was shorting anything that was up. You know, I had no rules. I said, this stock is up 20%. Let me short it. What's going to happen? You know? And after I started losing that money, I just kept, I kept working at Starbucks. I kept my job a little bit. I wasn't really making that much, but after blowing up like 5 or 6 accounts, these are small accounts, like say $1,000 or whatever. After blowing that up enough times, I said, what would work on the short side? What are all these big traders in this chat room doing that I'm not doing? Like, what am I missing? What is the golden road? What is whatever it is, what is the secret sauce of trading that I'm missing? And the thing is, I found, I guess the strategy that most people were using was they're shorting stocks that are trash, that don't really have any reason to be up. And long story short, that strategy worked a lot for me. And then I evolved that strategy into shorting the sympathy plays of running stocks. So mostly when these stocks run, like the sectors run, whether it's forklifts, Ebola, whatever it is, they usually have sympathy plays that other people are chasing or wanting to be that next big runner. Most of the time, I guess with smaller accounts, you don't really have to borrow for that big one. So I found that having to borrow for these sympathy plays was not only cheaper, it was also a little bit easier,
So you said that you were trading accounts that were only a couple grand, and I think you even said maybe one was like $1,000. Like that's pretty tough going. Like how were you managing to trade with such a small account, and how did you get around the pattern day trader rule?
Okay, so I use one of those offshore brokers that allows you to have like a $500 account minimum, and they give you 6 times leverage. So let's say you have a $1,000 account, they let you have $6,000 in buying power intraday. So that led to my blowing up happening even faster, because I was playing on margin, and just losers just start to add up and add up and add up until I said, screw it, I can't lose anymore. I'm sick of this. Screw Starbucks. I want a better life for myself. And
now these offshore brokers, that in itself, it sounds very dodgy. Is it dodgy? Are there any risks of using a broker like this?
I mean, I think so. I mean, the whole concept is sketchy anyway, but without these offshore brokers, I wouldn't be where I am today. I didn't have enough money to pass the pattern day trader rule. I didn't have enough money to open up like 3 accounts. I just had to pray that this thing wasn't really a scam. Whenever I complained and yelled at them 10 times, I eventually got my money, and the routing was terrible. Everything was terrible. This pattern day trader rule is such a stupid thing to me. $25,000 to trade as much as you want. I don't understand it. I think it's so stupid.
So now that you're well above that, you're obviously not with an offshore broker any longer.
Exactly.
Okay, sure. Now, I just want to put things into perspective here, because at the start of this call, I asked you about losing $40,000 just the other day. And here you are, you started out working at Starbucks. Just put that into perspective for us. How much were you earning at Starbucks?
Oh my God. I don't even want to say it because it sounds so stupid, but I was making, I think it was like $100 a week after taxes. I put $60 in my gas tank for my car, and then whatever I had left over, I would spend on my ex-girlfriend. So I basically had nothing at the end of the week.
And how many hours were you working a week?
I think because I was still in school at the time. I was still in high school and college or whatever. So I had to balance both. So I think I was working 25 hours a week or 30 hours a week at Starbucks and the rest at school.
Sorry, you're working 25 hours a week and making $100?
Yeah, it was nothing. I was getting paid minimum wage, as little as it was terrible. Just thinking now that money meant so much to me, and losing $40,000 doesn't even faze me anymore. It just blows my mind.
Man, that's so savage.
Yeah.
Okay, so at what point did you feel comfortable? I mean, obviously there wasn't much risk in losing and leaving Starbucks because you weren't making a whole lot of money. At what point did you make the decision to just go full into trading?
So basically, again, it's going to sound funny, but my girlfriend broke up with me, so I was a little bit upset. So I said, screw it. Why am I going to spend money on this stupid girl when I could be, saving up some money and starting to trade? So after that moment, I guess I was a little bit upset. So I dove full into trading to get my mind off everything. I started researching. I started watching some DVDs. I started to do everything that I could just so I could stop thinking about this person. And it's worked out amazingly. Couldn't be happier.
How long have you been trading for all up, and how old are you right now?
Okay, it's been, I think, 2.5 years. It's going to be 3 years in February, and I'm 22 now. I just turned 22.
That's incredible, man.
Yeah, thanks.
Good going. One of the things which is so crazy about your story is how quickly you've been able to pick this up and get a grasp of, how to trade your way in the markets. I mean, how have you been able to pick up these concepts so quickly?
I guess the best way to say it is I'm addicted to trading. Like, this trading is on my mind 24/7. The first thing I do when I wake up is I check the quotes on some tickers that I'm watching. Midday, I'm just thinking, no matter what, it's always on my mind. Before I sleep, it's on my mind. What am I going to do the next day? How am I going to plan my trades? I'm out with my friends. I'm drinking. I'm thinking, okay, what's the next stock that's going to be in play? How do I nail this stock? What do I have to do to become the best of the best in trading? It's become an obsession in my head. It's become like the only thing I think about. It might not be healthy, but I love it so much that I can't stop. It literally is. It means everything to me.
So obviously you've got a clear obsession for trading. Do you have an obsessive personality, like by nature? Like, does this, can you track this back to things in your teenage years that you were that just really obsessed about?
So basically, I guess when I want to do something, I try to be the best at it, whether it's trading, whether it's in school, whether anything, no matter what, I try to be the best in anything that comes in my way. So with trading, it was a challenge because you could never master the market. The market is always going to be smarter than you. So it just blew my mind that no matter how hard I study, no matter what, the market is ever changing. So even we saw with all these shippers, they're blowing everyone's minds because these moves are crazy. They're absolutely nuts. And it's something that we're not used to. It's something that the market is doing. We have to get used to it eventually. This might be the new norm. What if these new shipping stocks are going to happen more often? What if the next sector is, who knows, like coal stocks or whatever, We just always have to be adaptive. We always have to be learning. And the moment we stop adapting is the moment we're done.
So maybe walk us through your typical day. You said that pretty much from the minute you're up till when you go to bed, you're just thinking and obsessing about trading. Walk us through a typical day.
Yeah, so basically, I don't really get much sleep at night. I guess I have a sleeping problem or whatever it is. So I'm usually up pretty early. So let's say a normal day, I'm up at 5 in the morning. I wake up, check the quotes, go shower, think about trading. What am I going to do? And then I start checking the pre-market gappers to see what's up on the day. I do a little bit of research before the market's open. I usually just hang out really early, between 5 to 7 a.m. And then from 7 a.m. to 8 a.m., I'm always on the screens watching how the stocks are acting, how they're trading pre-market. Is there a trend that's forming? Is there some sort of news that came out? What is moving these stocks? And by the time the open comes up, I usually have a plan set up. Sometimes I write it down on a piece of paper. Other times I just wing it. But mostly I find more success when I just write down my plan and stick to it. So, for example, let's say tomorrow there's these shipper stocks are flying again. So I'll probably wake up in the morning, see how they're acting. Did they gap up? Did they gap down? Which stock am I most interested in? Why is that? And then form a plan. For example, I'm going to try to find the weakest shipper amongst all these stocks, the weakest, the relative weakness. And then from there, I'm going to plan my trades according to the support and resistance of that stock and then get my orders ready. And then by the time the market opens, hopefully if they spike up hard enough, they'll hit my orders and we'll get the day going.
Ever watch a stock rip and think, I could have nailed that if I had real capital? The truth is, many capable traders never reach their potential, not due to lack of skill, but lack of scale. Trade the Pool was built to solve exactly that. A firm designed for serious individuals who want access to the U.S. equity markets with meaningful buying power, up to $200,000 without committing their own capital. Get access to virtually every stock and ETF. Go long or short freely with the flexibility professional traders expect. You're evaluated on one thing: your ability to manage risk and execute with consistency. Meet the standard, and you trade at scale. No subscriptions, no ongoing commitments. Whether you're still refining your strategy, a trader with experience who hasn't yet broken through, or a seasoned professional simply looking for more capital, Trade the Pool is built to meet you where you are and take you that next step further. The markets have evolved, access has evolved, now so has the way traders operate within them. Trade the Pool.
In the years that you've been trading so far, what would you say have been the biggest challenges that you had to overcome?
I think it's in my nature to be very stubborn. I am incredibly stubborn no matter what situation I'm in. And that really shows in my trading. If I'm trading a stock with size and it's going against me, I say, screw it. I have the money to sustain. What if it goes, let it keep going up higher? I could take some blood, let the stock kick me in the balls. I'm stronger than that. And it just shows on situations like this, like DRYS. If you're short at, let's say, $30, you have 1,000 shares at $30 short, and it goes to 40. You say, I'm down 10 grand. No big deal. I could sustain that. What happens when it goes to 100 and you're down 70 grand? It's crazy. So that's something I struggle with now. I have to learn to cut my losers faster. I usually cut them too late. I usually cut them when the pain is too big and I'm just like, I can't deal with this anymore. If I cut my losers earlier, I would probably be a millionaire by now. It's just crazy, but it's in my brain to be so stubborn. And if I could just fix that problem I have, I would be such a better trader on so many different levels.
Have you made any effort, like any real conscious effort to try and change that? Like, is there anything you've tried?
Yeah, so I've tried using stop losses and they've been helping, but I always feel like when I get stopped out, it's always at the top, So what I've been practicing is setting a stop loss on half my position and then seeing what happens next. If the stock goes even higher, then I'll stop out the rest of my position by myself. If the stock goes lower after my stop, I'll just re-add it back, half my position. So that way it's a little bit of a balance. Sometimes the stop will take over, sometimes I'll take over, depending on the situation.
Right. So when you get into a trade, do you have in your mind like a predetermined amount that you're willing to risk on that trade?
Not really. No, I never set a predetermined amount that I'm willing to lose. I usually just play it based on the chart, So, for example, EGLE, when I lost, $40,000, I said, worst case scenario, the stock is going to go against me and I'm going to probably lose like 10 or 20 grand. Like, it's not a big deal. Like, I thought to myself, whatever. This is a winner. This is a sure thing. I know it's going to drop. So I said, it's not going to be really much of a big deal. But then when DRYS started to reverse, I said, oh shit, maybe I'm fucked. Maybe I have to cover. Maybe I have to take my loss. So I didn't even look at the P&L. I just had to get out of the chart as quick as possible. And then I saw the damage and I was like, shit, this sucks. But luckily the stock, this EGLE is up like $3-4 more since I covered. So I guess I did the right thing for now.
Right. So I want to stay on this for a little longer. I don't want to skip over this. I think it's very interesting that you approach things this way because it kind of goes against a lot of the, conventional wisdom, if you want to call it that's floating around, is having either a stop loss or a predetermined price point or knowing what's going to cause you to get out of that trade. But you're not really like that.
Yeah, I think that's going to cause too much emotional trading. If you say like my number is, let's say, for example, my maximum loss is $10,000 in a trade. I mean, it is the smart thing to stop out at that certain point, but sometimes I guess it's my nature too that I like to risk a little bit more. So I'm a very risky person. I like taking risks like in any situation. So when I see the stock going against me, sometimes depending on the situation, instead of stopping, I'll just add a little bit more. And I'm not going to add to the point where I'm add till oblivion. I'm going to add where it makes sense. And if I'm wrong with that add, I'll take it off 10 cents higher, 20 cents higher. But at least I tried,
So when does it make sense for you to add to a losing position?
It depends. Like, so for example, let's say this EGLE, it went from, I think the day I was short, I think it hit $8 and then started to sell back off. and then ramped a little bit again to like 750. So what I do, let's say I had like a 720 average, 730 average, whatever it was, and it was at $8. So when I saw DRYS reversing at that point, EGLE started reversing. So I said, this might be it. It's time to add. So I added there. The stock went down a little bit more. But then when the whole thesis of DRYS changed, when it reversed itself, that's when I knew, okay, this thesis isn't going to sustain. I have to get out no matter what.
I don't know. I don't really know how to word this correctly, but a lot of what you're doing in managing your trades once they're on is just trying to really gauge the emotion of the market and really trying to work out, like, I guess where price is going, like everyone is, but like you're managing the trade extends a lot further than from the point where you get into the market and have a predetermined stop. Really tracking and trying to have a really good read on where the market's going.
Yeah. So, I mean, if you say like, I'm gonna play EGLE, I'm gonna lose $5,000. As soon as I lose $5,000, I'm gonna be out. The moment you lose $5,000, you're gonna be fucked up in the head a little bit. You're gonna say, I lost, I suck, whatever. And that's going to cloud your judgment for when the reversal really does happen. So I'm okay with taking the loss if I have to at a certain point, but I'm not going to say I lost 40,000. I'm done for the day. I'm going to say, okay, I lost 40,000. You know, I suck. I was an idiot. This was avoidable. But when the stock reverses, I want to be right back in there hitting it with size. It's not going to be just to make the money back. It's going to be because I was wrong in the short term, but I have to re-attack. I have to hit the stock. I'm not gonna sit in a corner and cry if I lose. You know, that's what people are gonna do, and they're never gonna succeed. You have to overcome that loser, even if it's 5,000, 10,000, 20,000, whatever it is. You have to think past that and focus on being the best trader, being in the best trade that you could be.
Okay, so this has probably become a little bit easier for you to do now that your account's a lot larger, but in those earlier days when you were trading accounts that were really just a few grand, were you much the same? Like how has your trading changed from when you were trading, let's just say a $5,000 account to what you're trading now, like a few $100,000?
Yeah, so when I was trading with a smaller account, my idea was do not short any bit of size until the reversal is confirmed. You know, I said I have too little money to risk that if I'm shorting before the reversal, I'm asking to get wiped out. But now with a bigger account, I guess I have the leeway to short a little bit early, to throw out some feelers into parabolics or throw out some feelers into bigger size charts and slowly add on the way down rather than let the stock collapse and then add. It's a little different, but I mean, it's been working for me.
In that same sort of period, was there any like defining moments or turning points, things that changed for when your average P&L for the day went from perhaps maybe a few $100s to, a few $1,000s? Was there any like big changes that you made to your trading that started to ramp up the pace that you were growing your account?
I mean, I increased size, but it was just consistent gains. Like what grew my $5,000 account and what grows my accounts now is very, very different. So what grew that $5,000 account was consistent gains every single day. No matter what, I would show up to the market. I could make $500. I could make $1,000. And then I'd cut my day off. I'd take a nap. I'd do whatever I had to do. And I was just growing my account every day, slowly but surely. Now, what I try to do is I try to find those perfect opportunities, those 90% opportunities, and trade those. So that doesn't mean trading every single day. That means maybe trading once a week or twice a week or maybe like once every other week. I try not to trade every day. I try to trade only when my specific setup shows up. So for example, this week I've been trading every single day. I haven't left the computer because my setups are there. I keep telling everyone these shippers are crazy. They're going to be a once in a lifetime opportunity, both on the long side and the short side. So I can't afford to leave my computer for a second. These opportunities are so big that when the time comes, I have to hammer them lower. It's just, it's crazy to me, honestly.
Do you really think it is a once in a lifetime opportunity though? Or is that a little bit of FOMO? Sure.
I guess it's not a once in a lifetime opportunity, but it's been it's been kind of slow in the small cap world, and seeing a stock go from 5 to 115 in less than a week is going to light up everything. Everything is going to be lit up for a few weeks. So after these shippers run, let's say some chat rooms are going to try to pump the next big thing. And when that happens, they're not going to have as much fuel as this one did. So the fade is going to be even bigger. So I'm trying to stick to the market, stay on my computers to try to anticipate those trades and short them on the way down.
Now, I just want to pick up on something you said there. You said another chat room might try to pump a certain stock. Is that really the way that it works? You know what I mean? Does a chat room actually have the power to be able to really drive a stock price higher like that, or lower even?
It depends on the subscriber base. So let's say one chat room, whatever, let's say they have 1,000 members, right? And the main guy is buying 10,000 shares of an incredibly illiquid stock. This stock trades, let's say 500,000 shares a day, on a regular day. This guy's buying 10,000, 20,000 shares. If a quarter of his chat room buy 1,000 shares, that's already 250,000 shares, right? So it's just going to push the stock much higher. And then what happens when everyone starts to sell, or when there's no real demand for the stock, it's going to go back down. So I live for these chat rooms. I pray that they buy everything, because usually it goes right back down instantly.
I mean, we might have already covered this a little bit, but let's just go through it again, and maybe a bit more in general terms, I think. So what are the qualities of your ideal trade or your ideal setup, scenario, whatever you want to call it?
Okay, so my ideal setup are these sympathy plays that are going on right now. So basically what I'm sure most people thought is when DRYS was halted, everyone said that these stocks are toast. They're collapsing. They're nothing. That's it. The head of the snake is gone. Short these to oblivion. And when DRYS halted, these stocks went down almost instantly. But to everyone's surprise, they held a bid. They started trapping shorts again. They went even higher and higher and higher. And they're still continuing to squeeze people. So now, since DRYS is halted, there are other shipper stocks that are still going up, that are quote unquote the new index for shipper stocks. For example, SINO is the most powerful. It's at nearly $8 or $9, whatever it is right now. So tomorrow morning, depending on how SINO moves, it's going to fuel these other stocks higher. So tomorrow, what my plan is going to be is when SINO starts to reverse, I hit a different sympathy hard. I short it as hard as I can and hope that it's time for these to reverse. And if I'm wrong, if SINO starts to reverse, I'm just going to take my loss. I can't fight these shippers. They're too strong. But basically, my strategy is find the main stock that's running and short their sympathies when the main one starts to reverse. That's what I try to do. That's usually my best, most profitable setup.
Okay. And when you say you're going to try and hit these hard, what does that mean?
I'm going to short as much as I can. So let's say it's going to be 10,000, 20,000, 40, 50,000 shares. I'm going to try to short it and hold it for a few days, because we all know that after the hype is done, they're going to go back to normal. They're going to go back to where they came from. Stocks that went from 2 to 10 are going to go back to 5 by the end of the week, and then they're going to go back down to 2 by the end of the month. So what I'm going to try to do is when the main stock starts to reverse, when the new head of the snake is cut off, I'm going to short sympathy plays and hold for as long as possible, for as much downside as possible. Because we all know these stocks really, they have to raise money. They're toxic companies. There's no real reason to be up rather than a sympathy play. So as soon as all these longs get stuck, it's going to reverse.
So I might have misheard you there, but did you say you might hold these for a few days, or you'll hold them for definitely overnight?
Yes. So right now, the shippers have not reversed. So I'm not holding anything overnight yet. But when they do reverse, I plan on holding maybe 2 or 3 days, because usually the bleeding doesn't stop in one day. They continue to bleed for a couple more days. So that's also something that I'm trying to work on. I'm usually quick to cover. I'm usually quick to take my money and run. But I've realized that for more successful traders, that if you wait a few days, if you stick around for that quote unquote hard money that you just have to wait and be patient for, the payoff really is worth it. The money is really there for your taking, because after a day or two, traders are just looking to the next stock that's moving. They forget about this stock and it just starts to sell off when no one's looking.
Now, from the way you've been talking, it sounds as though you hold pretty large positions. How do you adjust your position size when you're holding a trade overnight? Is that something you do?
It really does depend on the situation. So when a stock is below the VWAP level, that is my tell that usually it's very weak on the day, selling off under VWAP, closing near lows. I think to myself, what reason do I have to cover? Like, it's probably going to go lower the next day, but maybe I'll take off like a third of my position or half of my position, just so that in that case where it goes a little bit higher, I've locked in some money, and worst case scenario, I'll just reshort it tomorrow a little bit lower.
Now, throughout this episode, we've been talking a lot about the shipping container stocks, but just more broadly speaking, how do you identify these sectors and industries that are starting to gain momentum?
Well, usually there's a lot of people on Twitter talking about it, or, chat rooms are talking about it. But when they start to stick, when something like this sticks, like before it was, let's say, Ebola or forklifts or whatever it was, when they start to have these sympathy plays in the similar sectors that every single person is talking about, every single person on Twitter, every single person in a chat room, they're only trading these stocks, that's when you know that there's something going on here. This is when DRYS goes from 5 to 105 or 100, whatever it was, it's going to get people talking. It's going to get people, everyone's going to be curious. Everyone's going to have it on their screen. Everyone's going to be watching every tick of it. It's just, the more eyes that are on it, the crazier everything could get.
And what would you say is your ratio of trades on the long side compared to the short side?
It's pretty pathetic, but it's usually 99% short and 1% long. And the only time I long is usually when I lose in a short. Let's say, for example, I think it was CANF, like a while back, a few months back, whatever it was. I ended up losing $20,000 on the short. And I said, okay, the short isn't working. The stock looks like it's going to go higher. So let me buy it. Let me reverse my bias. Let me reverse my position and just buy the stock. I ended up buying the stock with a bunch of size. I ended up selling for, I think it was a $50,000 win. So it ended up being a $30,000 win on the day after the $20,000 loss. So usually when I long, it's because my short position didn't work out. I see the chart is going to reverse, so I reverse my bias.
Okay. Now, these are not small numbers that we're talking about. Like, you're 22 years old. You make me feel old. No. What do your friends and family think of your trading efforts and the amount of success that you've seen so far?
Basically, my friends really have no idea how much money I'm making. They just know that I trade stocks and that I'm doing well for myself. They have no clue about the numbers. If I tell them, they just won't understand. It'll blow their minds. Like, they'll say I'm crazy, I'm an idiot. Like, what am I doing? You're risking too much. And I say, I'm 22. This is the time to risk. I really have nothing to lose. I have no bills. I have no mortgage. I live with my dad. Like, I think that's one of my benefits too. I don't really have to think about bills. I don't have to think about where I'm going to put my money. Like, what am I going to do? If I have a good month or a good week, I'll wire out some money and keep it in my bank account, save for like a rainy day. And that's about it. I don't really spend that much money out. I really don't have much of a reason to spend except going out on the weekends with my friends.
So why do you not share this sort of thing with your friends?
I don't think they'll understand it. I don't know. I feel like maybe it might be a little bit of showing off, and I just don't think they'll really get it. They know that I trade stocks. They know that I short stocks, but I don't really get into like numbers too much unless I'm talking to someone from the trading community. Then I'm like an open book. I tell them everything. No matter what, send me a question about my numbers and I'll tell you, because they'll understand. They'll know what I'm going through. My friends really, they don't know the stock market, so they won't understand much of anything.
Sure. And what do most of your friends do?
One of my friends does real estate and jewelry. The other friend owns a hardware store. Another one is doing pre-med. He's going to be like a surgeon. The other one's going to be a physical therapist. So I guess they're eventually all going to be doing well for themselves. So.
No, that's really cool, man. Outside of trading, I want to talk to you about this. I think it was earlier this year in 2016, or maybe it was 2015. Anyway, doesn't really matter too much. You renovated a house and flipped it. So tell us a little bit about that. Like, why did you decide to do this?
Yeah, so I think it was 2015, the Las Vegas Conference Traders for a Cause. I met a guy, Louis, Monaco trader on Twitter, and he made most of his fortune from not trading, but from real estate. So he trades just because he loves it, but most of his money is from real estate or venture capital or whatever else he does. So we met up at Vegas. We talked a little bit by the pool, and he said, what are you doing? Like, what is your long-term plan? And I said, I have some money in the bank. It's just really chilling there. It's not really doing much. And he's like, have you ever thought of real estate? And I'm like, like in the back of my head, I thought about it, but it sounds like a lot of work. Maybe it's not for me. And he just gave me some pointers, some tips. He mentioned his story about how he started in real estate. And I guess there was like he planted a seed in my head. He said, you could do it. You're not a dumb kid. You're pretty smart. A lot of people could do it. It's not a problem. So I think the conference was in, let's say, October or November. The market started slowing down in November to December in 2015. So I said, screw it. Why not get into real estate? What do I have to lose? I'm going to learn a lot. It's going to be a cool experience. The market's slow. So I guess I started doing research about what is like a potential good property to buy and flip and whatever. So I ended up coming up upon like foreclosure properties, and I started looking at a bunch of them, and I eventually found one that I enjoyed like that. I said, this one has potential. I see the vision in this house. So long story short, I ended up buying the house, and I guess that was the easiest part of it, buying the house. And then I had to think, like, how the hell am I going to do this? I have to hire a guy to do it. I have to hire a contractor, a plumber, an electrician, some guy to do the masonry at the front of the house, a roofing guy. And it was really overwhelming because it's like trading for the first time. You really have no clue what you're doing. You could press a couple buttons, maybe you'll be lucky, but really, like, you have no clue. So I said, what the hell am I going to do? So I started interviewing. It's funny because I started parking my car outside a Home Depot at like 7 a.m. and calling contractors from their vans, like from the numbers I saw in their vans, and just saying, hey, I have a house in this area. Do you mind if you could come in and maybe give me an estimate on what the work would cost? So I called, I think it was like 30 people, and they all came in. They gave me like varying quotes from like $20,000 to like $70,000 to like fix the house. And you can't ever choose like the cheapest guy because you don't know what kind of work he'll do. You can't choose the most expensive guy because it's not going to fit your budget. So I was a little bit frustrated. So I went out to drink with my friends, and I guess I got a little drunk and started telling them my problems. And one of my friends, he actually owns a hardware store. So he deals with contractors every single day. They come in to buy paint. They come in to buy like anything. So I said, if you find me a good contractor, I'll buy all my materials from your hardware store. And he's like, done, deal. So literally he found me a guy. He was one of the cheaper guys. My friend vouched for him, and I said, all right, let's do this guy. Let's use this guy. And long story short, he had a couple friends that were electricians and plumbers and whatnot. So I guess it all worked out. But yeah, so the work started, and he would just call me and he'd say, I need this, this, and this. And I'm like, all right. And I would go to the Home Depot or whatever it was and just find the materials. Like, I had to choose the hardwood floors, the paint, the kitchen materials, everything. And this is all like my first time doing anything. So I had to I basically winged everything. I didn't know what the hell I was doing. I went to Home Depot. I went to all these like tile specialty stores, like a kitchen store, whatever it was. And I started picking things out that, I would like in a house. So I picked dark wood floors. I picked the paint color. I picked the kitchen with granite countertops. And I guess before I knew it, everything started to come together. I mean, there were a bunch of problems like in between, like contractor nickel and diming for like stupid things or like stupid problems coming up. But as annoying as they weren't that hard to overcome. It just took some common sense and like some negotiation to fix all these problems. And the whole process from buying the house to selling the house was about, I think, 4 months. And then like there was like another 2 or 3 months of like attorney review, making sure the buyers could get a mortgage and all this stuff. And it was really an interesting experience. I learned a lot. I learned about how crooked these contractors could be. I learned how important like my friendships could be with my friends. You know, we help each other, and overall, like the whole experience was cool. But in the back of my head, I was still always thinking like, I miss trading. You know, like when I was doing this house project, I wasn't trading that much. I was trading once a month, and like just so I could get like my addiction settled. Like there really wasn't much plays or whatever it was, and I was just thinking like, you know, this real estate thing is cool, but trading really is where my heart is. Like, it's still what I'm thinking about. Like, so when the house got sold, I started trading again. I had more time to trade again. And I guess the timing was right. Everything was right. And all these stupid stocks, like these sympathy stocks or these low flow plays were back again. And no hesitation, I was back in my element. There was no, it was like riding a bike. I knew exactly what I was doing, and it turned out to be one of my most profitable months of the entire year. I did really well the first month I came back, and since then, it's just trading's been on my mind 24/7.
Right. So do you have any plans of doing, you know, another venture into real estate?
So like I said, my contractor was nickel and diming me for everything, and it was just so frustrating and annoying. Like by the end of it, I was just so sick of him. So I mean, I think a lot of this whole real estate thing depends on your team. It depends on who you're working with. Are they people you could trust? Are they honest people? Are they people that you know aren't there to screw you? And my guy, as much as my friend vouched for him, he was there to screw me a little bit, you know. He's there to make his money, whatever it was. And from that guy, just that one guy, discouraged me from doing this whole thing again. But if I found the right team, honestly, I'd be happy to do it over again. It was a really cool experience. I loved the feeling of turning a garbage house. There were holes in there that smelled like shit. It was terrible in there. And I'm glad like I turned it into something that someone could live in, you know. They're going to like start a family in there, and it's just all from like a stupid garbage property that if they saw before, they would never think about buying it.
Yeah, so if you did do it again, or when you do it again, you know, obviously the team is a big one. Like you'd make sure you had a better team or a team that you click with. Is there anything else you would have done differently? Like how did you go budget-wise? I know it's very easy to go over budget when you're renovating a house or, you know, and picking the wrong house. Like it's very easy to lose money in real estate, you know, just as easy as it is in trading, I think, to a certain level. Is there anything else you would have done differently?
So the area that I bought the house in obviously wasn't like the best area possible because it was very, very cheap. So the way I did the house is basically everything I loved, everything I thought would look cool. But all those things like take a lot of money. Like they cost a lot of money. So what I should have done differently is not think about what I want. I had to think about what buyers in the area want. And that would have saved me a lot more money. You know, instead of using granite countertops or decent like appliances, I could go with the cheapest appliances and the cheapest countertops, and the house would still sell, you know? So I guess I was doing it for the first time. I didn't really know what I was doing, but now that I know a little bit better, I know what it takes to like flip a house profitably. It depends on the area. It depends on like the kitchens, the bathrooms, or whatever. And I just learned that I was cheaping out on the bathrooms a little bit. And I know now that if I wasn't cheaping out on the bathrooms, the house would sell a little bit better. I was like garbage. The bathrooms I thought were garbage, but I don't know. I mean, I made some money on the house. You know, for my first project, I made some money. You know, I'm happy about that. I was ready to break even or even lose a little bit of money just so I could get that knowledge. But I'm glad everything really worked out.
Yeah. Oh, that's good, man. That's good. And I think you went into it with the right attitude as well. I mean, you know, learn before you earn in some ways. So, no, good on you, man. That's awesome. Anyway, Alex, let's leave it at that. Is there anything else you want to add? Anything you want to share with listeners before we call this a wrap?
I guess the most important thing is that when you're trying to grow small account, always focus on consistency. Like, find a setup that you're really, really good at, a setup that you know you'll win at, and trade that. You have no reason to trade like something like Facebook if it's moving on earnings just so you get a rush or whatever. Find something that you're good at. Find consistent profits, and your account will grow really fast. I couldn't believe how fast my account grew when I was being consistent, trading every day, trading setups that were there for me. It's just the little things add up. It might take time, but trust me, it adds up faster than you'll imagine.
So where's the best place that listeners can go to find out more about you?
I guess my Twitter or my blog, they're both on my Twitter. I guess my Twitter is ATO9_trader, and my blog is ATO9trader.blogspot.com. So, I mean, I have like some story about my real estate thing there. And I post on Twitter pretty regularly about some trades I'm in or some thoughts. So that's about it.
Excellent, man. And can you just repeat your Twitter handle one more time in case someone missed that?
It's AT09_trader.
Okay, good stuff. Alex, thank you very much for coming on the podcast, man. It's been a blast to speak with you. Thanks very much, man.
Definitely, man. Thanks for the opportunity.
You've reached the end of this episode of Chat with Traders. But rest assured, there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes. And we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Spotify, it's Jay Shetty. Are you one of those media strategy people? Scrolling through spreadsheets, searching for an audience that pays twice as much attention to your ads than they do on social? Let me introduce you to Fans. And they're here with me on Spotify. Trust me, I know Fans. They don't skip, they stay for hours. They don't move on, they manifest. They're not a demographic group, they're fans.
Spotify advertising. You're among fans.
What would your trading look like if capital wasn't the constraint? That's the reality for most traders. It's not skill holding them back, it's size. Trade the Pool changes that. Step into the U.S. equity markets with up to $200,000 in buying power without committing your own capital. Full access to stocks and ETFs, long or short, executed with the precision and freedom serious traders expect. Your performance is measured by one standard: disciplined risk management and consistent execution. Meet that standard and you operate at scale. No subscriptions, no ongoing obligations, just a clear path forward. For those ready to trade beyond limitations, this is the next level.
We are live from Feddy's house.
Guests are gathering around the TV, even with a big storm outside.
Are we worried about the fee?
No, they have Xfinity Wi-Fi.
Get reliable fiber-powered gig Wi-Fi with Peacock included to stream the beautiful game this summer. Xfinity. Imagine that. Restrictions apply. New gig internet members only. Speeds vary. Use of fiber coaxial cable. Peacock offer for Peacock Premium with ads currently $10.99 a month value. Activation required to access content. Terms apply. Peacock must be activated within first 90 days. Manage existing subscriptions to avoid multiple charges. Third-party subscriptions continue until canceled.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
Hey team, what's going on? I really hope you had an incredible Christmas day, ate yourself silly, and had plenty of laughs. For this episode, being 105, I asked Brendan Poots onto the podcast. Brendan is the founder of a sports betting hedge fund, the Prihoma Group. The main sports which Prihoma bet on include football, as in soccer, cricket, golf, and also horse racing and tennis. Prihoma set up shop in Melbourne, Australia in 2010, and more recently have expanded with a second location in Gibraltar, which is in Europe. Since inception, at the time of recording this, December 2016, Prihoma's Cloney Fund has returned a little over 220%. The fund has had no losing years. Worst losing month was minus 6.4%. Best month was plus 11.8%. And the fund makes positive returns 77.8% of months. From listening to our chat, you'll get great insight to how Brendan runs his operation, from getting investors to buy in, to controlling risk and minimizing the volatility of returns, and how the fund makes money trading sports games. Naturally, there are many crossovers to financial markets, which you'll pick up on. I had a great time speaking with Brendan, and I hope you'll enjoy listening. Now, just a small announcement before we get to the meat of this episode. So I've recently struck up a bit of a deal with Edgewonk for Chat with Traders listeners. Now, I'm sure many are already aware of Edgewonk, but if not, the simplest way of putting it is Edgewonk is a journaling tool built specifically for traders. And I know I don't need to emphasize just how important journaling is, as it's something we discuss frequently on this podcast. But the cool thing with Edgewonk is it takes your journaling entries and trades and shows you metrics for how you're performing and areas that you can improve on. Ultimately, Edgewonk helps you to discover your edge. It's got a lot of awesome features. Visit edgewonk.com, that's E-D-G-E, Edgewonk, W-O-N-K, edgewonk.com, and enter traders during checkout to score $20 off any package. For full transparency, I do receive a small kickback for anyone who purchases using the coupon code TRADERS, but the price is not inflated in order for me to be compensated. Like I mentioned, it'll actually save you $20. And I'm done. I'm Aaron Fifield, your host. Please welcome my guest, Brendan Poots. Sounds like you've had a pretty hectic week.
Yeah, well, this is one of the big things we trade on is the English Premier League and the European football.
Okay.
And this week they've got 3 full rounds. So they had a full round on Saturday, Sunday. They had a full round on Wednesday, Thursday, and they've got a full round this Saturday, Sunday. So there's been 30 matches we've had to go through and do our work with. So it's been quite hectic. And then when you throw in the cricket, which is going on at the moment, that's our other big sport. Yeah, it's been a big week.
Okay. And Christmas is coming up. So what are you doing? Are you shutting down over Christmas?
No, that's historically our busiest time, because you could imagine the same happens with the football, for instance. You'll have games on Christmas Eve, then you'll have another round on just Boxing Day and the next day, and then you've got another round on New Year's Day. So you've got another 3 sets of games in the space of 10 days. And then you've got, whenever there's these public holidays, like Easter and Christmas, that happens to be when there's a lot of sport. So subsequently, I tend to take my family's in Perth, mum and dad and brother, so I'll probably head back there early in the new year when there's a little bit of a lull.
Yeah, and when you get these big games happening around public holidays, does that bring more opportunity to make more money during those times, or not so much?
Yes, no, absolutely. There's so much more money that's being traded that obviously one of the keys to our success so far has been making sure that our trade size per match is proportionate to the total volume that will be traded on the match. So you don't want to be putting a really big bet on a match where there's not a lot of liquidity, because effectively you're betting against yourself. Whereas when you have these really big matches, there's so much liquidity that it doesn't matter because basically if we have a big trade and it goes wrong, we need to be able to get out. So you want to be trading an amount which the market will tolerate and will let you get out if things go wrong. Which is why we don't do it. To give you an example, an English Premier League match, a typical English Premier League match will have somewhere between 10 and 20 million dollars traded on the platforms that we use. Those same platforms in an AFL match will have 300,000. So if you have a $20,000 bet in an AFL match, you're effectively almost 10% of the pool, and then you can't get out. So the bigger match, yeah. So we tend to focus on the most liquid sports because A, we think we've got an edge there, and B, it allows us to stake accordingly.
Okay. So this might be a bit of a strange question. I mean, me personally, I've never put a bet on a sports game in my life. So forgive me if this is kind of a weird question to ask, but how does it work? Because I always was sort of under the impression that the bookmaker says, we've got this game, these are the payout odds for if this team wins or whatever the situation is, that's how much you make, otherwise you lose your bet. But you're like talking about this as though it's kind of like an active marketplace where, you know, there's liquidity issues and that sort of thing. Like, how does that work? Are you betting on a different sort of, I don't know if exchange is the right word, but a different kind of platform than what retail people are playing on?
Yeah, well, there are a few different global exchanges. So they work in global sports betting exchanges, and they work exactly the same as your typical stock market exchange, which is buyers and sellers meet, and they facilitate that meeting. But the big difference, and this is what has allowed our business to grow and develop, is the advent of in-play sports betting. So whereas previously, and we're talking probably 15 to 20 years ago, sports betting used to be a binary outcome, and you're exactly right in the way you described it. You used to put a bet on, and then you'd have to wait till the end of the match for the result, and you'd either win or you lose. But with the advent of in-play betting, what happens now is that as soon as the match starts, you can still bet. And as a result of that, say, for instance, you've got a bet on a team that's, let's say it's $2 each of two teams. You'd never get that for the bookmakers because they have their commission in there. But say you've bet on a team at $2 and it's a binary outcome, so it's a win-lose match, so the draw's not in there like it is in football. So say it's a rugby league or an AFL match, and your side goes to 20 points in front, say, so then the odds will have changed. So the side that's now 20 points in front, their $2 will now be $1.40, and the side that's now 20 points behind will have gone from $2 to $3.40 or something like that. So the market started at $2. Now the market's at $1.40, $3.40 or something like that. So what you can do, you can now bet on the other side at $3.40 a certain amount of your money to cover up. So then you've got, no matter who wins the match, you'll make a profit. Does that make sense?
It does, yeah. So just backtracking a little bit, do you still have the option to play or to bet on a in-play game and as well as bet for like a binary outcome?
Yes, you do. And what we do, we'll have an opening position, which will be pre-match. So typically what will happen is matches on the weekend, for instance, the soccer in England, those markets will have already come up. So the market's there now and you can have a bet. And what tends to happen is the early markets are somewhat inefficient, but as you get towards kickoff, that's when all the money comes in and the markets sort of even themselves out a little bit. So if we look at a game today and we think that the market's wrong, we'll take a position today. But then once that match starts on the Saturday night, 48 hours time, we will monitor that position and we will trade that position depending on how the match goes. So if our side that we think we've taken the initial position on goes way in front, we will then back the other side to close out a profit and hedge our position. If it's the other way round, we will then hedge out so we mitigate our loss. So it's no longer you win or you lose outcome. It's now you can win or you can win or you don't lose as much. So for instance, a bad trade for us now would typically be a 20 or a 30% loss of our initial investment. whereas previously it would have been 100%. So in that instance, what's happened? We've made a bet on a side. They've gone behind. They've gone further behind. Okay, what do? We need to start hedging our position by either backing the opposition or betting into other markets so we mitigate our loss.
Well, we're going to get into this much deeper, but before we go too much further, do you want to fill us in on your background prior to founding the Prahoma Group?
Okay, well, I'm Irish by background. Okay, so one of the golden rules of being an Irishman is that you love to have a bet. So I was brought up in an environment where having a bet was the typical Saturday morning was spent with my dad and my brothers over the kitchen table looking at the form guide. So I'd been exposed to the joys of punting from a very young age. Now, through school and university, I used to have a bet and what have you. And then at the end of my university degree, which was a degree in chemical engineering, I chose to pursue a professional sporting career. I was a cricketer, and so I went over to England to play county cricket for Sussex. Now, my benefactor, the guy that sponsored me, who got me the club side and provided me with the house and the car and all the things that go with it, he was a bookmaker, and he had 2 shops in Surrey, in the south of London there. And I was playing cricket by day, and then with the long nights, I'd go work in one of his shops and be a bookmaker at night. So that was my first entree, I guess, into the professional side of sports betting, for want of a better term. Well, horse race betting and sports betting, because back then sports betting wasn't so big in Australia, but it was certainly big in England. So fast forward 4 years, when I'd realised I was not going to cut the mustard as a cricketer, I then went and worked in investment banking, finance, venture capital type industries, where I was analysing, I was looking for value, trying to find a share. If we valued a share at $2, but it was trading in the market at $1, then that's a buy. And I thought, okay, that makes sense. That's interesting. But one of the things that was the downside of that is it's very slow moving. You don't tend to buy a share at $1 and then an hour later it's $3. It might be 6 months later or a year later. So then in 2006, I was very fortunate to earn a scholarship to complete my MBA studies at Columbia University in New York. And that was 2007 was when I went. And then obviously in 2008, there was the financial crisis. So your typical Columbia MBA graduate would pursue a career in consulting or with one of the major banks, being a trader or investment banker, one of those areas. But all those jobs had dried up. And having already worked in those industries, I didn't want to go in as a 32-year-old, 33-year-old lackey. So what I decided to do was I thought, where would I want my money during the financial crisis? I thought, well, I want to have my own personal money somewhere which is liquid, somewhere which is non-correlated, and somewhere where I really knew what was going on. Obviously, the global financial crisis was catalyzed by ratings agencies, manufacturing ratings of the mortgage-backed securities and a lot of other nefarious type activities. So I said, well, I know sport. Betfair, I understand that it's growing. There's a Betfair global exchange. So how about I apply those principles that I've been educated and then previously I professionally used in the realm of sports betting or trading or investing, depending on how you want to term it. So in 2008, 2009, I started with my own money and I started building my own very antiquated algorithms and fairly much focused on a little bit of horse racing, but predominantly cricket and football or soccer. And then in 2010, I decided, well, I've done this now for a couple of years. I've got decent returns. I started speaking to some friends about it, and they said, yeah, we'd give you some money. In 2010, Prahoma Capital was formed as a sports hedge fund, and that's the origin of where we started, how we started, and since then, your typical client for us now has gone from being a friend who would give me $10,000 or $20,000 to now people who we have never met giving us a couple of $100,000, $300,000, $400,000, $500,000 to manage. So that is the origin of how we started and where we've got to today.
Okay, so you started the fund in 2010, yeah?
Officially, yes. That's when it was registered as a business. I was trading my own money and figuring out the strategies in 2008, 2009, but I started taking external investors' money in 2010.
Okay. And, you mentioned earlier that you'd been kind of placing bets all throughout your, even your childhood, and then throughout your schooling days and that sort of thing. During that time, were you just having a punt, or were you actually being somewhat strategic about your betting?
Okay, it started as a punt, but then it morphed very quickly into a strategic way of betting or trading. And effectively, I was, from the periods of about the age of 26 when I finished my cricketing career, or basically gave up the dream of playing professionally, for the next 4 years, my goal was to pay my rent every month with winnings from betting on sport. So that's when it became quite strategic.
Okay. And were you able to achieve that goal?
I was, yes. And that was, that was what sort of lit the fire underneath me for when, because after that was when I went over to university in America, and I pretty much paid for my university degree. The scholarship paid for the tuition and the accommodation, but certainly the running costs of living in New York had to be paid somehow, and I pretty much paid them via gambling or betting or investing on sport, depending on how you look at it. Yeah, so that was what gave me the confidence to say, okay, this can be done if you approach it in a methodical manner. One of the tricks, and certainly when I interview people for any positions within our firm, one of the disciplines that is definitely required is, with sport, there's always another race, there's always another match. It's coming at you thick and fast. So you need to really be able to outline a strategy and then cherry pick your matches or your races to play in, because you can quite easily get yourself dug into a hole because there is just so much coming at you.
Yeah, so starting the fund, were there any regulation issues, any hoops that you had to jump through to do this? Because, I think sports betting hedge funds are pretty few and far between. Did you have to do any, was there any additional challenges than what there is to normally managing money?
Well, yes, there is, and that takes us to where we are now in terms of our offshore office in Gibraltar. But certainly starting off, the Australian fund operates as a small-scale private fund, which is limited to the number of investors, and that is one of the ASIC rules. So you're limited to the number of investors, retail, I guess, who invest less than $500,000. So that limits you. So as long as you stay below that threshold, you can operate as a private small fund, which is what we've been doing. But clearly, that's how we started, and it was obviously the lowest risk, lowest cost way. But given the success that we've had, we've just now registered a Gibraltar fund and a Gibraltar company, and that is a fully regulated vehicle under the AIFMD, which is the Alternative Investment Funds Management Directive, I think, in Europe. So the restraints you have in Australia are very much around the number of investors you have, as well as the number of funds you have, whereas now we've been able to parlay our success into a European fund, which allows effectively unlimited growth.
Right, okay. Sure. Now, I think you may have already answered this to some extent, but, just so we're very clear on this, why did you decide to open a sports betting hedge fund rather than a fund that trades financial markets? Like you brought up previously that you had some experience in financial markets also.
Well, the real catalyst was the global financial crisis in 2007, 2008 there, where basically it didn't matter whether you owned luxury cars, property, stocks, bonds, shares. They all were fairly much adversely affected by the global financial crisis. So the dream for a lot of investors, be it professional investors managing money or people who are investing money, is to find an uncorrelated asset class, one which is fairly much immune to every other asset class. And that was what drew me to sport, because during that financial crisis, all the major sporting events kept being played. There was millions and millions of dollars being traded or bet on those sporting contests. So to me, that was the ultimate uncorrelated asset class. Couple that with the fact that having spent countless hours looking through information memorandums and annual reports and spreadsheets on financial markets and businesses, I was never going to be the best at that. I was competing against, always competing against a lot of very smart people who love that sort of thing, and not loving it was always going to be my problem. I'd done the periods of 16-hour days, 17-hour days, and quite frankly, I was not very good at it. I lacked the passion and I lacked the motivation to do it. So I guess combining the fact that I'd identified a non-correlated asset class, and it was also in an area which I actually loved and an area where I could spend 16 hours a day doing it and not feeling like it was work, that was why the sports hedge fund started. And the other thing about it was that I liked the fact that I could be sort of pioneering something which no one had ever done. I've got an obstinate part of me which was, proving people wrong and things like that. And along the way, we've had lots of criticism, and I've had lots of personal criticism about what I've been doing, but that sort of spurs me on more than anything. So rather than being lost in a corporate and being well paid to be unhappy in a corporate, I thought, well, let's start something new and let's be happy, probably earning less, but building something. And that's sort of where it all started. And look, it's now an international business with international investors, and it's sort of getting close to being where I would have been anyway, have I been working with a firm, but I'm doing it on my own back, and that's quite rewarding.
No, I love that answer. And I just want to pick up on your point about sports betting being uncorrelated to financial markets. This might be a bit of a stretch, but is there any flow-on effect? Because I would presume that if we had another event like 2008, the GFC, there would be, people would have less disposable income. They'd be less likely to put some money on a sports race. Would that have any effect on you and what you're doing?
Yes, potentially, but ultimately I think betting on sport, cheering on your sports team, it's a little bit like people who smoke or have a drink, in that it doesn't really matter what's happening in the world. If you haven't got enough money, you'll still go find a beer, or you'll still go buy a packet of smokes, because that's what you do, and it's part of your makeup. So I would suggest no in the overall scheme of things. What we've seen is that there has not been there hasn't been a lot of downturn. The business of sports betting has grown between 3, 5, 7% in some markets consistently over the last 10 or 15 years, and there hasn't been a downturn based on global economics, because people still like having a bet and people still will follow their sporting team. And maybe the contrary might be true, in that when life's really bad, you actually try and make more money, and you try and have a bit of a drink, and you try and cheer on your sports team even more when things aren't looking good. So I hear your point, and there might be some negative impact, but certainly we haven't seen it, and we're not big enough for it to have made an impact on us, certainly.
Yeah, okay. And just on a side note there, do you ever have trouble betting on a team that you would normally cheer for, like betting against a team that you would normally cheer for?
There is that pops up every now and then, but some people call it a personality flaw. I think it's a personality strength, is that I'm pretty good at compartmentalizing my love of anything with the pragmatism that I'm required. So ultimately, no. I'm driven by the numbers and the opportunity more than anything else. I'm not the sort of fan who will be seen wearing a replica T-shirt or wearing a scarf or something like that. So I'm not too heavily invested emotionally in any team, despite having my favourites, of course.
Okay.
And we're live from the living room as Doug eyes up the matchday spread. He's reaching for the Buffalo wing. Perfect. Hang on, what's this? Oh, he's gone for a can of Pepsi too. Incredible. What a finish. Sensational combination. Look at the delight on his face. There's no doubt about it. It just tastes better. Match days deserve Pepsi. Food deserves Pepsi. Grab a pack of Pepsi Zero Sugar for today's match. It's poetry in motion.
Ever watch a stock rip and think, I could have nailed that if I had real capital? The truth is, many capable traders never reach their potential, not due to lack of skill, but lack of scale. Trade the Pool was built to solve exactly that. A firm designed for serious individuals who want access to the U.S. equity markets with meaningful buying power, up to $200,000 without committing their own capital. Get access to virtually every stock and ETF. Go long or short freely with the flexibility professional traders expect. You're evaluated on one thing: your ability to manage risk and execute with consistency. Meet the standard, and you trade at scale. No subscriptions, no ongoing commitments. Whether you're still refining your strategy, a trader with experience who hasn't yet broken through, or a seasoned professional simply looking for more capital, Trade the Pool is built to meet you where you are and take you that next step further. The markets have evolved, access has evolved, now so has the way traders operate within them. Trade the Pool.
So you brought up earlier the fact that you did cop quite a bit of criticism for doing what you're doing, starting one of the very first sports betting hedge funds. Was it difficult for you to get investors, to buy into what you were doing? Because there is this kind of negative connotation around sports betting with most people anyway. I think most people who actually listen to this podcast will understand that there's a way that you can go about it in somewhat of a professional manner. But was it difficult to get investors to buy into what you were doing?
Well, certainly part of the problem with the short answer is yes. Early on, when I've got friends who are getting involved, they knew me, they trusted me. Some of the early investors that we took on board, we had to capital guarantee their investment, basically saying, look, you're not going to lose your money, etc. At worst, you'll get your money back. The hardest thing, and this is why the European adventure is of great appeal to us, was the educating of potential investors with respect to sport is no longer a binary outcome. You can be a punter or a bettor, you can be a bookmaker, or you can be a combination of both. So in Australia, whilst Betfair's a burgeoning business and Matchbook, etc., betting in play, being able to trade, being able to hedge, most people don't understand that as a way of trading or betting on sport. And typically most of our investors are not the young, not 18 to 25-year-old guys or girls who have grown up with that environment. They tend to be the people who have accumulated a deal of wealth, so they're a little bit older. So they're used to just going to the TAB or going to a bookmaker, having a bet and either winning or losing. So the hardest thing has been the educating. And then the second thing which we've really focused on has been the reduction in the volatility of our returns. Because a lot of people, you hear stories about, you won $100, then you lost $100, you won $80, you lost $80. We've taken all the volatility out of our trading. So a bad month for us will be a minus 1% month. A good month will be a plus 4% month type thing. Used to be a lot higher and lower respectively, but now we've taken the volatility out of it. So people now see that it can be done. And that's been, so the hardest thing at the start was educating, as well as trying to talk to people and alleviate any concerns they had about the potential risk profile of the returns.
Okay. Yeah, that's an interesting point you bring up. And I've spoken to a few fund managers on this podcast, and that educating their investors is something that has come up a couple times as being a big part of the challenge in managing other people's money. So let's talk about this a little more, especially because you were offering a capital guarantee in those early days. That's a pretty big commitment from your side. How were you able to manage risk, and how are you able to manage risk, and how do you control the volatility of your returns? Like, what sort of things do you do?
Right. Well, the first thing is we cherry pick the trades that we make. So let's talk Premier League football. There's 10 matches every round. There's win, draw, loss markets. There's over, under markets. There are a multitude of different markets that we have information on and we can trade on. But we only ever trade where we've got a clear premium compared to the market. So that, by definition, narrows down a lot of your opportunities. So on a typical EPL weekend, we might only have 3 or 4 trades out of 10 matches and maybe 50 or 60 markets. So that's the first thing we do, is we only ever make a trade where there's value. The second thing we do in terms of the volatility side of things is that, as I mentioned earlier about the in-play trading and what that allows in terms of capability, we would rarely run an event to expiry without trading out. So pretty much about 95 to 97% of all of our trades are hedged. So what that means, a good example would be, as I touched on earlier, if you've got a football team and it's in a 3-way contest and they start at $2 and they score and they go to $1.30 or $1.40, we will then take opposing positions in that match so that we've just locked in a profit straight away and then we move on. The only instance where we wouldn't do that would be if they scored 2 or 3 goals very quickly and they were well in front, and then whilst we wouldn't trade out, we'd still monitor that match so that if the other side started coming back or the statistics said they'd be coming back, we'd start hedging out. But we're very selective and we cherry pick the trades we make, and every trade we make, plus or minus 1 or 2%, we always look to exit. So a typical trade for us will be a 15-minute or a 20-minute trade. We don't trade to expiry. We're never sitting there in the 90th minute of a football match hoping for a goal or hoping for a penalty or something like that, because we're long gone by then.
Okay, so just so I understand that right, in most cases, you're out of the trade or the bet before expiry.
Correct.
Is that because you just want to lock in your profit as soon as possible and move on, or is there a little bit more to it than that?
Well, it's a combination. There's certainly the psychological aspect of it, which is to take your profit and run. The other one is the data that we've built up through the algorithms and the statistical database. To give you an example of, in football, if a side scores and they go to $1.40 immediately, they're going to hover around $1.40 for the next 25, 30 minutes, depending on how the event's unfolding. So effectively, you've got risk sitting there, and you've got 30 minutes of risk with very little reward, because the market's not going in your favour. It will just keep ticking around the same spot. So it's a combination of the psychological love, I guess, of taking your profit and running, but also of the risk return of staying in a position longer than you need to. And that's probably the main drivers.
And while we're talking about risk here, besides taking a loss on a bet, are there any other risks inherent to sports betting, maybe along the lines of like a bookmaker going out of business, government regulations, injury of a player, any other risks like that?
There are. I would say that all of our service providers, which are all very large regulated betting exchanges or bookmakers, so we're not dealing with small guys. We're dealing with people who we've got agreements in place, who will accept our bets, will accept our volume, and they're registered, regulated. They're highly scrutinised because they're generally listed. Most of them are listed bookmakers. So counterparty risk it's never non-existent, but I suspect it's fairly low. Government regulations, well, that's obviously a pain in the backside in Australia. because of the fact that they don't allow in-play betting. They only allow it via phone, whereas if you're in Europe, you can be betting on your computer and just betting in play without having to be on the phone. So those sorts of things, like we've got around that by having the office in Europe so we can execute our trades much more quickly. Now, injury to player, that's one of the things that we like about sports is that we find that it's much more transparent in terms of the information dissemination than certainly some other markets. So a lot of you only have to pick up the sporting pages and it's all over the pages whether there's a injury or whether there's injury clouds about people. So a lot of that information is out there. So most times we'll have taken that into account in terms of our pre-match trading analysis and pricing. Now, if one of those events happens in play, what we tend to find is that the reaction to a player being injured is over exaggerated. To give you an idea of basketball, we don't touch, but basketball, for instance, your main player is going to be touching the ball almost every play, so that can make a big impact. But if you look at football, as in soccer, for instance, losing a star player in the big sides, they're generally replaced by another star player. So the incremental degradation in performance expectation is not as great as one would imagine. So yes, injured players injured, they can affect things, but it certainly doesn't lead to a catastrophic loss. So if someone gets injured, the market doesn't turn completely on its head. So if you do get worried, you could then close that trade if you want. But what we've tended to find is that injuries to players tend to represent a market opportunity because the market overreacts.
And are there any other risks which I may not have mentioned there? Anything that comes to mind?
Well, there's always the risk that we could lose all the money. Like that goes with any investment fund. But in terms of external risks, not really. There's the major ones, I think, are the counterparty risks, which we don't think are very, very large. We've touched on the business and regulatory risks. If you're an investor in one of certainly our Australian fund, there'd be the exchange rate risk because of the fact that the Australian fund is domiciled in Aussie dollar, the European fund is domiciled in British pound. So there's those exchange rate risks, but certainly there's no market shock. And that's one of the things that when we talk about one of the differences between our asset class and the traditional asset classes, it's immune to market shocks. And if you look at what's happened over the last couple of years with the Brexit, the way the market reacted to that, the financial markets reacted to that. If you look at when there was the Greek default with the IMF, the market reacted to that. When the Swiss franc was depegged against the euro, there was a lot of market shocks there, and there was a lot of businesses which were highly leveraged which went under because of that shock and that no one anticipating that event. So in that sense, there are no external risks which can violently upset the apple cart.
Okay, no, that's an awesome answer. Now, how important is an understanding of the sport compared to just weighing up the probabilities and payout odds? I mean, maybe if we can just get into the strategy a little more. So, yeah, tell us a bit about that.
Well, it's essential when it comes to our algorithm development. Now, what we've been very prudent with doing, and this has come as a false start from a previous bad experience, is that grabbing a smart mathematician or a smart statistician is not enough. You need to grab one who has domain knowledge of the sport itself so that they can model and they can incorporate the nuances that pertain to each sport. Subsequently, at this point in time, that's why we tend to focus on only the 3 or 4 sports, because we've only been able to identify 3 or 4 PhD quant guys who have got an innate understanding of each sport. Now, from the trading perspective, the numbers, I would dare say that you don't have to know the sport to trade the numbers per se, but it helps. Obviously, one of the big things in any sport is momentum and momentum shifts. And if you're going to be trading a sport, you need to be able to understand and notice them and see them. So that helps a lot. But certainly it's an absolute prerequisite for our algorithm development that the analyst or the developer in charge of each sport understands the sport innately.
Okay. You said there that you focus on, I think it was 3 or 4 sports. Do you deliberately avoid other sports for any reason? Maybe you feel as though there's no edge in actually competing on those sports, or is it purely just because a staffing limitation?
Well, it's a combination of a lot of things. For instance, AFL here in Australia, we won't have a bet on AFL because you can't trade. The numbers don't let you. As I mentioned earlier, a good game in AFL might have $500,000 traded on it. You compare that to $10 or $15 million traded on a Premier League match, or $50 to $100 million traded on a Big Bash cricket match. So there's the liquidity aspect of betting on a sport, because that's all very well getting set, but if the game goes the wrong way, you can't hedge your position. So there's the liquidity aspect. There's the innate understanding aspect, which is driven by a lack of quants. Like American sports, we would love to get involved in, but we're yet to find any analyst quant who understands the sport to the level we need. We can watch a sport. If a quarterback gets injured, we know that affects the game, but how much does it affect the game? We can't quantify, whereas certainly with the other sports, we can, because a lot of our modelling is underpinned by player ratings, we know what a player means to a team, whereas we don't in a lot of the sports. All the sports we don't trade. So it's born out of liquidity, and it's born out of the right manpower. We get a lot of CVs from people who are NFL experts or whatever they that's how they call themselves, but none of them tend to stack up when we ask the questions that we ask.
So why is that? They don't have the right qualifications, or they don't understand the sport deep enough?
Yeah, well, there's a couple of things. Partly is that what we've done here is we've separated the analysis and the trading side of things. So our analysts don't trade, and our traders don't. They help with the analysis, but they certainly don't build the algorithms. They'll help with some input. So we've separated those two functions within the business. So a lot of the people that come to us, they're gamblers. They don't. And this is the other thing about American sport, is that because America has been effectively a binary sports betting nation since eternity, you either win or you lose, they don't actually have the concept of trading. So a lot of the American people, or a lot of the people who tell us that they're specialists at America, they will be having binary bets, win and lose, and that brings with it long good runs and very long bad runs, which then takes our volatility up. So that's why we don't tend to find we haven't found anyone good that matches us as yet.
Okay. So here you're talking about PhD quants, you're talking about statisticians. How much discretion do you use versus quantitative methods in regard to your bets?
Okay. Well, first, certainly there's the typical work week, for instance, is, say we've got a weekend round of sport coming up, we'll have all the data and we'll have our prices by Tuesday or Wednesday morning. And then there's a discussion amongst the team about, all right, what's happening? You know, there's a big match this weekend, for instance, Liverpool versus Everton in the football. That's a Merseyside derby. Stay clear of that, because there are so many qualitative factors in a Merseyside derby that's impossible to bet on. You know, these two sides hate each other. They've hated each other for hundreds of years, etc. So that aspect comes into in the previews during the week of what's been happening. Are there any external factors we need to take into account? How will that affect our price? And most of the time when there's an external factor like that, even if there's perceived value in the market based on our output, we'll steer clear of that event purely because of the unknowns of those qualitative factors. Now, once a match is in play, that's where the trading becomes, I guess, 80% algorithmically driven and 20% trader driven, market driven. So there's probably a 20-80 split of the trading once the match goes in play.
Okay, so would you describe the way that you guys bet on sports as a strategy? Is that the right sort of way to frame it?
Yeah, absolutely. We have a couple of strategies which we like, market strategies, where we bet in a certain way on a certain market, and we just replicate that all the time. That's sort of our bread and butter trade. So that's definitely a strategy, and the way we approach it is a strategy as well. For us to get involved, we need at least a 25% premium on. So if we've priced something at $2, we need to get in $2.50 in the market for us to be interested, sort of thing. So yeah, it's all underpinned by a robust strategy which has been developed by trial and error back when I was playing with my own money, but has since been continuing to be optimized since the start of the fund.
And do you guys do any work on actually validating those strategies before you start actually trading them?
Yeah, absolutely. So the typical process of building an algorithm or building a sports data set, there's a certain element of that which will be trialing the trading strategies which I want to employ, or we want to employ, because it's instead of, I guess, the process is, all right, there's an opportunity in the golf market, in this type of market, it might be betting on the first round leader, or it might be betting against the first round leader. We have a strategy, a hypothetical strategy, and then once we built the database, we then back test that strategy against all previous results, and then that gives us an idea of where we should be headed and what we can expect. So yeah, it's all driven by that. Yep.
Okay. And is it fairly easy to come by data for sports betting?
Very easy. Well, the data is a commodity. The data itself is, if you wanted to build your own model on football or EPL or something, the historical data is very easy to come by. So, and if you want to get live data as it happens, you can purchase that, have that streamed straight into your own system. So that's very easy. The data itself is a commodity. It's very easy to get. The trick is understanding and developing a system which recognizes data which means something and data which is purely noise. And there's a lot of noise. And in terms of possession, if you look at possession, historically possession used to be in football, soccer, it used to be a good determinant on who would win. Leicester managed to win the championship last year, generally with 40% or less possession. So that's noise, and that's the sort of stuff you need to be able to wade your way through.
Yeah, so I mean, it's much the same as data for financial markets as well.
Correct.
How do you measure your performance as a fund? Like, how do you measure how successful, how well you're doing? Is there any way you measure this besides your bottom line?
Yeah, we measure it. A couple of things. It used to purely be just bottom line. You give $100 on January 1s, $150 on December 31st. Okay, we've had a 50% year. That used to be as simple as that. But as we've developed the business and as our investor has become more experienced, more sophisticated, there's been other metrics which we've had to incorporate into the business as a way of testing ourselves, and volatility, number of negative months, obviously comparative returns to a couple of benchmarks have all come into it. So volatility is the big one. We've tried to, because it's a new asset class, because it's an asset class which may or may not be deemed an asset class by many investors, and rightly or wrongly it might be perceived as being slightly more risky than others, we've tried to really take out the volatility of our returns. So as a result of that, that's one of the key metrics by which we now gauge our own performance is typically number of negative months. So that's probably the more, because obviously if the less negative months you have, you're going to end up getting a good return anyway. So that's been one of the big things we've been focusing on.
Okay. How do you measure the volatility of your returns? Is there any method to that?
Well, there's the mathematical methods, if you like, in terms of just your standard deviations and number of negative months, average number of negative months, and things like that. And that tends to be quite rudimentary and basic in that sense. But certainly, when we talk drawdowns, we talk high water marks, things like that. We know where we've been, so we know that what our high points have been, and we know we don't want to drift too far below that. So it's a combination of all those. There's no one metric which drives it. It's effectively, we know how positive we've been. We know we don't want to get below a certain negative. So then we'll make sure that if we're tracking that way halfway through a month, we'll then revisit the algorithms, we'll revisit the trading strategies, and we're doing that all the time. So it's an ongoing moving target driven by number of negative months more than anything.
Now, this question here, I'm really keen to ask you. I'm not sure what you'll think of it, but we hear stories about races being fixed and sort of shady business in the sports betting field. Do you see anything like that? Is that something that still exists to this day?
I would say yes is the answer to that. The short answer to that would be yes.
Okay. And what sort of sports do these mostly happen in?
Well, look, I think a lot of it's great news. It's a great news story when someone talks about match fixing and things like that. But I suspect what you'll find is, and this is certainly our experience, is a lot of the match fixing, a lot of the spot fixing, some of the nefarious activities. If you're looking at tennis, it's at the very lower levels of tennis where guys are scratching around for a living. The top guys in the ATP and the Grand Slams, they tend to be. It will take a lot of money for them, I would have thought, to be persuaded to ruin a legacy. Similar to the football in Europe, I noticed Luis Suarez this morning has just signed a new contract with Barcelona, and for someone to buy him out, they have to pay $250 million or something ridiculous like that. So the incentives are not there at the high levels of sport. They are there at the low levels of sport. Now, for us, the low levels don't really matter because we can't bet on those because the volumes are not big enough for us to trade anyway. So we tend to confine ourselves to the higher upper echelons at the highest level of sport where prudence and the way it's managed and run is at its highest. So yes, for sure, there's always going to be someone trying to make a quid out of it, but it tends to be in the lower levels, suburban levels, through to the futures tours on the tennis tour, which doesn't affect our business.
Okay, yeah. So it's not something you've really got to worry about too much.
No, and the other thing you need to point out there is that, as mentioned earlier, 97% of our trades don't depend on the outcome of the match. So we're immune to that as well. So we're not sitting there in the 90th minute and the goalkeeper lets one go through the legs and we've lost. We've traded for 15 minutes in the first or second half. We've made our money. We're out. The actual result doesn't matter.
Okay, got it. Yeah. All right, Brendan, well, let's do one last question and then we'll close this out. What suggestions would you have for someone who is interested in sports betting and someone who's actually serious about it, not just interested in having a punt? Anything you'd like to pass on to them? Any final words?
Yeah, well, look, as much as we bet on sport, we don't really bet on sport, if you understand that. Sport just happens to be, the market is the market, and sport just happens to be the vehicle by which we that's the vehicle we use, happens to be sport, but it's the same as any other market. In terms of sports betting, the things that the three things you really need if you want to have fun out of it or you want to do what we do out of it, the first one is to understand that there's always another race or there's always another event. So you don't need to be betting every sport. You don't need to be betting every event. You want to bet on something you actually know and understand, because this is one of the reasons why I got out of the financial markets per se was because if I'm buying a BHP share, that means someone's selling a BHP share. And if someone's selling it, they're probably going to know more than me. So I should be asking myself, why am I buying something someone smarter than me selling? So you want to be making sure that you bet or trade a sport you understand. You want to make sure that you're not being forced or you're not pressurizing yourself to have a bet, because there's always another event. And the other thing is, if you want to make money out of it, you probably got to do it in a very boring fashion. And a typical example for us is our maximum trade is generally it's up to 3% of funds under management, but it's typically only 1 or 1.5%. So we're not having typically if you've got $100, we're not having $50 on an event. We'd be having $2 or $3 on an event. So the money management side of it is very important, because you've always got another event coming up. You want to make sure you've got money to bet on that event if that event fits your criteria. So yeah, we approach it in a very boring fashion. So it's probably not going to inspire anyone to want to get involved.
No, I think that's what you got to do to make money over the long haul anyway.
Well, slow and steady. And that's how we people, and this is one of the things that when we speak to people who are interested, they tell us how they've hit these hot streaks, et cetera, and these tend to be Americans looking for jobs or people who specialize in American sports. And typically what we look at, we don't look to hit the home run, we look to get the first base, and we try and get the first base all the time. And if you do that, you've end up waking up at the end of the month and you've had a good month. The home run is nice, but the home run is also hard to find.
Yeah, and just to clarify, you mentioned in your answer there that you often risk 2 to 3% of your capital, your assets under management on a trade. But you also mentioned earlier in the interview that you often only lose 20 to 30% of that 2 or 3%. Is that correct?
Correct. That's right, yes. Not 20 to 30% of the whole fund.
No, that would be scary.
That would be scary, yeah.
All right, Brendan, well, let's leave it at that. It's been really good speaking. Thanks a million for coming on. Where can listeners go to find out more about you?
Well, Prioma, www.prioma.com. That's PRIOM, H for Harry, A for Australia.com. That's our website. That has all the information about both our Australian fund as well as our international fund. So if people are interested from an investment perspective, you can drop us a line. If people are interested from a work perspective, we're always recruiting. It's one of the things we try and do is recruit good people. So we're always interested in hearing from good people.
Excellent. And are you on Twitter also, Brendan?
Yes, we are at Prioma.
Okay.
And Skype, and we're everywhere. We're ubiquitous.
Excellent. Well, of course, as per usual, include all those links in the show notes at chatwithtraders.com. Brendan, again, thank you very much for coming on. I appreciate it.
Aaron, pleasure. Thank you.
You've reached the end of this episode of Chat with Traders. But rest assured, there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes. And we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
What would your trading look like if capital wasn't the constraint? That's the reality for most traders. It's not skill holding them back, it's size. Trade the Pool changes that. Step into the U.S. equity markets with up to $200,000 in buying power without committing your own capital. Full access to stocks and ETFs, long or short, executed with the precision and freedom serious traders expect. Your performance is measured by one standard: disciplined risk management and consistent execution. Meet that standard and you operate at scale. No subscriptions, no ongoing obligations, just a clear path forward. For those ready to trade beyond limitations, this is the next level.
You're in your apartment alone. Then you hear something. You think, was it just the storm? You realize you're not alone. Your living room is not safe with Unhinged, the new immersive game experience brought to you by Netflix. To make it out alive, you must answer the phone. The question is, when your phone rings, will you answer? Tap the banner to play Unhinged now, only on Netflix.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
So here we are, team, for the first episode of 2017. I do hope there are big things in store for you this year, so let's go. My guest, who you're about to hear from, is Tony Duff. Long story short, Tony was a hedge fund trader on Wall Street who led a truly excessive lifestyle. In 2013, he released a book about his experiences titled The Buy Side, and currently, Tony is a consultant on the Showtime TV series Billions. On this episode, we cover everything from what it was like to trade more than $1 billion at Galleon Group, which was the hedge fund run by Raj Rajaratnam, currently serving an 11-year prison sentence for partaking in one of the largest insider trading cases in US history. Following on from this, we discussed Tony's relationships with the sell side and the extreme measures they'd take to win his business, which then led us into their shenanigans, which took place after hours, the cocktail of drugs, alcohol, sex, money, and power. We finish up with Tony's fall from the top, some of the greatest realizations he's come to, and the life he leads today. Please enjoy this episode, guys. Here it is, my guest, Tony Duff. I noticed that you've had some involvement with the TV show Billions. Do you want to tell us a little bit about that? I think you've just wrapped up season 2. Is that right?
It is correct. And thank you for having me. So I wrote a book called The Buy Side, which published in 2013. And what happened was it was optioned by Sony. And they put a team together. And so going into 2014, there were a number of competing projects. And apparently there was this show over at Showtime that was, about to be bought. And so then they announced it, and Sony kind of, dragged their feet a little bit and got lukewarm because they were nervous that there was already a Wall Street project out there. And so my book went away from the Hollywood side. And I don't know, maybe 6 months later, I got a phone call from the 2 executive producers, and they said, hey, we'd love for you to read the pilot, give us your thoughts or whatever. We're going to be shooting in a couple of weeks. Are you up for it? And I said, yeah, definitely. And so I read it twice in one weekend, went in there and basically just, gave them my opinions. And, it might have been, a hedge fund guy would have never said this, or this is how this might go down. And that's all I did. And, after we had a meeting, they said, we would love to hire you as a consultant on the show. And so for the last 2 seasons, basically what I do is they'll send me drafts of the episodes. I read them, give notes, send it back. And then when we're shooting, I go to set, 2 to 3 days for each episode whenever we're doing Wall Street or hedge fund stuff. And I sit there and, whether it's talking to Damian Lewis about what something actually means, or, any of the other actors or the director or whatever. And I'm there basically to try to make it as authentic as possible.
That's very cool. I mean, that must be like your ideal job right now. You lived this crazy life in your 20s and 30s on Wall Street. You left Wall Street, said you didn't want to go back there, kind of put the nail in your own coffin to a certain extent in terms of a Wall Street career. And you wanted to get into writing and that sort of thing. So here you are working on the set of Billions. That's very cool.
Yeah, I'm very grateful, and it's an amazing opportunity, because I'm working with people at the highest level. Paul Giamatti, Damian Lewis, the two showrunners, Brian Koppelman and David Levine, Showtime. So it's an amazing opportunity and experience, and just even going back to my Wall Street days. How there's value in everything you do, right? So it's not always about the paycheck. So in terms of an opportunity or a job, working on this show it's a home run for me because my expertise is I live the life, and I also get to partake in a very creative venture. So it's a phenomenal job for me.
Yeah, that's excellent. I'm pleased it's worked out for you.
Have you seen the show?
I'm about halfway through the first season.
Okay.
So I'm slowly working my way through it, and I'm loving it. It's really cool. It's really cool.
Thank you. Yeah. We just wrapped season 2, and that'll be out in February.
Excellent, man. I'm looking forward to it. Now, as I kind of hinted just before, you have one hell of a story of spectacular excess, as you describe it. But so we can get a grasp on where you've come from, what was your upbringing like? Were you born into money, or did you have somewhat humble beginnings?
All right. So I grew up in a small town in Maine in a house heated by a wood stove. I had 3 older sisters. Very, very, very naive. If you can imagine how backwards Maine was, in the 80s, this is pre-internet, pre-cell phone, it was pretty simple way of life. And I graduated high school, ended up going to Ohio University. And I was a journalism major, B student. I had 970 SATs. And so when I left for New York City in January of 1994, I had probably $1,400 in the bank. I was driving a giant U-Haul with a lobster on it that said "America moves from Maine." I had LL Bean boots and J. Crew jacket and a baseball hat, and I was like, all right, let's do this. And I had no idea what I was getting myself into. And when I initially got to New York, I still wasn't even remotely interested or even aware of Wall Street. I thought I was going to get a job at, a magazine or newspaper or public relations. And, and this is no lie, it's no exaggeration. When I was driving the U-Haul down to New York City, my buddy and my roommate was telling me about a friend of his who got an interview at Goldman Sachs, and he was looking at me like I thought I would be impressed or something, and I literally thought that Goldman Sachs was a fancy department store. I had no clue. So yeah, not born into money. The one thing that I had over other people was an uncle who worked in the business, and when I initially called him, I was thinking I knew he had money, I knew he was successful, figured he must know some important people. So I called him up looking for him to help me get a job, not a job on Wall Street, but I wasn't able to articulate, what I wanted. And he hung up on me and said, I'll call you back in 10 minutes. And when he called me back, I had 10 interviews on Wall Street.
Wow. Okay. So he got you these interviews on Wall Street for obviously a position on Wall Street, but you really wanted to get into journalism. Did you just think that this Wall Street thing would be a temporary gig until you got yourself set up as a journalist?
No, I mean, look, I was 23, 24 years old. I really wasn't looking that far ahead. I knew from my bank account, I needed a job. You know what I mean? At my low point, and this is nothing against retail or the Gap or anything like that, but I was coming back from, another rejection, And I passed by the Gap, and I was like, oh my God. And I walked in there and I asked for an application, and I brought it home, and I was like hiding it because I didn't want my roommate seeing it. But like I was at the point where I just desperately needed a job. So I called my uncle up, and I was basically saying, well, hey, Uncle Tucker, I really kind of need a job. And he's like, I'll call you back in 10 minutes. So when he called me back, he said, all right, you got 10 interviews this week. And I said, for what? And he said, oh, just tell him you want to get into sales. I was like, oh, okay. And so I hung up the phone, and I was terrified. And my first interview was at Lehman Brothers, which I believe was 2 or 7 World Trade Center. I forget. And so I go down there in my Filene's basement, untailored suit. Basically, it was the only suit I owned at the time. And I go down there and I go up the elevator and I get off and I'm terrified because God forbid they ask me something remotely, close to something I should know. I would have no clue. And so I'm in the waiting room and I'm waiting. And then all of a sudden this dude comes out, probably late 30s, early 40s. And seems super caffeinated up, and he's talking a mile a minute, and he's just like super intense, and he grabs me and he's like, all right, let's go. And we go out into the trading floor, and it was right around the open. And so here I am at Lehman Brothers, January 94, and the opening bell rings, and it was just utter madness. It was very similar to walking out to a casino floor for the first time. And there was just something about the intensity and the utter grandness of it all where I didn't know what they were doing, but I said, I want in. And so that's when I really kind of caught the bug, was just seeing this trading floor of a few hundred men and women who all seemed like they were smart and successful and made a lot of money and just, intense. And that's when I kind of was just like, all right, whatever, this journalism thing, just, sign me up. And, it took many, many interviews because, like I said, a B student from Ohio University with a journalism degree, even in 94, is not that appealing. So a lot of the interviews were really just sort of favors to my uncle. And it wasn't until Morgan Stanley where I got an opportunity.
Yeah. So tell us about that. What were you doing at Morgan Stanley? What was your job there?
So it ended up being a fantastic job. It was called PCS at the time, Private Client Services. They've since changed the name to PWM, Private Wealth Management. But I was an assistant. I was a sales assistant, and my job was to work with a team of brokers or a broker. But the beauty of it was, we were selling, almost every product that Morgan Stanley offered. And, it was an opportunity for me to get my licenses and to learn about all the different products and the different departments. And, it ended up being a much, much longer haul than I initially expected. I thought I was going to work there for 6 to 12 months and be given some, great opportunity on the trading floor and be knighted, but that it didn't play out that way. But it ended up being a great job. And so I was just working with, I bounced around a little bit, but I ended up working with some of the top brokers on the floor, and I was trading for their clients, and I was of course doing all the administrative and paperwork bullshit, whatever. But I was getting to learn, all different sides of Wall Street, so it was a phenomenal opportunity.
Okay, so when you were working there at Morgan Stanley as a sales assistant, who were you actually selling to? Like, who were the clients that you were working for?
So I would be an assistant to a team that already had their client base, right? So we were dealing with middle markets, like some mid-sized institutions who were just straight equity and they were trading, but the bulk of our clients were high net individuals. And this isn't like like a Schwab account or Dean Witt or anything like that. This is people who are worth 10, 20, 50, 100 million, and could swing it around if they wanted to. So, it wasn't your usual retail account. It was someone who had real money and wanted the, exposure and diversification.
Okay. So how long did you stay around for at Morgan Stanley before you moved on?
I was there for 5 years, and I was literally at the point where I was ready to give up because I thought 5 years was way too long. At the time, I was 28, 29 years old, and I'm like, shit. I'm like, if I haven't made it by now, then I'm a loser, and I should pack my stuff and ship out. And it wasn't until like I had completely, almost given up that I ended up getting a call from the Galleon Group, which was at the time a up and coming hedge fund. And when I got the call, the only reason I got it was because I spent a number of years doing happy hour across the street, and there were some ex Morgan Stanley people there, and they needed a new assistant. And, again, super naive and not very aware of the world around me, but I hadn't been dealing with hedge funds. So when I was offered a job at a hedge fund, I was kind of like, whoa, like, what's a hedge fund? I mean, I knew, but I had no idea how big opportunity it was. And I was just like, all right, I'll go over, I'll check it out. And I quickly learned, being a client and being on the buy side for, even a $300 million hedge fund in 99 was a big deal. And so I ended up getting that opportunity just literally from being fun and doing happy hour for a number of years while I was at Morgan Stanley.
Okay. So what was that like working at Galleon Group? Like, what was your sort of first impressions when you walked through the doors there, like day one?
I mean, and this is no exaggeration, but I think my boss said to me once, and this is early on, he said, every day expect to be fired, and if you're not, it was a good day. And yeah, and just like you, I kind of chuckled, and my boss did not. And I didn't realize how serious he was. And it started every single morning in the shower. I'd be getting ready for work, and I would start to panic and say, oh my God, did I book this wrong? Did I send that trade to the wrong prime broker? Did I forget to do anything? Because, and I get it, but a simple little mistake or just me not crossing a T or dotting an I at a hedge fund like that could be $1 million error. And so, I just, up until that point, I had not been operating at such a high intense level where, if you're not good, you're out the door. And so it was a whole new, kind of learning curve. And I was right back to being low man on the totem pole. And it was just like, it was insane because, here we are, it's the 90s and it's the Wild West, insider trading was completely the norm. It was like, and this wasn't me early on because I was still just like assisting on the desk, but you were calling people up and saying, hey, I need to know what they're going to report tomorrow. And I need to know if this acquisition's going through and I need to know when, and, are you upgrading this tomorrow? Because I need to know now. And that was just common. And the numbers were just, head spinning because the first year, we were up triple digits. And so I didn't know any difference. And, I'm saying to myself, I'm like, oh, well, I got 15 grand in my account here. And, if we're up 100% for the next 15, and I'm doing the numbers like on a calculator as if like that was a possibility. So, I would learn quickly that that wasn't a normal market and those weren't normal returns, but it was insanity on a daily basis But I loved it and I thrived on it. So,
yeah. And did you see, like, it sounds as though it was very cutthroat. Did you see many people come and go, like getting fired for making errors? Was that a common occurrence?
It was, and I would say it happened much more often on the analyst side than it did. The trading side was a little tighter knit, and not that we were in a bubble, because our own bosses were pretty vicious. But and I say this jokingly, but there's a lot of truth to it. I would see a new analyst show up, and they'd go into one of the offices that wasn't occupied, and in my mind I'd be like, well, I'm not gonna take the time to get to know them. I'm gonna wait 2 weeks, because so often someone would come in and either they didn't like the culture or they could not keep up, and they would be gone shortly. So if they were in their office for more than 2 weeks, then I felt like it was safe to introduce myself.
That's funny. I had a job, my first job out of school was much the same as well. The staff turnover was through the roof, and we kind of had the same attitude there as well.
Right. It was nuts.
Yeah, so you mentioned your boss there. Who was your boss?
For a small place, it was like I had, anybody who was a partner was technically my boss. But the guy who ran the trading desk, his name was Gary Rosenbach. And he was, I guess you would call him, he was number 2 behind Raj Rajaratnam. But I worked directly with a guy named David Slane, who he was called by Bloomberg a dream informant, and he helped take down something like 38 people in the whole insider trading web. That wasn't until, much later. But number 1 was Raj Rajaratnam. He's currently serving time. I think it was the largest sentencing in the history of Wall Street for insider trading. Number 2 was a guy named Gary Rosenbach, who mysteriously left the business right before Galleon got pinched and went down, and he's in Colorado, maybe. I don't know what he's doing. And David Slane is trading his own money. He was number 3. He cooperated and avoided doing prison time, but in some respects, I would say he's still serving, because there's some reputational damage that happens, if you end up cooperating. And number 4 was a guy named Christian Sood, who was the healthcare PM, and I ended up leaving Galleon with him to start a hedge fund called Argus, and he's currently, I believe, running money under some multi-billion-dollar hedge fund, but I haven't kept tabs on him.
Okay, so I want to ask you about Raj. I'm not going to try to pronounce his last name. Yeah, that's the one. I want to ask you about him a little bit, because he, as you said, he's serving 11 years in prison for insider trading. What was it like working for him? Like, he was your big boss. What was he like as a trader?
Well, I mean, I literally sat, there was a glass wall between me and Raj, and his office was right behind the trading desk. And he actually was very kind of happy-go-lucky. In my book, I described it almost as every time he came into the office, it was like he was a homecoming queen in a float, and just kind of like doing that little half-cup hand wave as he would walk into the office, and someone would be dropping rose petals in front of him. I never really felt the wrath or the venom from Raj, which he was 100% capable of. But he used to, he was the kind of guy who would prefer to, stab you in the back and then smile, versus, kind of making you feel the pain and enjoying you, just wither away. There's one thing I talk about in the book, and I called it the Raj cockfight model. And I suspect that many other hedge fund guys, or people who are successful in business, I mean, Donald Trump could be accused of this, but what he would do is he would find two people who are essentially peers, equal skill, equal level. Maybe they have the same title. And what he would do is he would do it himself, but he would create this rivalry between two like individuals in the firm. And then he would like to sit back and he would watch them scratch each other's eyes out until, one was a bloody mess on the floor and got swept out and the other one survived. But what it would do is it would create such competition and such grit between the two that he would maximize what he would get out of both employees until one was done.
Sounds very intense.
Yeah, I mean, they tried to do that with me and one of the other traders, but she and I, she was the one who got me the job, and we just maintained communication after work, in private, on the phone, and would share with each other what they were saying about the other one, and so I was able to avoid it, but I saw it happen over and over and over again, and it would get vicious, but Raj would end up making a lot of money.
This episode is brought to you by Accenture. When your advertising operations fall out of sync, everything else follows. Spotify and Accenture are working together to reinvent the rhythm of ad sales, using automation, analytics, and smarter workflows to simplify campaign delivery and access better data across the business. The result? Less time spent on operations, more time connecting brands with the moments and fandoms that matter most. Learn more at accenture.com/Spotify.
Ever watch a stock rip and think, I could have nailed that if I had real capital? The truth is, many capable traders never reach their potential, not due to lack of skill, but lack of scale. Trade the Pool was built to solve exactly that. A firm designed for serious individuals who want access to the U.S. equity markets with meaningful buying power, up to $200,000 without committing their own capital. Get access to virtually every stock and ETF. Go long or short freely with the flexibility professional traders expect. You're evaluated on one thing: your ability to manage risk and execute with consistency. Meet the standard, and you trade at scale. No subscriptions, no ongoing commitments. Whether you're still refining your strategy, a trader with experience who hasn't yet broken through, or a seasoned professional simply looking for more capital, Trade the Pool is built to meet you where you are and take you that next step further. The markets have evolved, access has evolved. Now, so has the way traders operate within them. Trade the Pool.
So when did Raj eventually get caught out for insider trading?
Ironically, it was on the day of my last drink and drug, but he got arrested on October 16th, 2009, and then was sentenced in, it was right around Occupy Wall Street, October of 11, and then I think he went away in December of 12, something like that.
Okay, and what led to him being caught out?
Well, I mean, I have my own theory. If you look at, kind of all of the documents, supposedly the Galleon case was opened in 2006 or 2007, so that doesn't quite line up with my theory, but I believe that it's probably a combination. With everything that happened with the financial collapse, and then no one going to prison and no one, really kind of getting any consequences. I felt like in 2008, 2009, they said, well, someone's got to go down, and the next best headline is insider trading and hedge fund guys. Meanwhile, hedge funds had nothing to do with the bailout, right? Or, or CDOs, or what I mean, mortgage-backed. Hedge funds didn't create them, and hedge funds didn't get bailed out. But so I believe it was part of a desire to get the headlines against Wall Street. So the more scandals and insider trading rings that they could bring down would appease the public a little bit more and make Main Street feel a little bit more comfortable that Wall Street was being policed. So I think it was kind of a combination of really bad timing after the financial collapse, and it was the easiest fruit to pick off.
Sure. And you yourself have said in the past that you operated in a grey area yourself. Were you ever investigated or get caught up in this mess?
I don't know if I was investigated. A couple of times I had to sign off on letters from the SEC, like it would say, you bought 250,000 shares of, HMA 30 minutes before Citigroup upgraded the entire hospital sector and upgraded the stock. And, by signing this, you're, admitting that you had no prior knowledge, blah, 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 blah. So that was the extent of the stuff that I ever got caught up in. But it's impossible to know, whose names were being floated around. And with all of the phones that were being tapped, if you were on one of those phone calls, well, guess what? They're writing your name down and maybe they're looking at you. So I have no idea how deep it went. Whether this is fortunate or unfortunate, I don't know. But when I left Galleon, I was still operating in a gray area, but drugs and alcohol ended up consuming my life much more than trying to figure out what Apple's earnings are going to be next week. I very easily could have got caught up more in it more than I did, but I was all about the party, and that's the path I chose.
Absolutely, and we're going to get right into that very shortly. Before we do, though, I just want to have a couple questions about you as a trader. So you started at Galleon Group as another assistant. How did you sort of come to be a trader and a portfolio manager there, and how did you perform as a trader?
It was kind of like they would give you a shot, and if you were good, they would just keep on letting you go. So I did start as an assistant, but it quickly turned into, I was the number 2 guy on the healthcare portfolio, and we were trading, it was over $1 billion, and so I had a lot of responsibility, and so it was a great gig. And about a year and a half into my time at Galleon, the guy to my right, the head trader for the healthcare portfolio, said, "Hey, I'm leaving. I'm starting my own hedge fund. You can come with me if you want, but why don't you stay here and see how they treat you?" And so in 18 months, I went from assistant to the head trader on $1 billion fund. And it was sink or swim. And, I ended up being able to produce. And, Galleon at the time and eventually on to Argus, we ran kind of a hybrid. Very often you'll hear about like an execution trader or proprietary trader. But we would do both. Obviously I was executing everything for our PMs and our analysts, but if I saw an opportunity to make some money, I would do it. And back then it was really about information, and it was much easier to to get ahead, and I was good at gathering information. I was good at making new relationships, and one of the things I learned there, that I took with me, I was able to kind of take emotion out of it, and so I used to keep a little notebook, right, where whether I was talking to an analyst or somebody over the phone, or I came to my own conclusion or came with my own thesis, when I was able to do that void of any emotion, I would write it down on, in a notebook. And, like, let's say, I'm just giving a random example, but, let's say I was talking to one of my analysts and he was like, oh man, if Apple was ever trading at, 200, I would back up the truck and, because of A, B, and C, this is why I would buy it. And then, sure enough, 2, 3, 4 months later, for whatever reason, Apple would be trading at that level. And I would go into his office and I would say, hey, has anything changed fundamentally? And they're like, no, but, the market's getting killed and the market's off and we can't buy it now. And I'd be like, fuck that. I'm like, we're buying it. And what I found was that most people that I was working with couldn't remove emotion. And so I would try to gather information that had no emotion attached to it. And if I could sign off and figure out that, all right, the story hasn't changed and everything is still the same, they just don't like the current market environment, like that would be a huge buy for me. And so, I very early on, I learned that if you can take emotion out, you become a much, much better trader.
So what were some of your greatest trades? Like you said, during that time when you were at Galleon, your biggest edge was the information that you could get hold of. And this wasn't just information that was coming from your analysts internally. What was some of the best information that you got externally that led to your greatest trades?
My first big trade, I got a phone call from at the time it was a small boutique called Leering Swan, and a headline hit the tape, and my sales trader called me and said, oh, generic, they're going to discontinue generic Prozac. And so I was like, okay, whatever, shearing plow, generic Prozac, not a big deal. And I kind of dismissed it. And then I got a call again, and my sales trader was like, no, they're like, not, the trade isn't shearing plow, the trade is Sepulchre. And so then I started kind of doing a little bit of work. And so it was a derivative play of what the news was. But at the time, and I'm making the number up because I don't remember, but, Sepulchre's earnings 2 or 3 years out was like 80% based off of this generic Prozac. And the stock at the time was trading, I forget, but it was probably like $120. It was probably trading like, I don't know, 15 or 16 times 2002 or 2003 earnings. And, not that the stock was zero, but it was going to get dramatically cut. And so I just went out there and I just started buying puts. And at the time it was scary because it was a bull market. And, I was just buying 500 puts at a clip, and the stock went from, I don't know, like 120 to 90. And I was still buying puts. And so at the time, I think I had a few 100,000 or, equivalent to a few 100,000 shares short of Sepulchre. And, it was $5 below my cost basis. And, so I made a quick $1 million in like 20 minutes. And that was kind of my first big trade where I was like, oh, maybe I can do this, and then, a few years later I was at Argus and it started off as a simple conversation, but my med tech analyst told me about this new trend that was happening and said, hey, he goes, hospitals are no longer hiring nurses. They're using these staffing companies. And I was like, okay. And he's like, yeah, he goes, he's like, it's the numbers just, keep coming in. He's like, it's a big trend. And so I started to look into it and I started to ask questions, and these staffing companies they were ridiculous to trade. Like, I'm talking like 80,000 shares a day, but I was like, screw it. I'm like, let's go for it. And I bought a slew of names, and, this took much longer. It was more of like a, 3 to 6 week trade. And I just wanted to get my positions in before they reported. And, this is another, and I don't even know if it's a trick or the trade or whatever. But once I got my positions in, I mean, this isn't Einstein, but once I got my positions in and I got the solid research and evidence to back it up from my analysts, I started to share the story with guys that I liked. I didn't cast a wide net because I wanted other people to make money, right? If you tell 50 guys the same story, guess what? Nobody makes money. They all, none of them owe you a favor. So, I started to share with a couple of guys saying, hey, look, I'm long these names. This is what's going to happen when they report. And, you might want to get in. And so the stock started to move up before they reported. Once a couple of my friends were in the trade, then I shared it with somebody on the sell side, and they were like, holy shit, this is great. And as they were reporting, they were upgrading, the entire sector and all of the stocks. And it was just kind of like this perfect storm. So, I identified the trade. I did the work, got the positions in. Then I shared it with a couple of people that I wanted to look good. And then I shared it with somebody on the sell side. And then it hit. And so it ended up being a home run all the way around because I made a ton of money. I had 2 or 3 other buy-siders who now wanted to help me because they made a shitload of money on the trade. I got a guy on the sell side who thinks I made him look like a hero because he was ahead of the street on the call. And the whole time I'm selling my stock on that day. So it was a big trade.
Yeah. Wow.
Sorry for rambling.
No, that was awesome. I appreciate it. Now, for us outside of the hedge fund world, do you just want to explain the mechanics of buy side and sell side and sort of how they operate together?
Sure. So in the simplest terms, the buy side is the client. So, if you're sitting there in your underwear trading your, E-Trade account, you're considered the buy side. It has nothing to do with buying. It just means you are a client of the sell side. So the sell side is any broker who is in the business of customer facilitation, and they execute your orders. So, if you're on the buy side, you're buying, you're selling, you're trading, you're doing whatever you want to do. And the people on the sell side, whether it's Goldman Sachs or Morgan Stanley or, some tier 4 broker, they are facilitating your orders. They're providing research. They're sometimes housing your portfolio. And the idea is, the sell side helps the buy side, and the buy side pays the sell side commissions.
Okay. So in your position as a hedge fund manager, the sell side were very keen to get your business, correct?
Very.
Okay. So how did they try and get your business? Like, talk to us a little bit about the social aspect, the wining and dining that goes on.
Right. Some of that, I mean, and I'll preface it by saying some of this has gone away, but a lot of it is still very valid and present. So in, let's say 2003, I'm 33 years old, and I'm the head trader of a $1.4 billion portfolio, and I am trading in commissions about $50 to $60 million a year. So every single person on the sell side wants a piece of that $50 to $60 million. And of course, you pay your Goldman Sachs and Morgan Stanley, you pay those guys, $2-3 million a year. But, $50-60 million goes a long way. And so basically people would be wanting to either give me great information, proprietary information, trading ideas, providing research, and just making my job as easy as possible. Because when I had, 1 million shares of Johnny John to buy, they wanted me to call them. And then on the other side of that, they had unlimited expense accounts. So I could legitimately go out to dinner every single night of my life for 50 years, and it never would have ended. Any restaurant, any bar, any sporting event. I've been flown to Super Bowls on private jets. I've been taken to Sundance Film Festival. I've been offered surf camp in Costa Rica. I've been flown to Cancun. I mean, you name it, it was offered to me. And the idea was, and there's so much truth to this, you take me to dinner, we have a good time, whether that leads into, us scoring drugs or going to a strip club or getting hookers, or maybe it's just a good old fashioned, get fucked up night at the bar. Well, during that time, you're bonding, and hopefully a friendship or something is developing and cultivating, and they're hoping that, if they spend 10 grand on you, a couple nights a year, that's worth $1 million in commissions. And so, obviously you do the math. That's 10 grand well spent, right? A lot of that has changed in terms of just the ability for a hedge fund guy or a buy side guy to pay whoever they want. So a lot of funds do now have what's called a list, and so certain brokers or all brokers need to be on the research list. So back then I could pay a friend of mine who had his own broker dealer on the floor and maybe was trading out of his apartment. I could get away with doing $200,000 a year with him. These days, most places have to get every broker approved. But, they kind of came down on expense accounts, and the way they worked around it these days is, if let's say you're at a tier 4, tier 5 broker, and, you want to do a lot of business with an account, you'll still take them out and you'll still spend all of that money. You just don't run it through your credit card. And so you take the hit personally. You'll spend 20 grand on an account over the year. But if they're paying you, $400,000 in commissions, it's a huge win. So, very often, whether you're at a bulge bracket firm or at a lower tier firm, they'll do a lot of this entertaining off the books. So there's no paper trail, but the commissions are still there.
Right. Okay. So it gets a bit shady.
Yeah.
So you said that if you wanted to, you could go out for dinner every single night of your life for 50 years. How often were you going out and socializing with the sell side?
When I was single, all the time. But I mean, it got to the point where I was just like, if I had one more steak dinner or if I had one more martini, I was gonna explode. And so, I mean, it got to the point where I would just say, people would call me up and they say, Turney, they're like, I have to take you out, or I'm going to get in trouble with my boss or whatever. And I said, dude, take your girlfriend out for a nice dinner and put my name on the receipt. I'm like, I don't want to go out. And they'd be like, no, I need. And I'd be like, all right, I'll trade 200,000 shares with you right now if you don't ask me to go out with you again. And they'd be like, okay. And then I'd be like, all right, buy 200 SPYs. It was truly unlimited. I would say from, obviously, September 11th, didn't change the game, but it shifted people's focus for a short period. But from 98 to 2008, it was pretty unlimited.
So tell us a little bit about how this led to a lot of partying, a drug habit, alcoholism. Is that a word? Yeah, I think so.
Yeah.
How did that kind of come about? Obviously, it was a flow-on effect from so much sort of partying and socializing. Tell us about how that got a little bit out of hand.
It's interesting because one of my best skill sets, or one of the things that allowed me to be successful, was my ability to socialize, to be out at night. When the office lights went out and the city lights came on, like that's when I really shined. And And that's what helped me get to the top. And it also ended up being kind of my biggest detriment also. I was always, party guy. I was always, fun and tried to be the life of the party. And, I never ever thought I would do cocaine. And first time it was offered to me, I wasn't even sure what to do with it. And I went to the bathroom and I was like, do I do the whole thing? Or, oh my God, are they going to know I didn't do any? And I was freaking out, and I went back out there and handed it back off, and I didn't touch it. But 6 months later, I'd gotten a big bonus, so my bank account had changed. I got a new job title. I was running around with a faster group, and it didn't seem so menacing anymore. And it felt like it was part of the culture. And so I tried it, and the first time I did it, I was like, oh my God, like, this is the greatest thing I have ever done in my entire life. And on my way from the bar back to the rooftop, I said, okay, this is probably going to be a problem at some point because I feel so good. But I can't worry about that now. And, at first it was a slow progression. It was, I was still drinking 4 or 5 times a week, but, I was, cocaine only showed up every once in a while. And then it kind of turned into once a month. And then shortly thereafter, it was once a week. And then soon as I got the direct phone number of a dealer, that's kind of when the wheels started to come off. And, it would take another 2 years or so for me to completely blow myself up. But I kind of look at it as like this giant cocktail. It was drugs, it was sex, it was money, it was alcohol, it was power. And it was kind of all mixed into one. And, I've been very careful to say, like, Wall Street or my job, like, none of that made me an addict or an alcoholic. I believe I was kind of born this way, but all of that fed into this undying need to be adored. And, I kind of suffer from the disease of more, and bigger is better. And once I got a taste of cocaine, it was like I had found this thing that I'd been looking for my entire life. And, it eventually got out of hand, and I could not stop.
So if I heard you right or understood you correctly, it took you about 2 years from the first time you tried cocaine until you were pretty much using it each and every day. Is that right?
I would say about 2 years before I was using it weekly. And then it was somewhere between like year 3 and 4 where it kind of became daily.
Right. And do you have any idea how much you were spending on any given week on drugs, alcohol, and hookers?
Well, so the cocaine I would usually make people from the South Side give to me. So, like some broker I would call up and say, hey, dude, meet me at 415. And that was code for, because 420 is synonymous with weed, I decided that 415 meant cocaine. So I would be like, meet me at 415 on the corner of 54th and Park. And so the coke, it wasn't always free, but because I also, used the dealer, but the coke was probably $200 to $300 a week, only because I was getting a lot of free coke. But, the hookers, were before I started dating my girlfriend and she got pregnant. The hookers were, probably started happening, I don't know, maybe once a week. So that could run anywhere from $400 to $2,000, right? But it was also the things I was doing, on cocaine or drunk or being out or, hookers involved or whatever. Like if I was messed up and I decided that we needed to get a helicopter and fly to Atlantic City, like we would do it. So it was the grandiosity of being on cocaine where I probably spent the most money.
That's pretty crazy.
Yeah.
Man. So what was your most memorable, and I should probably use that word lightly, but what was your most memorable night?
Oh, God. I mean, like, good night or bad night? I mean,
let's hear both.
I don't, I mean, it's a shame because, like, good night, I'll give the nod, I'll say, even though it wasn't, but it was a great night initially. My 34th birthday party, so October 2003, and I talk a little bit about this in the book, but I hired a band called Naughty by Nature, a couple of other bands, and they performed, and it was just this insane night of 500 of my closest friends, drugs all over the place, out in the open, and just a night that never ended. And that was before I'd kind of gone into the black hole of addiction. So I was still having fun. That was a pretty big night. I would say, one of the most memorable bad nights was obviously not a night at all. It was, more like 5 a.m, but I'd been up for 3 days straight. And I'd called in sick so many times that if I called in sick again, I'd be fired. But if I showed up for work in the state that I was in, I would be fired. And this was October of 2006. So I ended up getting the brilliant idea that if I had been mugged, that they wouldn't expect me to work. So I proceeded to slam my body into a puddle on the pavement numerous times until I'm bleeding and bruised and my suit is ripped and I'm soaking wet. And I limped into the hedge fund, and I could barely speak. And I just said, I was mugged. And I turned around and walked out. And, needless to say, I was in my first rehab, 48 hours later.
Did anyone see you throwing yourself into that puddle?
I don't think so, but it's possible.
Okay. That would have been awkward.
Yeah.
Just to put things into perspective here, how much money were you making on an annual basis by the time you reached your 34th birthday?
My biggest year was 1.9. And I had a couple of 7-figure years. But from when I started at Galleon, which was, let's say, middle of 99, until 2007, or 2008, I made $10 million, I would say, over like a 7-year period.
How much of that would you say was your salary, and how much of that was bonuses?
I mean, for the most part, it was bonus. But when I went over to Argus, and then I went to rehab and came back and I went to JL Berkowitz, which is Jim Cramer's old fund, I negotiated a percentage of the profits. So as long as we didn't even have to make money. Like one year, when we were over $1 billion, the management fee alone paid me, I don't know, $600,000-$700,000 just from my percentage. So I call it a bonus, but I negotiated, a minimum percentage of the profits. And one interesting thing that we were doing over at Argus, which I thought was good. So I had a fixed percent of something like, I think 6% or something, by the time I left, but we would have what was known as a jump ball. And so there was always 15%, maybe 10, 15% of the bonus pool that was up for grabs. But, sometimes that bonus pool was $5 million. And so anyone in the firm could get, part of that. And so, that would make people, work harder and try to get more than what their percentage was.
Sure. Now, leading this type of lifestyle, did this ever cloud your judgment at work? Like, you've Like you said there, you're controlling large amounts of money, like billions of dollars. How were you able to perform at work?
Without a doubt, it clouded my day. I mean, I went from kind of being the golden boy to, almost having to go to rehab whether I wanted to or not. But I would start making mistakes and, just careless stuff or being hungover. I don't care how smart you are. If you're hungover, you're less likely to pay attention and you're not going to pick up as many lights, or you're not going to send out as many emails, or, you're not going to be capable, and you're not going to be operating at 100%. And so, near the end, like I was telling you before about 2005 and 2006, I was averaging, playing, I would call it, playing through, meaning that I never slept. And I was doing that at least once a week for a good 2 years there, so showing up to work at 6:30 or 7 in the morning on zero sleep, still coming down from cocaine. I don't care who you are, it's going to affect your work.
So why were you not sleeping? Is it because you were just partying too much? Had you taken too many drugs and actually couldn't sleep, or?
Couldn't sleep. Coke. I mean, if I just drank or smoked weed, like I could fall asleep, no problem. But, you're doing cocaine. There was two things would happen. A, I couldn't sleep, and B, I had to do more. I couldn't stop. And so, it was just this vicious cycle. I was down in Miami once, and I was hanging out with this, kingpin drug dealer from Miami, and he was like, "Oh, you from New York?" And I'm like, "Yeah." He goes, "New York, the city you can't sleep." Or no, he's like, "New York, the city that never sleeps." And I was like, yeah. And he goes, "Miami." He goes, "We're the city that can't sleep." And I was like, "Yeah, I get it."
So I'm just curious, when you're on cocaine, how long does the buzz or the high actually last for?
Initially, it was longer, but near the end, it was like your first line of the night would be fantastic, and you'd feel good for 15, 20 minutes, and then you would spend the next 12 hours chasing that high, and be completely miserable. So you do a line of cocaine, you feel fantastic for 15, 20 minutes, and then you keep snorting more and more and more and more because you're trying to get back to that original feeling, and you never quite do, and it's pretty miserable.
And were you taking more every 15 minutes or so?
Yeah, sometimes faster, sometimes, I mean, depending, sometimes you're trying to ration, like you're trying to make it through the night, it depends, but, more often than not, I would have a mound of cocaine and it would just be, probably every 15, 20 minutes I'm snorting.
That's full on. So when do you stop? Like you said, you just keep wanting to take more and more and more. When do you stop? Like literally when you run out, or when it's time to go to work?
Right. The first couple of years, I could actually come home, put the remaining Coke in my sock drawer. It would be hard to fall asleep, but I'd eventually fall asleep. And then there became a day where I was unable to stop until it was all gone. And, I'd put it in the sock drawer, and then I'd go lie in bed and stare at the ceiling and be like, I got to go to sleep. And then I'd just be like, screw it. And I'd get up and I'd go and be like, all right, let's have one more. And I'd just, tap out a nice little line and do it. And then I'd try to go back to bed, which was insane because I was never going to fall asleep. And there would be times where it'd be 4 a.m. and I'd be like, oh my God, I'm never going to be able to work tomorrow. And I would go to the toilet and I would flush the rest of the Coke in the toilet and it'd be gone. And then like an hour later, I'm like calling or texting my dealer. I'm like, I need you to come back. And I mean, it was not healthy.
At what point did you realize that something had to change? Like this was not sustainable?
I mean, like I said, the first time I did it, I kind of knew that there was an issue, but I always thought I'd be able to fix it. So it wasn't until, things were just kind of falling apart, because I had a couple of big years financially when I was still using almost every day. But, I started making mistakes at work and people were no longer, impressed with me. And, got to the point where, my girlfriend was not so sure she wanted me around anymore. And we had a daughter and, it was just kind of like I woke up one day and realized like, this is not who I am. And this is not, how I'm supposed to act. And I thought I could kind of fix it on my own, but, it would take a lot more pain and saga in order for me to eventually clean it up.
So how did you go about fixing up this mess? Like, I think you mentioned earlier that you had a couple stints in rehab. Can you tell us a little bit about that?
Yeah. So, I ended up going to rehab twice, which, was good for the time being, but I never really learned how to be honest with myself. And the thing that the mistake that I kept making was I truly believed it and I kept believing the lie, but I really thought it was going to be different the next time. So I'd blow myself up and I would be like, oh my God, I'm never doing that again. And oh my God, I'm such an asshole. And I'd be like, all right, I'm done. And then 12 hours later, I would say, okay, well, I'm gonna just do a little coke tonight and I'm gonna stop at midnight. And I really believed it when I would call the dealer, but it never happened.
So what's your life like today?
I am living in the middle of Long Island, so I'm 40 miles outside of the city, and I live 2 miles from my daughter. I see her every day, and I try to get some writing done every day, and all my life is very simple. I'm paying $1,300 a month for rent. I barely get by every month, but I manage to do it. And I'm just trying to stay sober. I'm trying to write, and I'm trying to be the best dad, friend, and son that I can be. And interestingly enough, I've never been happier.
You made a lot of money during your stint on Wall Street. I think you said you made about $10 million. Where is that today?
I wish I knew. So, let's say I made $10 million, just for sake. We'll say, I lost 3 of it just from 3 or 4 from taxes. I was the owner of a fast food or a casual dining concept called Fat Burger for the state of New Jersey. So I put $1 million in that. That ended up being a 0. I bought a house in 2007 at the height of the real estate bubble. I bought that for $2.1 million. Put another $500,000 into it. I ended up selling that for $1.2 million. So I ended up, taking a bath on that. In my early 30s, I was living in a 2,700 square foot apartment, paying $9,300 a month in rent. I lived like that for a couple of years. So it was a combination of some bad investments, a house, an apartment that I bought, and living like an asshole for many years. And the money just went.
Yeah. Sure. And you say that you're pretty much never been happier than you are right now. Why do you say that? I mean, because I presume that when you were living in this New York apartment and living life big, you must have thought that was happiness at the time. Were you ever content with where you were?
No. So that's one of the things. I was never content. When I was at Morgan Stanley making $22,000 a year, I would say to my friends at the bar, if I could just make $50,000 a year, then all of my problems would be solved. And when I made $2 million, literally I said out of my own mouth, if I could just make $3 million a year, all of my problems would be solved. So that was never going to end. And so there was a moment back, after I'd left the business where, I'd kind of gotten my life back together and I still wasn't happy. And so I ended up going to the computer and I searched what the pursuit of happiness meant back in 1776 when they wrote the Declaration of Independence. And what I learned was that happiness used to mean courage and integrity and honor. And it was about how you lived your life. And I was like, when I read that, I was like, what? Because I always thought happiness was pleasure and material things and stuff like that. And so on that day, I was like, you know what? I don't even want to be happy. I was like, screw it. And I kind of just said, I just want to live a good life. Like I want to be a good person. And once I made that shift, so I went from a guy who wanted to live the good life to a guy who wants to live a good life. That's when it all clicked for me. And that's when I became happy.
Yeah. So I think a lot of people listening to this right now, and maybe even myself a little bit, we understand exactly what you're saying, but are you only able to say that and actually believe it because you have experienced it, because you've had that life experience?
Yeah. I used to say, I would say any asshole who says money can't buy happiness never had any money. Like that was my frame of mind, and I truly believed it. And so it's so cliche and you probably hear it all the time. So it's a difficult concept to grasp unless you get it, because and I'm not pointing the finger at anyone, but like no one wants to look in the mirror and say, hey, I could be doing more, or if only I had these things, my life would be so much easier. Because you know what? It's true. Money will make your life easier in a lot of respects. So it's hard to look beyond that. But I wouldn't have been capable of doing it without experiencing it myself. And like another thing that I sometimes talk about when I give talks, I inherently believe that most people are good, right? Most people have good intentions, but if you ask people to look at, okay, where's the line of your intentions and where's the line of your actions? The closer those two lines are together, the more successful and the more, I guess, good, or, however you want to phrase it, the closer those lines are together, intentions and actions, the better results you're going to get, just whether it's as a business person or just as a human being. And so one thing I try to do is I always try to line up my intentions with my actions. And when I do that, I feel much better about myself and I'm happy and I'm in a good mood.
Yeah, I think that's a clever way of looking at it. And, this is quite a complex sort of subject or thing to try and get right in your head, because, in some ways not being content is a good thing, because it causes the competitive spirit to keep driving forward. But it can also be somewhat self-destructive in some ways as well, like you've experienced. So, I think it's really cool to get your thoughts on this. Tony, let's leave it at that. Thank you very much for coming on the podcast, man. I appreciate it.
Thank you.
Guys listening, if you want to pick up a copy of Tony's book or just take a closer look at it, it's called Buy Side, A Wall Street Trader's Tale of Spectacular Excess. You can find that at chatwithtraders.com/buyside. No dashes, all one word, of course. Tony, where else is the best place that listeners can go to find out a bit more about you?
You can buy the book on Amazon, but if you're looking for more, I have a website, which is turnyduff.com, TURNEYDUFF.com. I'm on Twitter, Turny Duff. I'm on Facebook, Turny Duff. So that's pretty much it.
Excellent. Very good, man. Well, I'll be sure to include all those links in the show notes at chatwithtraders.com, and for a direct link to Turney's book on Amazon, chatwithtraders.com/buy-side. Thank you, Turney.
Thank you, Aaron. Have a great day. Have a great holiday.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
What would your trading look like if capital wasn't the constraint? That's the reality for most traders. It's not skill holding them back, it's size. Trade the Pool changes that. Step into the U.S. equity markets with up to $200,000 in buying power without committing your own capital. Full access to stocks and ETFs, long or short, executed with the precision and freedom serious traders expect. Your performance is measured by one standard: disciplined risk management and consistent execution. Meet that standard and you operate at scale. No subscriptions, no ongoing obligations, just a clear path forward. For those ready to trade beyond limitations,
with only on net.
On this episode, I had an incredible chat with the great Anthony Saliba. Anthony is an options trader of 40 years. For his first 13 years in the field, he was a market maker on the CBOE floor, where he made about $8 to $9 million before 30 years old, and that was during the 80s. At which point, he was one of the traders featured in Jack Schwager's first Market Wizards book. Since then, Anthony's continued to scale up, making big moves, both through trading and various business ventures. We spoke for close to 2 hours about his experience on the floor, a trader education company that he operated, some of the non-cliche traits of great traders, longevity, and how he's grown wealth as a parallel entrepreneur, amongst lots of other things too. Now, on a side note, I'd like to let you know Anthony has a new book on the way, which will be released January 30th, 2017. The book is titled Managing Expectations, Driving Profitable Options Trading Outcomes Through Knowledge, Discipline, and Risk Management. You can find it now on Amazon by going to chatwithtraders.com/expectations. And Tony has actually offered to give away 5 signed copies too. To enter, simply go to chatwithtraders.com/Tony and follow the prompts. Please note this giveaway will close 24th of January 2017. Again, that link is chatwithtraders.com/Tony, Tony, to enter the giveaway. Hope you dig this episode. Anthony is a major boss. Enjoy, team.
After learning about you, I checked out your popularity with some of the people that I know that are trading. And you actually interviewed a friend of ours, Derek Wong, earlier.
Oh, you know Derek, right?
Yeah, yeah, he's a client and also fellow Chicagoan living in Beijing. So,
oh, that's very cool. I had a lot of fun talking with Derek. I sort of am trying to keep in touch with him a bit.
Brilliant guy.
Yeah, really awesome guy to have on the podcast as well. I mean, he's someone who has pretty much zero presence online. I just, the only way I found out about him is I have a Facebook group for Chat with Traders, and he just happens to be in the Facebook group. And so I kind of came across him that way, and we got talking, and I was like, I'd love to have you come on the podcast. So otherwise I probably would have never heard of him. But yeah, very smart guy. So how do you know him? From Chicago?
Well, no. About a year ago, a mutual friend introduced us. He needed some help. Being a futures trader, he needed help in options trading. So our company has been working with his company as they get ready to launch a few more options products in the Chinese market. And he led the charge for the first 6 months. We did some programs for him and his desk, and then he kind of handed it off to some other individuals that are looking to grow their sales trading business and their client business. So it's been a good relationship, and Derek was Johnny on the spot for everything. Really took a lot of care in the relationship, and he was on vacation last week, but I would say we talk to him every week. Keep abreast of what's going on. So
right, yeah, that actually makes a lot of sense, because he was talking about how options are something that's coming into China very soon, or hopefully soon. So yeah, that makes sense that you guys would connect over that.
And that's a good reason. I mean, that's one of the reasons why I wrote this book. I mean, there's a lot of options books. Heck, I wrote my first options book 16 years ago, but we wanted to do something that we could translate and cater to the Chinese market. And that's what we're doing with managing expectations. So it kind of fit right in, meeting with Derek and our current business.
Ah, right. Okay. So it's already got a Chinese translated version on the way.
Mm-hmm. Mm-hmm. It's translated, and we're just basically, the editors are cleaning up some of the vernacular, and the whole package will be available before the Chinese New Year. So it's interesting. It's kind of exciting. It's a whole, another chapter. This is really, Aaron, it's the last frontier, right? Options in China. I mean, they have 120 million retail investors. It could be huge.
Yeah, that's a big market. And I read that you also spent some time in Australia helping out the ASX exchange here.
I did, and I love your accent, because I lived there for 2 years, and I have to say the Aussies were the nicest people to us Yanks that you could imagine. Now, it was a different time. It was 20 years ago, but from what I understand, that hasn't changed a lot. It was so fantastic. I lived at the Rocks in the Sydney Harbor, and I dealt with the exchange and all of the market making groups, the banks, and a couple of the groups that were independent market makers, and literally was on the floor, walked on the floor, and turned out the lights the last day of floor trading in 1997. It was January of 1998.
Okay. So what exactly were you helping out with?
Well, at the time, OM, Options Markets of Sweden, had one of two electronic options exchanges. The other one being DTB, which turned into Eurex. And I was partnered with OM. Are you familiar with ORC Systems?
I've heard the name. That's about as far as it goes, though.
It's a Swedish company that is a professional trader, expert trader system that helps market makers, and they've evolved over the years to have algorithmic bots. And I was part owner of Research and Trade, which is the company that sold ORC. So what we were doing in Sydney was readying the exchange. The head of operations of the exchange had brought us in to help deal with the floor brokers and the market makers, and explain to them the transition from outcry to screen-based trading. We worked with them to develop rules that were fair for market makers, with quoting times and quote requests, quantities, and how, everybody was at risk of losing their job. It was the first onset of automation. And what we did was we helped with a fair and orderly transition. And then we also were installing our systems, which became the front end system for the marketplace, with the vast majority, if not, I think the only ones that didn't use us were UBS. They had their own, but everybody else used our systems. And I camped out there from like July of 96 to February or thereabouts, or March of 98. And I was a global commuter from my home in Milan to my apartment in Sydney, back over to my house in Chicago. I was ping pong balling all over the place as these electronic markets launched. And me and my company were helping Italy and Spain and Kuala Lumpur and Hong Kong and Sydney all make the transition to screen-based trading. Well, some had no options at all, but in the case of Sydney and Hong Kong, they had outcry and they needed a transition. But the people in Sydney at the ASX were the only ones that really gave us a lot of credit for helping them. They were wonderful. And some years later, maybe even 10 years later, there was a conference in the U.S., an OIC conference. And a young lady from ASX was on a panel with other leads, other CEOs and COOs of exchanges. And when I got to her, they said, well, what do you attribute the success of transition from outcry to screen-based trading? And she said my name. She said, because Tony Saliba was there to help hold our hand and make the transition a smooth one for everybody. And I almost fainted. She didn't even know I was there. And basically, my guys were my staff was with me, and they were like, wow, that's pretty cool. But yeah, we left it all out on the field, Aaron. We wanted to make, options that are in our blood. We believe in it as a great product. And we helped with the understanding of these guys who were scared, men and women who were scared about their jobs and how to transition from outcry to screen-based trading, and then also taught them how to use our systems, modified them for their basic, localization needs. And we've been doing that for 20 years.
Excellent. Well, let's go back a little further than 20 years, maybe another 20 years past that. Tell us about how you got started in trading. Like, you got into trading right out of college. Why trading of all things?
Well, actually, I started out as a stockbroker right out of college, just because I didn't really know. I had a finance degree, a business degree from university, and I was offered a job to be a stockbroker. And keep in mind, this was the era of Jimmy Carter and the stagflation, the malaise of super high interest rates and super high inflation. And being a young 21-year-old assistant stockbroker was living hell. Nobody wanted to talk to you. I was in Indianapolis, heartland of the country, and most of these people were farmers or manufacturing families, and they didn't think a kid right out of school was going to help them with their investments. So I took to reading about options, which were only about 4 years old at the time. And I started following the options market. And keep in mind, back then, you would get your quotes the next day. Closing prices would come in the newspaper, unless you called your brokerage company after the close and ask them, you get 5 names. They'd go look up for you, where IBM, General Motors, U.S. Steel, whatever, closed. So the youngest guy in the office, which at the time was me, had to stay late and take these calls as people would, come home from work hour after the market closed and want to know where their stocks and bonds finished. And one day I spoke to a young man who sounded a lot like me, had the same accent, happened to grow up in my own neighborhood, which I didn't know him. And his dad he was in school in Indiana, and his dad had given him a bunch of money to invest in Bally, which was a pinball machine company at the time. They also then ended up getting into fitness, which is what they're mostly known for. And Bally was a big mover, Aaron. I mean, it had huge volatility and would have intraday swings of 10 or 15%. They were perfect for options, and they had options dually listed between Chicago and New York. So I struck up a conversation with this young man, and he said, "Oh, it seems that you know what you're talking about." So he was calling for a quote, but he really didn't have an account with us. So he opened an account, and I started using what I had learned, trading, as a retail customer in his account for him. And after about 3 or 4 months, I had doubled their money. And he said, "You got to get up here to Chicago and let's see what we can do." So I talked them into giving me a shot on the floor. And in the meantime, while I was getting ready to trade on the floor, I met a guy that I caddied for a few years earlier when I was in high school. And he was on the floor of the Chicago Board Options Exchange. And he said, "Hey, I really would like a guy like you to help me out and show me what's going on." And then I had to make a decision between going with the first group or this gentleman. And the first group had started putting a legal contract together with a lot of caveats, and I was going to be more of an employee to them. So I said, "Well, thanks, but no thanks. This guy's giving me a 50-50 deal." I went with the other guy, and within 3 years, I made him like over $500,000 and bought him out. That was in 1981 then. And it just came naturally. Well, let's put it this way. I studied a lot. This is in the days before computers. We had an online mainframe that we could plug our phone receiver into. They had those old-fashioned couplers that made humming and whirring sound to them. And we would get a printout on a Texas Instruments keyboard with a heat-sensitive printer, and we would get our theoretical values, which at the time a lot of people really weren't aware of what those meant or how to use theoretical pricing. And what I did, Aaron, is I would print out a block of values. Imagine a 3-dimensional block of paper cube of time, price, and volatility. So what I did was I focused on a handful of spreads, and I would go out 6 or 9 months in time, up and down 20% in price, and up and down about 30% of the volatility. I was trading Teledyne at the time, which was a very high-priced stock and made wild swings. It was at the time a proxy for the market. IBM, Teledyne, Honeywell, Hewlett-Packard. There was a handful of individual stocks that people would buy and sell based on their market sentiment because the S&P 500 weren't futures yet on them, and there was no tradable index at the time. So people would rush to the floor and buy options or sell options on 6 or 10 big moving stocks as a proxy for the whole marketplace. And Teledyne was one of them. So I would come to the crowd every morning, having studied all night long the various relationships between these spreads and how they would potentially move based on price movement and volatility movement. And then over time, I had all these prices. And it's somewhat of a tie-in to what we're still doing today, because a lot of people who trade options lose track of the relationship between options and various spreads. And what I was able to do was trade much bigger than my peers, because I was able to package my position into spreads that would allow me to eliminate 90% of the position and the risk that went along with that position by having finite spreads. You can imagine vertical spreads or butterfly spreads or calendar spreads, and then some variations on those themes, diagonals and some very light ratio spreads. And over the years, it became second nature to me to be able to walk into any crowd and sort of size that up. But as the personal computer became a thing, if you will, in 1984, I hired my first programmer and built a program that would allow me to do my risk management in the same fashion, automatically, programmatically through the software, so I could carry bigger and bigger positions and reduce my risk much faster, since I did it electronically on this. And that's how I got into the software business then, through that. So I was on the floor for like 13 years, throwing them around with the guys.
Yeah, well, let's flesh that out a little more. Now, just going back towards the start of your response there, you said that you made about $500,000 within the space of 2 or 3 years. If I understand correctly, it wasn't always smooth sailing for you right in that early stage, though. I think you actually came very close to losing all of your money. Can you tell us a little bit about what happened then?
Well, you're absolutely right. I glossed over that. When I was a clerk, before I started trading, when I was a clerk, I observed some of the biggest and what I thought best traders were at the time trading around me. And as soon as I got a chance to start trading, I dove headfirst into it, Aaron, and started building a big position. And volatility collapsed on me. And overnight, I lost the bulk of my capital, which I started out with $50,000, and then I found myself 4 or 5 weeks into trading with only $15,000 in my account. And I was a subject of Market Wizards chapter. Jack Schwager, now a friend of mine, wrote about this. But there happened to be a plane crash that Friday afternoon where a lot of people died. And as I said to Jack, I felt like I would have rather switched places with one of those people. That's how bad I felt. And my partner at the time, who didn't know a lot about trading, but he did know about something about banking. And he said, well, pull your horns in, trade smaller, and just see what you can do with a tiny fraction of the style of trading that you were doing. So I left the rough and tumble crowd of Teledyne and went over to a much more mundane crowd of Boeing, and learned how to be more regimented in my trading and was just trading one lots at a time and was able to target. I had a goal of making about $200 or $300 a day. And I figured, okay, this would pay my seat lease, pay my bills, give my partner his half, and not a bad living for a 23-year-old who, got to wrap up work at 3 o'clock in the afternoon. So I honed my skills over a few months of being very regimented. And I was a wrestler in high school and then also a cross country runner. And if you know anything about these two sports, you have to be very disciplined. Not that all sports aren't discipline needed on all sports, but particularly in wrestling and your diet and training for cross country and being alone for a long period of time. So I really brought out the discipline aspect of my nature. And then one day I was standing in the crowd in Teledyne, which was across the floor where I had been trading the first 5 weeks and not the next 3 months. Got really busy and I ran over there just to see what was going on. And before I knew it, I was trading in the style that I had practiced for 3 or 4 months in Boeing, very regimented, but very small, one lot at a time. And I said, whoa, I can do this in this crowd too. And I was able to chip away at my deficit and started making $1,000 a day and then $2,000 a day. And before too long, I was able to, I got back to even. And, I had a string of many months, over 70 months in a row, where I made 6 figures a month or more. And it was basically from very disciplined, regimented trading, which I think today those who are making money are following similar disciplined techniques. And, punting is something that is anathema to me, but chipping away and having a small target, which becomes a medium target or a larger target every day or every week or every month, is really what I ended up doing and still try to instill today.
So I just want to go back to what you said earlier about how you would have been happy to put yourself in the position of someone who died in a plane crash. I mean, that's a pretty out there sort of thing to say. Why did you feel so terrible about losing that money? Was the fact that it wasn't entirely your capital? Was it you felt like you'd failed in some way? Was there anything more to it than the fact that you just lost the money?
Well, first of all, it didn't happen overnight. It had been 5 weeks of losing. It had been 5 weeks coming. And that Friday was a culmination of more than 50% of my trading capital's gone. Yes, it was somebody else's money, and that was a big factor. I felt that I had let him down. I felt that I was a failure. And I was devastated in that I didn't think there was any way back. And I really felt that, given where I started with, at the time, $50,000, which was a reasonable sum to start with, and now having barely 15 grand, how was I ever going to make it work? So I was devastated in that I felt I had failed, but also it was the man's name was Julian Good. It was Julian's money, and I felt really, really bad about that. And I remember walking off the floor and hearing about this massive disaster, and I just said, if I could do anything and if I could do anything good for somebody right now, I would switch places with one of those poor victims. And I think that was probably the depths of it. It wasn't like a rebound the next day or anything. It was not a V. It was more of a trough that lasted for a while before I shook myself out of it. But a lot of introspection and realizing it wasn't as easy as I thought. So it took a lot of energy, a lot of wherewithal to bring myself to carry on at the time. And I looked around and I thought, well, look, if I can make it in this business, I mean, I'm the son of a carpenter. My dad would come home with, swollen hands and cuts and, sore back and shoulder. I'm thinking, this is a much better living than he went through. So I still have a chance. And I literally sat down with my partner, and that's when he said to me, look, I know bankers who get overextended. They pull in their loans and don't lend as much to new candidates. They just lend smaller till they make a little bit of it back. And I think you should probably try to trade smaller and chip away. So he did bring something to the table in that regard, that he was able to talk some sense into me and get me back on the right track.
Trading at Schwab is now powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms loaded with features that let you dive deeper into the market. Visualize your trades in a new light on Thinkorswim desktop with robust charting and analysis tools, all while you uncover new opportunities with up-to-the-minute market news and insights. Thinkorswim is available on desktop, web, and mobile to meet you where you are. It's built by the trading obsessed to help you trade brilliantly. Learn more at schwab.com/trading.
Ever watch a stock rip and think, I could have nailed that if I had real capital? The truth is, many capable traders never reach their potential, not due to lack of skill, but lack of scale. Trade the Pool was built to solve exactly that. A firm designed for serious individuals who want access to the U.S. equity markets with meaningful buying power, up to $200,000 without committing their own capital. Get access to virtually every stock and ETF. Go long or short freely with the flexibility professional traders expect. You're evaluated on one thing: your ability to manage risk and execute with consistency. Meet the standard, and you trade at scale. No subscriptions, no ongoing commitments. Whether you're still refining your strategy, a trader with experience who hasn't yet broken through, or a seasoned professional simply looking for more capital, Trade the Pool is built to meet you where you are and take you that next step further. The markets have evolved, access has evolved. Now, so has the way traders operate within them. Trade the Pool.
Now, this was an obvious low in your career. Was there ever another moment comparable to this one?
Well, so that was a moment of loathing and despair. But shortly thereafter, about 3 years later, in 1984, there was a event in the stock that I was trading, still Teledyne at the time, where the CEO announced that they were going to buy back some of their stock. And the stock, which was trading at about $180 a share, the target price was $200. So it was only a 10% increase to the current price, but he didn't say how much stock he was going to buy. And what happened, Aaron, was one of the biggest short squeeze scares in the history of the marketplace. I mean, to date, today, back then, it definitely was the biggest short squeeze. And that day, the stock closed at 230. So it rallied 50 points when it really, the tender price was below where the stock closed, because nobody wanted to be short the stock given they weren't sure how much stock this man would take. Well, my position, being a market maker in the crowd, was that I had to manage this massive position, which now was taking on all sorts of different characterizations, given that you had basically two expirations. You had the expiration of the options that the exchange, at the time there were quarterly expirations, but you also had this floating expiration based on the tender offer. And that was unknown. And time spreads went inverted, and reversals and conversions switched. And it became a very, very trying time that I had to scramble. I was scared. And what I did was I immediately started using my relationships with various back office people that I knew, and started calling around and looking for stock that I could guarantee would be not taken from me in a tender. Now, the first day, the stock was up 50 points, and people were not certain, what was going to happen. Volatility had exploded. And what I did was in fact, the gentleman who's in the news today, his name is Leon Cooperman, who was the lead analyst for Goldman Sachs at the time. This is 1984, for Teledyne, sought me out. We started having conversations about what we thought the characteristics of the stock might be. And for the next 3 months, I felt like a boxer on the ropes, trying to make sense of the trade that was in this stock, because we did not know how much of the float, how much outstanding shares the CEO would take. And the stock ended up traveling up to $320 a share. So back in 1984, that was just an unheard of move, where the stock almost doubled in 3 months based on a tender offer at 200. So as much as it wasn't despair as in the previous time some years earlier, this was trying my mettle and being able to defend against an unknown expiration, an unknown path of the stock. All the volatilities had whacked out, and being responsible to make markets in that crowd while all this was going on. So that was a very trying time for me, for sure.
Okay, so you didn't lose out on that particular trade, though?
Right. It ended up, because I was able to take an unorthodox approach locating stock, which is a commonplace today, but back then no trader actually thought of locating stock and getting guaranteed stock. Because of that, I was able to do very, very well. And I saw plenty of guys around me just get ripped to shreds. There's been over the years, it hasn't always been rosy. I keep forgetting about my flirtatious dalliance with Forex. We listed some options in 85, Aaron, on CBOE. At the time, we had the yen, the Deutschmark, the Swissy, French franc, and Canadian dollar. And I went in there because I was a pioneer, and I would try all the new things and try to help get them started as kind of a way of giving back to the exchange. And trading currency options was nothing like trading equity options. And I had a multi-million-dollar line of credit with the banks, and I figured I was all set up to really do some damage. And first day I went home long premium, and the yen moved like 4% that night. It was huge. It was you can look it up. It was in September of 1985, and there was a readjustment of the currencies, and the yen rallied against the dollar like 4 or 5% one day, maybe even more. And I thought, here I am back spread, and I'm going to clean up. And I had my little Quotrek machine by my bed, and it only showed the underlying because it was basically cash trading, interdealer market. And the next morning when we opened the options, they had crushed the volatility, and my back spread lost me money. And I was like, whoa, how does this stuff work? And it was literally talk about being on the ropes. This was not only death-defying, it was day and night because the currency never stopped trading. The only respite you had was at 4 o'clock Central on Friday afternoon, and you really only had 48 hours before it started trading again. And it was. I did that for 2 years. I lost a lot of money. I mean, I'm one not to give up, but eventually I'd throw in the towel. I probably lost about $2 million in those 2 years, plus all my time. But I learned a lot, and I met some great people. It just was so different. So different.
Right. So just continuing on your path, I'm not sure if this was in the interview you did with Jack for Market Wizards or if it was in another interview, but I understand that you had accumulated about $8 or $9 million by the time you were about 30 years old. Was this sort of money common amongst floor traders during that area, or were you an exception?
I'll answer that question in two different ways. One, I would say that it was hard to say. It's hard to say because we didn't really talk about how well we did. But my situation, which is a very little known story, except for my very close friends and family, I mentioned a minute ago that I like to give back. And, I was basically 30 years old and looked around and said, this is a great place. I love the CBOE, and I wanted to make sure it could continue. So I felt an obligation to do something good for the exchange. And in the year or two earlier, I had signed up for a program that a market maker would go around and do a marketing trip with a staff member. And, you were on the road for 3 days or maybe 4 days, and you'd go to some small town or a group of small towns in certain areas where people were interested in options and trading options. And you'd go to a Schwab office or a Fidelity office and answer their questions. So I had done these kind of things, and I'd also done other quote unquote giving back sort of activities like chairing. I volunteered for all the committees, and I chaired a couple different committees, and I was one of the individuals on the very original market performance committee. And it was a committee of market makers and brokers to try to bring rules to the exchange so that market makers would act in a way that was healthy for the customer. Okay, better behaviors, all that stuff now has been ensconced in rules and regulations for decades. But I recorded all of these meetings with a little micro cassette, and that's basically the way I operated back in 80, 83, 84. And then in 1987, in August of 1987, I got a call from the marketing department, who I was very close to, and said, there's a writer who wants to do a story about options market maker. And his name is Edmund Andrews. And Edmund contacted me, and we could not come up with a date where he was in Washington, where he would be able to come into Chicago to interview me, that I wasn't traveling. And mid-August turned into late September, and we settled on October 20th. Okay, because I traveled, a lot at the time. Well, here's the point of the answer to your question. Totally by kismet, this writer, great guy, total sponge of soaking up knowledge and information that was going on, was dropped randomly, just through serendipity, into the eye of a hurricane on the day the market crashed. And he was assigned to follow me around. Okay. And here I was, a market maker at the time in the SPX. And there wasn't very many of us in the crowd at the time. We had just switched to a European style option less than a year earlier. And there were a handful of us trying to breathe life into this institutional product on a retail floor. And I come to work, and somebody said, there's a writer here, his name is Ed Andrews, who says he wants to interview you. And I said, I don't have time for this. The market is collapsing. And instead of rescheduling and being rude to the guy, he said, well, can I just follow you around? And I said, yeah, what the heck? So I got him a visitor's badge, and he stood outside the crowd while I made markets. This was Tuesday after the day of the crash, and watched what happened. Okay. So the answer to your question is, he observed how I did and sort of overheard my staff and I, calculating our P&L. He stayed with me for about 3 days, and it got into his story and became the headlines of the article he wrote. He was just going to do a speculative story, see what kind of magazine would pick it up. And it was on the cover of Success magazine in January of 1988. So it was about 3 months after the crash, and he had put this big opus together. So I was the brunt or subject of a lot of wrath from the exchange, because they didn't want market makers having high profile. They had taken provocative pictures of me, basically just looking like I was having fun, nothing untoward beyond that, but I was enjoying myself, had my feet up and looking, like the cat that ate the canary. And this just sort of spread out around people on the floor and staff that I was making light of a day when a lot of people lost a lot of money, because I was short the market and had these explosion spreads that I would curate and nurture. But I would say most of us didn't talk about how much we made. And to say that I was an outlier or unusual, I don't think so. I mean, I think my peers did well. I mean, I know guys that did better than I did, but then there were also those who had roller coaster rides and didn't hang on to it, that they had made more and given it back and maybe made it again and so on and be on this, pendulum type or yo-yo type ride. But at the age of 30, so that happened when I was 32, and it was in the midst of the string of profitable months, which had started like in 80, 82, I think. So it was about a 6-year run. And I would say that a lot of guys down on the floor, they made their money in different ways. Some took more risk and made a lot more money. I tried to chip away and make a little bit every day. And then occasionally I would have great days where I would, hit the ball out of the park. And, but there were a lot of people down there though that didn't figure it out either. It was, a casino for some, just people who, wanted to bet odds on where stocks were going to go. And options provided leverage for them more so than trading the stocks themselves. And I think that the younger guys like myself who were trying to make it their career were more serious about it, and probably by the time they were 30 had amassed some reasonable amount of wealth. So that's a long-winded way around answering your question, but I think that it's the most fulsome answer.
No, that was a really great answer, and I enjoyed that story about the writer coming and following you around during the crash as well. I mean, it's quite crazy how that turned out for you. You know, during that first, during those 13, I think you said it was 13 years that you were actively trading on the floor. You know, you came in your early 20s up till, around about your 30s. What was some of the turning points, or maybe turning points isn't the right word actually, but major realizations that you had as a young trader? Like, was there anything that kind of clicked with you one day and that just sort of like changed or shaped the way that you traded, shaped your strategy? Was there anything that kind of you observed about markets that changed how you thought about your trading strategy? Does that make sense?
Yes. I don't know if there was one defining moment as opposed to a series of moments molding the feelings and opinions of what I was doing and learning more through automation and such. But in the very early days, it was the ability to, in the early days, it was the ability to see the structure differently than a lot of people did. Most people were really focused on either trading the Greeks, which they would be a slave to Delta and Gamma, and some went beyond to Vega. And others might just trade directionally based on technical analysis. Whereas, I looked at the structure of being low cost or no cost spreads and being able to mold that position and have it be very, very easy to understand the risk and not distract me from my trading. I left the floor in 91, and there's a lot of people that came after, didn't get to the floor till after that had fantastic livings. I mean, I maintained a business down there that my brother ran for another 11 years. So, we were heavily involved straight through. But in terms of actually being on the floor and trading those 13 years, I would say that I tried to go into areas that were new. I tried to do things that were a little bit avant-garde, or not the beaten path, if you will. And I studied. I can't say that I'm not a quant guy, and I'm not a particularly. I wasn't very good at math in school, but I could do the math fast enough in my head, and I'm very disciplined. So I would teach myself these relationships, and I always had that in my kit bag that I could lean on. And then over the years, I learned a lot more about theory and about automation, and got more into using automation to eliminate a lot of the drag or a lot of the superfluous activities of trading. So I don't think there was any one defining moment or one singular process, but I would say that when I die, the gravestone would say necessity was the mother of invention. And I think that I always looked at what the problem was and tried to figure out how could I solve it. So in the case of the story I told you about, the tender offer, and everybody was having extreme pain about short covering, I went to the source to control short stock. When the market collapsed, I mean, I had the benefit of owning a lot of really far out of the money puts, but I bought them because nobody else wanted to buy them. And I was buying them from retail brokers who were just selling them for the premium. And then I was able to parlay off of that into spreads that paid for them. And when the market came unhinged, I had some bullets, as they would say. So each stage of my life, I would say necessity has been the mother of invention. And that's to a great degree how I improved my trading and improved my view of the trading environment. And that's what we're doing today now with China. So, you know, we see there's a lot of smart people in China. There's a lot of systems in China already. There's a lot of approaches that people are trying to say this is the easiest way to get there. But I don't think that's the case. My youngest brother happens to be the head risk manager for Goldman Sachs in the area of options trading. And last year, when the market literally came unglued in August of 2015, I remember it because it was on my anniversary, and he called me and he said, AJ, I've got a line outside my door of 30-somethings who are blowing up, and they could really use a dose of relative pricing because they don't know how to make heads or tails of their positions because volatilities have just gone off the charts. And these events happen maybe once or twice a year, but when they happen, they can be devastating for a lot of people. And it's been that understanding of the option structure that, you know, I coined a phrase when that tender offer happened, Aaron, staying spread is staying alive. And spreads have grown, been the fastest growing segment of the listed options market because you can identify the risk and because you can depend upon it. And as my brother was saying to me last year, he said, there's just too many people who depend upon systems to tell them where they are, and they don't have that extra set of tools to fall back on when the you-know-what hits the fan. So I think it's been a molding structure, and basically whatever the necessity was, I would try to figure out a solution for it.
After you left the floor, like you mentioned a little earlier, I'm not sure if this was directly the next step, but you started an education program teaching traders. Can you tell us a little bit about what this operation looked like and maybe your reasons for actually starting this program?
That's a great question, Aaron. You don't know how funny that is, actually, the reason. Well, so it's 1988, and I had about 23 or 25 traders trading for me on the floor, and each of them I would have to work with personally and teach them what I thought they should be doing, and I was getting tired of it. So I asked, I had a very small IT department, if you will, 3 guys who were just out of college, and they knew how to program in DOS. And I said, I need to find out a way to automate what I do. There's got to be a multi media package we can find or put together that would allow me to stop having to do this one-on-one. I mean, it's so tiresome now because the 20-some guys that were on the floor represented maybe 50 guys that had gone through the program and had been above average. So we were experimenting with video and the early nascent computer programs. And I met some guys that were building a simulator for gaming purposes, but they didn't know anything about options. I mean, they were working with a guy who thought he knew something about options, but he didn't. And I decided that I would invest some money and help these guys build a simulator that would also help me with my needs. Well, as you know about software development, they call it a rubber calendar because things always take longer than you think and they cost more than you expect. And when I was done, the number was pretty big, and I said, shoot, I got to find a way to monetize this. And I figured very basically, if I had this need and had to go through this to develop my own solution, there has to be others out there that could utilize this solution. And lo and behold, the German market was about a year away from launching an options market. And I packed up my stuff, literally a metric ton of hardware, because it was all voice activated. You would train your voice. We figured out that there was about 45 words that you could have a full a day of trading or a full expiration cycle of trading. And it was basically 45 words or less. Buy, sell, the numbers, done, various things that you would say on the floor. But it ran on the very early stages of Dragon voice recognition software. This is 1989 now. And it had to run on our computers. And by the way, all Germany was on Unix using Sun systems. And there we are on the Frankfurt tarmac with these giant crates full of computers, steel crates full of computers, bringing them over to Deutsche Bank. And I had spent months working with a gentleman who I had met. He blew out in 1987, but he was a brilliant guy, and he's subsequently gone on to have a great career as a risk manager. He's called the Risk Doctor, Charles Cottle. You might be familiar with his name. And he joined forces with me, and we put together a curriculum around our simulator, and we taught the German market, hundreds of guys, and some women too, back in 1989. It was pretty much a male-dominated business, how to trade. And we delivered to the German market dozens of market makers and dozens of sales traders. And some of those guys are running the desks now, and some of them are actually, a couple of them are on the boards of directors of some of these banks. But we barnstormed from Frankfurt to Vienna to Milan to Madrid, Denmark, Stockholm, of course, Kuala Lumpur, and Sydney, and a few other places in South America, Colombia, and Central America and Mexico, and taught literally about 7,000 people over the next 10 years how to do the various things that they need to do in an options market, from market making to broking to being a hedging physical positions, and on and on. We had about 20 some courses. And that business still operates today. We're doing it now with the Chinese, and from time to time, other people come. They want to get that real. Shelley Natenberg has written a book that's one of the most popular books. Shelley's a great guy, and he really talks about, how options work. And what we do and have done and continue to do is talk about how to put the trades on, how to move the trades around, how to manage a risk, and actually be the mechanics of the business. So that was another necessity, some other invention. If they would have delivered that simulator on time and under budget for me, I might not have gotten into the business. But in the meantime, now we have electronic simulator and courses in Mandarin, and it's just been a progression. So that's how I got into that business, and I really hadn't been involved with it from maybe 1998 till a couple years ago when we started doing stuff in China again. I had other guys running it for me.
Right. And were you ever afraid of giving away your edge? I mean, I'm not sure about the specifics that these courses actually taught, but were you ever concerned about giving away too much, like giving away your edge on exactly how you traded?
Well, not really, Aaron, because so idea generation comes in different forms, right? And so, if you find a niche or an edge in the marketplace that is fleeting and you don't want to tell people about it because you want to utilize it while it exists for yourself. If we were that kind of program, then I would be worried about it. But really what we've done is evangelize about the ability to do better risk management, identify opportunities in your marketplace, stay disciplined, how to turn positions, losers into neutral or neutral into winners. It's better to have a great spread on at a bad price, for instance, versus taking a loss immediately because you made a bad trade. And so how do you turn that bad trade into a better spread just at a bad price? Things like that. So our edge or our secrets weren't such that we were exposing some holy grail or that we were going to tell the people we were working with something that we would need them to keep a secret, or else it would not be effective in the marketplace anymore.
Now, Tony, this is a cliche question, but, as someone like yourself who's been doing this for 4 decades, you've 40 years of experience, I think you're the right man to ask, what are important traits of a good trader?
Well, it is a little bit of a cliche, and my answer, I'll try to make it sound less cliche than the answers you might have heard in the past, because first and foremost is discipline. Okay, and that obviously is the ability to stick to a plan and not be distracted from that plan. Okay. Another trait is creativity, and that would be to come up with a plan and to be able to see what might work in the marketplace. And the third thing would be the ability, humility or humbleness, to be able to understand that your plan was maybe 80% or 90% right, modify it, maybe even scrap it and try another plan. Okay. And a good sense of humor, I think, is very important, also, because the market giveth and taketh away, and basically you have, look at the people who swooned the night of Brexit, and then again on our election night, and seasoned pros were even panicking, but greatest buying opportunity in history that night. And I would say I don't know many people that actually took advantage of it. So you have to have a sense of humor that you missed that and keep going on. Obviously, intelligence and diligence, but the systems of today and the ability to have a embracing of what automation is available and how to. I know so many traders today that are still swivel chairing because some of the systems are not integrated, and I'm answering your question from the standpoint of an individual who's going to be trading rather than be a cog in a bigger machine working for a bank or a combine, which is also good. And some of those banks give you some freedom to do the things that you want to do. But for the most part, if you become part of a team such as that, you'll be dictated to some degree in what they want you to do. And I think that's good, because somebody who's possibly more disciplined and more aware is going to give you a plan to follow. But I'm answering this as an individual who wants to make a living doing it, or is trading as a side avocation. So those would be the highlighted aspects or characteristics of an individual that makes a good trader.
Yeah, those are really good, and I want to pull apart those a little further if we can. So you made a point there about systems and automation and that sort of thing. Can you just expand on that point? What exactly are you trying to get at when you're talking about systems and automation and traders not necessarily utilizing that technology as much as they could be?
There's two types of systems overview on a very high level. There's systems that are built for the brokerage company. So they're basically designed to be order entry and facilitate your execution. Okay. And I would liken that to an appliance that you would have in your kitchen that's very important to you, like a refrigerator, but you don't really think about it very much. It's there. It does what it needs to do when you need it, and you don't spend a lot of time thinking about it. But you're standing at your kitchen counter, and you also have a second appliance or device, and that would be likened to a system that is more focused on the trader's needs, idea generation, more workflow automation, helps you skip steps, and allows you to match your personal characteristics, your persona, with the data you need, when you need it, and how to use it. And that device would be more like your smartphone, your iPhone. It's something that you love and you can't be without. So you're standing in your kitchen, you got this very basic and important appliance, your refrigerator, can't live without it, but you don't think about it. And then you have this little device, which is the iPhone. You need it, you can't live without it. And those are the two types of systems generally that are available. One is built more by the brokerage firm to facilitate what you need, and the other one is built by maybe a third party so that it meets your needs and you can't live without it. Now, there are some brokerage firms that offer the second type of system also, but those are few and far between. And I've talked to a lot of traders, and I know a lot of traders, and nobody really settles in on one system. Many of them have multiple accounts because various systems offer something in a way that the other system doesn't. And so that user could be two separate users, and they would disagree. One would use company A and B, and the other one might use company B and D because of their personalities and their characteristics. So it takes that aspect of a trader that I mentioned. It takes a person to understand, what's out there, how they can make it fit, and if you're going to swivel chair and use more than one system, what systems work best together. I know guys who use the second type of system, the iPhone type of system, by one brokerage to get their idea, but then they trade with the refrigerator brokerage because it's cheaper. and that their time frame allows them to swivel chair and make decisions and make trades versus maybe setting up a bot and letting the bot do the automation for their idea all in one shop. So that characteristics, and I personally can't tell you what the best system is because different personalities need different things, and there's some global systems that are available that are decent, and then there's some higher level systems that are very expensive that don't work in every marketplace. So it's really a matter of which market you're going to trade and what your personality is, what your risk appetite is for the idea generation. But you should understand that that's something. I mean, I know guys who spend more time researching systems and trying to find the system that's going to fit them before they actually engage in the trading.
And is that a good thing?
Well, if you're going to lose money and you're preventing yourself from losing, it's a great thing. Yeah. I was talking to an individual that runs a large Asian brokerage, and this person was telling me that they were surprised at some of their brokers who moonlight, if you will. They have side jobs consulting their customers about what happened in the market that day and answering their questions, this so-called coaching, right? And she was telling me that it, in some cases, went on for the better part of a year where these individuals would pay a lot of money and not make any trades. And I said, well, of course, they're scared and they're preventing themselves from potentially losing. But hopefully when they do trade, they're going to be much more well-equipped to deal with the loss if they do lose. And if they learn and they're actually more profitable when they do trade, then that's going to be money and time well spent. Now, I started my career, as I told you in the onset, totally different. I plunged in head first and almost lost everything. And I learned out of fear, total shock, right? But today, I think the markets are less forgiving, and there's a lot more that you can learn from before you do trade, so that it makes sense to, do your research, but probably more measured than some of these people that she was telling me about going 9 months before you trade. But it's an aspect, I think, that you just can't take for granted that your brokerage company is going to give you the best system, and then that's all you're left to use, right?
So your main point in this tangent about systems, etc., is that traders really need to map out their systems a lot better, think about their workflow, make it as efficient as possible. Is that kind of what you're getting at here?
Yes, and maybe make an inventory of what's available and what they do, and understand how they work together, if at all. And it's a combination of your risk appetite, your degree, amount of capital you have, the agency or brokerage that you're going to be utilizing, or multiple brokerages you're going to utilize, and understand what is out there and what you can use. I mean, I have contact with lots of traders from every stratum of trading, and only those that work for a very large company that's built their own system and mandate they have to use one or two systems. But most people are using multiple systems. They're tinkering with them. They're swivel chairing. They're trying their best to optimize between those systems. And I mean, that's just a sign of the times where we are right now. But a trader should understand that there are choices, and that should be able to look at these various systems and know what they're missing by not using one of the other systems.
Okay. Now, when I first asked you this question about, important traits of a good trader, one of the first points you made was that a good trader has good discipline. I just want to get very clear on this point, because you brought it up right at the beginning of our discussion, as well as, you said that discipline was something that really helped you dig yourself out of a hole when you were down to $15,000 coming from 50 grand initial balance. What is discipline as a trader? Like, what exactly does it mean?
Well, for me, it meant, and for people that trade for me today, what it means is sticking to risk guidelines, sticking to size guidelines, sticking to a plan that if you map out a plan, whether it is technical analysis on entry points, a carry trade, a price target that you expect, how are you going to play out that scenario, and then stick to it, so that if something unforeseen happens, you either are using your exit strategy, or you're staying in the strategy because, let's say, it's a low risk strategy until it comes back. So the discipline is not to change the course of your plan because of events. It should be understood and noted what you're going to do, and then stay with it. Otherwise, you can't determine why you didn't make money. Was it because you veered off course of your plan, or because the plan was wrong? And cheating on that only makes it more difficult to determine what went wrong and how it actually impacted your P&L and your risk profile. Sure.
And the other point you made was very non-cliche. It's not one I've heard before. And that is it's important to have a good sense of humor. And when you were talking about this point, you mentioned that, the recent elections brought about one of the best buying opportunities. But you said that even many professional traders missed out on this and weren't able to capitalize on that. I'm just curious to hear, why do you think that was? I mean, was this just something that was easy to identify in hindsight, or, what are your thoughts?
Well, so I think when you play back the tape, I didn't say many professional traders, but those that I know and I spoke to, I don't know any that really hit the ball squarely that night. And the reason why I think it happened was due to caught a lot of people off guard, and B, it was overnight, so you really only had a limited amount of trade that you could transact. You had, S&P overnight futures and possibly dollar trade, but for the most part, for Americans, it was a shocking situation. I think most people, the majority of people, didn't expect that to happen. And now look at the value that's been created since then, just due to this man being elected. So, I was on with Trader while that was happening, and I was getting the handles as the Dow and the S&Ps, plummeted. And, I could have pulled the trigger and said, buy some S&Ps here, but I'll just admit it, that I was a little bit shocked and a little bit scared, and I thought that the market was convulsing and may take a while to snap back. Now, I will say with 100% sincerity that the night of Brexit, that was a different story. I thought, for sure that this was a bunch of wailing and teeth gnashing and hand wringing that wasn't going to last. But that correction wasn't as deep, and the bounce back wasn't as immediate. But I to a man, I was leaving literally the next day or 2 days later for the UK, and I went around Scotland and Ireland and in London about 5 days each country, and asked everybody that I met, were they a Remainer or a Leaver, because it was so fresh. And it was a mixed bag of responses. So that activity on the night of Brexit, to me, I thought this is a great thing. This is overblown. This correction is overblown. This is going to be great, great for the UK, and great for other countries that end up leaving that globalist situation called the EU. But with Trump's election, I think that it caught all of us off guard, and really was, it's obvious now. Sure, he's going to cut rates and cut regulations, and all the things that he's said are very bullish. But it just didn't strike me that night that the market would digest that the same way that was on the face. And that's why you need a sense of humor, Aaron, because you could kick yourself for many, many months saying, how did I miss that?
Yeah, we've all felt that. That's for sure.
And people are still feeling it right now. It's like 1 month later, a lot of head shaking. And
Tony, I'd just like to ask you a couple more questions here, and then we'll wind things down. I'd like to touch on the subject of longevity. As I mentioned earlier, you've been in this business for 40 years now. It's a long time. How critical has change been to your success and longevity? Can you give us an example of how you've had to adapt and evolve with times?
It's a great question. Great question, Aaron. Yes. As I said earlier, necessity being the mother of invention, my adaptation, which has been critical, and, I got to say, I hate when people say, wow, you reinvented yourself, because that's kind of a weird term. I didn't, people who do that didn't reinvent themselves, but maybe they figured something to add on to themselves or to modify something that improved themselves. So my reinvention, if you will, to use that phraseology, has been to bring a solution to the problem that might have been a roadblock for me, or a speed bump as it went on. I mentioned the simulator being a tool I was in search 4, and then ended up saying this has got to be a business because it was harder than I thought to develop. And prior to that, in the early 80s, I came up with some smaller programs to assist me in my risk management, and that turned into a system that I ended up building and adding on and becoming a blockbuster that I sold, wrapped it into a company, and ended up selling it for a lot of money to Bank of New York. And then another time I needed to change or reinvent myself, if you will, when I had a clearing firm in the mid-'80s and developed some software, which was a solution that ended up revolutionizing the marketplace because nobody had automated the margin package. Margin calculations were all done by the OCC and only by the OCC. So change, absolutely, very important and constantly changing. I mean, my wife says on a regular basis, that I got too many ideas and I give this too much thought to come up with solutions. But I usually sort through to find out which one is the right one. And I mentioned a little bit before about the refrigerator and the iPhone, and you will see shortly one of the projects we're working on will bring that to fruition. And that's just another aspect of the change that I'm undergoing right now with various people that I'm working with to address some of the problems that are in the marketplace today. So the answer to your question is I usually change by developing a solution, whether it be a software solution or a combined software and some sort of social aspect in the case of those classes that I developed and delivered for so many people around the world. And while I was doing that, I was meeting great traders or great traders to be, and ended up backing some of them in various markets. And through wisdom that I had learned and their youthful exuberance and intelligence, made some great progress in a number of the new marketplaces that I wouldn't have had I not done that. So I would say solution provision has been the way that I've dealt with change.
Okay. That's a really good answer. And I'm really keen to ask you this next question. I think you may have already answered it to a certain extent, but how have you been able to scale your wealth? At 30 years old, you'd accumulated about $8 or $9 million in trading profits. What things have you done to compound that into the fortune you have today?
Well, I've diversified, and let's put it this way. I mean, I would be disingenuous to say that everything that I've done has been a profitable or automatically positive activity. And as I like to say, a parallel entrepreneur, because I do have multiple projects going at the same time, you end up, kissing some frogs on your way to that princess. And what I've done is to branch out into other aspects of business. We own, an insurance company and a golf resort in Northern Ireland and healthcare facilities. And so what we've done is been able to utilize what I learned in trading and get into other businesses that have nothing to do with trading, but you could see the discipline and the risk management, if you will, the reporting, the identification of where you're making money, the P&L identification. So I've taken those things. I still stay involved in trading and in training and in systems development for options trading. But in terms of scaling the wealth, I have my family, my nephew and my brother, who are very good at helping find opportunities. They look at a lot of deals and been involved in a number of, some have gone belly up. We were involved in Fisker, which got screwed by the U.S. government, was better than Tesla in our opinion. But then, we've been involved in other bigger deals that have done well, and some have IPO'd, and others have just been, spinning off returns. So that's how I've been able to deal with it, having this family office and being able to, work with my family to do that.
So with that being said, how do you encourage other aspiring entrepreneurs and traders to think about money, wealth, and success?
That's a great one. Because we all are at risk of letting it get out of hand. And, I was born into a very, I don't want to say poor and impoverished, because that would be unfair in the relative sense of global poverty. But, my father was a carpenter. He lived hand to mouth. He fed and clothed us. There were 7 of us. Okay. And we learned to live without. We went with very little. We wore hand-me-downs. We respected value of a dollar. We were very good at trying to maintain a lifestyle on a very small amount of money. Leftovers were always eaten, and you have this upbringing that helps you respect the value of a reasonable living. But we all run the risk of making more than we ever dreamt we would, which is in my case. And you need to stay disciplined in that regard too, because, and I'm not saying to be a penny pincher or curmudgeon-y Scrooge type, but I think for young people who attain successful trading results, need to stay grounded and need to understand that you can make a lot of money and keep it as long as you don't start to get crazy about habits, because the crazy habits usually tend to break down your discipline. Now, having said that, I know guys who have houses in multiple states. Some have boats at those houses, and I don't think that's excess if that's how they want to manage their lives, and they end up having a trading style and trading skills that allows them to do that. But sometimes those become distractions to their businesses, and sometimes it gets to be more of a burden. So that discipline permeates my life. I mean, I have multiple residences too, but I think I know when to draw the line and be able to sort of live within a reasonable, 24 hours of the day boundaries, and be able to enjoy it and not be let it go to my head.
Yeah. Do you think without those humble beginnings and the upbringing that you actually had, that you would have had the drive to reach the levels of success that you have today?
Wow, it's another spot on question, Aaron, because no, I look at the kids of the generation of my kids. I have young kids, and there's I hate to say it, but a sense of entitlement. It's a natural propensity of parents like myself who've done well to give their kids everything. And there's an old saying, I'm sure you've heard it a million times, but I heard it a million times when I was, in my teens, and that was, success skips a generation. And I always wondered what that meant. And sometimes I would think that it skips a generation because maybe the generation that were the children of a successful parentage would maybe not be as smart, let's say. But I think it has everything to do with not being as driven and not being as hungry and not being as worried or careful about their future, so that they would look out at everything and see it as a glimmer of opportunity versus, well, what does this world owe me? And I see that in a lot of the 20-somethings and, dare I say, maybe even 30-somethings, but the millennials, there's a sense, not at all, but in a reasonable amount, that there isn't the kind of hunger and the ability, if you tick through the things that I said make a good trader, you have to have the discipline and you have to be able to readjust, and you have to also take a loss and be able to endure losses. I don't see that so much. And I think it's possibly because their parents have taken good care of them. Not that my parents didn't take good care of me, but it was a different type of care. It was a subsistence or existence and not a preeminent spoiling of the children. So the answer to your question is you're absolutely right. If I didn't have those small beginnings, I don't think I would have been as driven as I was and am today. And I think that that's just something that you can't replicate. Now, I'm not saying that children of wealthy parents can't be hungry. Obviously, if their parents help them get started, that's a great advantage. But I'm sure there are plenty of offspring of wealthy parents that are hungry. It just takes more. It takes an extra special child, an extra special person to have that drive. Now, having said that, there's creativity that springs from a person as a savant, and they may have a special characteristic or a special trait to be able to create something, and their upbringing may have no bearing on how successful they are because of that creation. And what I mean by that is, maybe a guy like me had to try it multiple times to get it right, and then through hard work and discipline was able to succeed, versus someone else who came from rich upbringings but had a special gift or a special level of creativity that they, develop the power wall or the space elevator or something that, is revolutionary, and their upbringing becomes secondary or even tertiary to what they're doing. So, but I do think that mine had a big role to play with me.
Yeah. Another excellent answer there, Tony. And I know we could keep going for so much longer, but let's leave it at that for now. I've really enjoyed this conversation. Thank you very much for coming on.
Aaron, it's my pleasure to meet you. You're an awesome. I'm telling everybody I know about your site and your service. I think you're an awesome interviewer, and happy to do it again if there's something else, or fill in the blanks. Maybe there are men and women, young men and women, that would benefit from some of these things in your audience.
Yeah, no doubt. And I was going to say that, maybe we should try and set up a part 2 at some point, because like I said, there's so much more we could talk about. But before we close this out, I want to ask you about this latest book, which you've just released. It's titled Managing Expectations. And I know you've written a few books in the past. What's this one all about, and what can someone expect from reading it?
Well, this book so my previous books were a little bit more basic and beginner. They were targeted for individuals to use somewhat as a workbook. We wanted to be different in terms of with quizzes and tests to go back and understand, so the individuals could understand what they were doing. And in this book, we have 24 chapters devoted to synthetics. Obviously, we cover the Greeks, but we talk about how the Greeks react versus 10 different strategies that we show, and then how to change these strategies, the risk in the strategies for different market situations. So it's kind of an intermediate level book. It's coming out in Mandarin. We did this mainly for the Chinese market, but we've already had a lot of pre-orders, and people who have read sample chapters have come out and said that they thought it was additive to the genre. The package that we're offering has also the audiobook read by me and the ebook. So we're looking to fit a niche of newer options traders that have not been exposed to relative pricing and the ability to look at synthetics and look at different strategies in multiple ways. So it's something that you might be able to find if you read a lot of different books and maybe not get all of what we have, but we try to sum this up as the working man's options trading book, and that's where we're at on this.
Yeah, I mean, I think if you're into trading options, you'd be crazy not to read it. I mean, obviously you've had 40 years experience in the game, all packed into one book. It's very cool. And I have to ask you, what's your reason for titling the book Managing Expectations?
Well, I think so much of what we do in trading is about testing yourself and being able to understand where you want to go and what is your level of accomplishment. So just like I mentioned in the very first question you asked, I started out by not really thinking or desiring a certain amount of profit each day until I did. And then when I did and I said, I want to make $300 a day or $200 a day. And when I hit that target, I was able to understand that my success had been reached, and I managed my expectations and felt comfortable saying, okay, I put in a good day's work. Same thing can be said when you are trading in a stock or trading in an index or an ETF. And what can the market give me? You need to be able to manage that expectation and gauge your success around that so that you are not, constantly swinging for the fence, constantly trying to hit that home run versus getting on base with a single or a double. So, working with my partner, Larry, so Larry Shover and I did this together, and we just liked that dimension or that angle, saying that, you need to be able to know what slice of the market you're going to be able to operate within.
Well, what I'm going to do is I'm going to tack an outro onto the end of this interview here. So guys listening, I'll give you full details on where this book is available and how you can get your hands on it. Tony, thank you very much for coming on the podcast. I appreciate you taking 2 hours out of your day to speak with me and share a whole lot of insight with everyone who's listening right now. So I truly appreciate it.
Aaron, thanks so much. I look forward to meeting you someday also.
Hey there, I mentioned I'd tack an outro onto the end here for how you can get Anthony's book, Managing Expectations. So listen up, especially if you are an options trader, then I think this book will serve you well. The official release date of Managing Expectations is the 30th of January 2017, though it is available for pre-order on Amazon already. just go to chatwithtraders.com/expectations, and that'll take you straight to it. Also, as I mentioned right at the beginning, Anthony's going to be giving away 5 signed copies to Chat with Traders listeners. To enter, all you got to do is go to chatwithtraders.com/Tony. The giveaway closes on the 24th of January 2017. Again, that link is chatwithtraders.com/Tony, Tony, to enter. Thank you so much for listening. Enter the giveaway, pick up a copy of the book if you don't want to wait, and if you want to impress me, please share this episode on Twitter. Thanks again. I will catch you next week.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Starting a business can seem like a daunting task, unless you have a partner like Shopify. They have the tools you need to start and grow your business. From designing a website to marketing to selling and beyond, Shopify can help with everything you need. There's a reason millions of companies like Mattel, Heinz, and Allbirds continue to trust and use them. With Shopify on your side, turn your big business idea into... Sign up for your $1 per month trial at shopify.com/special offer.
What would your trading look like if capital wasn't the constraint? That's the reality for most traders. It's not skill holding them back, it's size. Trade the Pool changes that. Step into the U.S. equity markets with up to $200,000 in buying power without committing your own capital. Full access to stocks and ETFs, long or short, executed with the precision and freedom serious traders expect. Your performance is measured by one standard: disciplined risk management and consistent execution. Meet that standard and you operate at scale. No subscriptions, no ongoing obligations, just a clear path forward. For those ready to trade beyond limitations, this is the next level.
You're in your apartment alone. Then you hear something. You think, was it just the storm? You realize you're not alone. Your living room is not safe with Unhinged, the new immersive game experience brought to you by Netflix. To make it out alive, you must answer the phone. The question is, when your phone rings, will you answer? Tap the banner to play Unhinged now, only on Netflix.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
How you doing, folks? You're listening to Chat with Traders. I am your host, Aaron Fifield. What you're going to hear very shortly is my interview with John Netto. John, a former US Marine, describes himself as a high-velocity cross-asset class trader. He connects the ability to be versatile, adaptable, and interpret large amounts of information to be his greatest edge for making lucrative returns. These are all things we cover during the interview, which includes discussion about process, research, strategy, macro, and market regimes. We also talk about the benefits of stepping outside of your comfort zone, why there's a need to embrace growing pains, and when emotion can be an ally. And just a quick heads up to let you know, on the next episode, being 109, I have Edward Thorpe on the podcast. So look forward to that. But right now, here is John Netto for episode 108. Thank you so much for listening.
Fair enough. Yeah.
Cool, man. Well, let's just get into it. So, John, I understand that your interest in speculating began at a pretty young age. Do you want to share with us where this all began for you?
Sure. I would say that I placed my first sports bet when I was 8 years old.
And it was a NFL game here in the United States, American football, and it was just something that the idea of having something at stake based on a yet to be determined outcome was very intriguing and very alluring. And as a result of that, I ended up developing quite an interest in how to predict more accurately. Because at first, they normally say like the worst thing that can happen is the first bet you place is a winner, because it kind of hooks you and it gives you this adrenaline and you think that this is beatable. Well, actually, I lost like the first couple bets that I placed. So in that regard, it's interesting just to see, how that whole thing evolved. But I didn't take no for an answer, so I kept on sports betting. And I would say that while I don't do that anymore, it's something that sort of was in my blood. And this inherent desire to take on risk, and then ultimately, with a process and a discipline, began at a very young age.
So, I mean, that's not normal for an 8-year-old to take a sports bet. How did that sort of come about? Was that something you picked up from your father, or where did that come from?
Ironically, my father's very conservative. However, he did really impress upon us like the importance of investing and saving. And really putting money away. He always followed the stock market. I remember very distinctly in junior high, I'm in 7th grade. It was October 19th, 1987, the day of the big crash, when the Dow fell, 500 points. And I live on the West Coast, so I'm 3 hours behind New York City. So we were driving in at 7:45 a.m., which is about 10:45 a.m. in New York. And like the radio was going on talking about the Dow was down 250 points now. The Dow's down 350 points now. And my dad talking about how much money he was losing on the market. And I just thought it was absolutely fascinating watching this market sell off, which probably explains why I think why a lot of traders, love make money being short the market. And there was just something fascinating about a big market crash. And I was 13 years old when that happened. Also, this is around the time, of course, the Oliver Stone movie, Wall Street. And when I saw that movie, I was, 12 or 13 as well. And just knew right away that when I saw all the scenes, and most traders out there who are in their 40s, I'm 42, are very familiar with the final scene of the movie when he's down on the floor and he's trying to save his father's company by bringing in another corporate raider to outbid Gordon Gekko, then ultimately dump the shares and then really have Gekko lose a lot of money. Just the intrigue, the Machiavellian style with which that movie was constructed. Oliver Stone intended. He has said many times, to really depict corporate greed at its worst, and to show just how nefarious the financial industry can be. And instead, paradoxically, he actually turned on a number of people to the financial industry, and a young John Netto being one of them.
Yeah, no doubt. That's it's such a classic movie, that one. In high school, I presume this was probably just a few years after, you were a bookie. Now, I can't remember where I read this, but...
No, well, hold on. I provided liquidity for those wishing to prognosticate on the outcome of sporting events. Let's make sure we have our semantics correct here, Aaron. All right. Now, some people might call that a bookie. I was a liquidity provider, though, and provided lots of exotic derivatives bets to make that possible. And so my high school career taught me a lot of things. Actually, that was in I talk about that a lot. That experience, sort of how I created the Netto number. And the first sort of version of the Netto number was when I was a bookie in high school, to use your terminology, when I was providing liquidity in high school, to those, who wanted some action on American football games, which is the most popular sport to bet on here in the U.S. And I came up with what was called a progressive point spread, at the age of 16, where most American style betting is a binary outcome, meaning you either win or you lose the entire amount. And the progressive point spread provided context, albeit a cap on that context, which seemed to make more sense. So if a team, is a 7-point favorite and they win by 15 or they win by 8, the way the most American bets work now, which is still to this day the case, you're going to win the same amount of money. However, with the progressive point spread, I had to model it around NFL games because NFL points, like 3 and 7 is a very powerful point. They occur more frequently. So I had to model out how I work those payouts. If a team won by 7, laying $1.10 to win $1, meaning you bet $1.10, you get back $2.10. Then they win by 8. Okay, you would get back, $1.60. All right, because that 7 to 8 is worth more. If they won favored by 3 and they won by 4, yet it's a non-normal distribution in the sense that going to 8 to 9 doesn't have the same increase. Going to 8 to 9, where 7 to 8 will pay you $1.60, 8 to 9 only pay you $1.72, and 9 to 10 will then pay you another big leap up to, $1.97, then 10 itself will pay you, $2.07. And then from there, you get your full money. So so football was unique in that regard. Basketball is much more linear than football in terms of the model behind that. But nonetheless, these are things I was working on in high school while I had pretty poor grades, was just how to be a better liquidity provider. And I just learned a ton of lessons, that ultimately there was this spirit that I ended up creating the Netto number to provide better context on performance. The Netto number is what I use today is the equivalent or tantamount or analogous to the progressive point spread, which I used 25 years ago as a bookie in high school.
Right. Okay. So you might have lost me a little bit, but what do you mean by you were a liquidity provider as a bookie?
Yeah, I mean, like what bookies inherently do is that they don't pick the side necessarily that someone bets on, just in the way a market maker doesn't pick the side. Someone comes and you have, I don't know how familiar you might be with American football, but the New England Patriots are a very popular team. The Dallas Cowboys are a very popular team. Okay. And so I don't tell people who they get to bet on in the same way that a market maker doesn't. A market maker, you go to a market maker, and my job to make a market for an NYSE stock. Okay. Let's say Alcoa. All right. It's my job to keep an early market and provide liquidity for both buyers and sellers. Okay. So being a bookie has the same skill set. I'm there to provide liquidity for people who want to bet on a team or bet against the team. I'll make a market for them. If you want to bet on the Dallas Cowboys, you got to lay 7 points minus $1.10 to win $1. Okay. If you want to bet against the Dallas Cowboys, you also can get 7 points. All right. For minus $1.10 to win $1. So bookies are very much liquidity providers because they simply are facilitating order flow for people's desires based on what they expect to happen in the future. And so in high school, I was facilitating order flow based on people's, prognostications around sporting events. And that's where I was drawing the analogy.
Right. So this sounds quite advanced for a 16-year-old to be doing. Where were you doing this? Just out of your bedroom at home or?
Great question. So I grew up in the Bay Area, East Bay Area, San Francisco, a small city called Pinole, California. I'm a California native, East Bay Area, right near Oakland, Berkeley, very close, on Interstate 80 for those who are familiar with some of the interstate geography in the U.S. And on Sunday nights, the Stardust line, the Stardust is a very famous casino back in the late 80s and 90s, and really in terms of big pioneer when it comes to a lot of the sports betting and odds making that went on for sports investing. And so I got this really powerful radio line that would come in that I'd pick up down in my bedroom, and I would record all the opening point spreads. Okay. And then I would listen to this sports, and all they would talk about every night was just sports betting. And so I would listen to all these handicappers and do everything and go to school. I'd print out these parlay cards at my high school. Then I got other sort of people to work with me from other high schools as well. And I built up a pretty sophisticated operation. Understand that I was still not 18 years of age, which in the U.S. is when you can be tried as an adult for doing something against the law, with a full understanding that being a bookie was against the law, or I should say facilitating order flow. Sports investing was not legal in California at the time. It was only legal in Nevada. And even then you needed to have a license. And at 16, I assure you that I had no license to do what I was doing. But nonetheless, I didn't let that stop me from my entrepreneurial desires. And, worked at primarily football, age 16, 17, even some of 15, my sophomore, junior, and senior year in high school. And then I turned 18 in December 1992. And then left that and then joined the Marine Corps 9 months later.
Right. So tell us a little bit about your time as a Marine. How long did you serve for? What was that like, etc.?
Yeah, I tell people this unequivocally that joining the Marine Corps at the age of 18 was the most profound decision of my life, and it's had the most profound consequences in my life. I was a classic underachiever in high school, had a lot of self-esteem issues. Really wondered if I'd even be able to get a job. Wondered if I was even that intelligent, if I was that smart. So I had a lot of just, issues that permeated throughout my academics and just a complete lack of discipline. And I was pretty soft as well. Really, really soft, and just needed to be, I just needed to grow. And I'd always held this incredibly high regard for the U.S. Marine Corps. I mean, regarded as maybe the most elite military organization in the world. Incredibly stern, incredibly disciplined, physically fit, physically demanding, and just have that integrity and just have that sense of pride that I could be part of the best. And again, with my poor grades, this just seemed like a natural outlet, or a place to go, because I wasn't going to college with the grades that I had in high school. I mean, I failed multiple classes, and really looked at high school as more of as a business than I did as like a place to learn a Pythagorean theorem, from geometry. So listen, I joined, and my first assignment was in Japan, and I established a passion for the Japanese language. So in 1994, I went to Japan, spent 2 years there at Iwakuni. I worked in weather forecasting, weather observation, briefing fighter pilots before they go out and run. So again, you're talking about something chaotic in the weather, something that requires forecasting, prediction, the use of models. This stuff just made a lot of sense to me. But that was not my true passion when I was there. Like, my real passion was really studying the Japanese language. I love the Japanese language. And I would spend 2 to 3 hours a day in my Marine barracks studying Japanese, trying to go out in town, trying to meet people. We didn't have, this is 1994, we didn't have like Google Translate on our smartphones. So I just did the best that I could, and just tried to speak to the Japanese nationals who were on base, because you didn't have to learn a word of Japan because you were on a U.S. base and totally insulated from the outside. So that gave me a lot of confidence that I could learn a language like Japanese after being there for 2 years. I then went back to the U.S. again, trained to work at the U.S. Embassy in Tokyo, came back, was assigned to the State Department, the U.S. State Department, the U.S. Foreign Service, lived in Tokyo, Japan for 2 more years, again continued my Japanese study with a lot of the State Department translators that were there, trained under them till 1998. And then came back to the U.S. And it was during 1998 that I started trading again, had an E-Trade account, and came back to the University of Washington, studied Chinese, and then became the business editor at the University of Washington newspaper. And this was kind of where everything kind of coalesced. And I joined up with a trading firm then, and broke down and really started helping them develop option strategies and derivative strategies, as this stuff just all made a lot of sense to me.
Cool, man. Well, let's break that down a little bit. First of all, how long did it take you to learn the Japanese language so that you could actually speak it fluently?
Fluent's a very discriminating word, and anyone who studied Japanese that's a non-native Japanese speaker would probably never use that word fluent. It's very complimentary, and I spoke it effortlessly and naturally, but I never got to be fluent at it, but very effective, very natural. But it took me studying every day close to 9 months, with multiple, failures along the way in terms of just like thinking that I had progressed and then I hadn't. And then by the end of 2 years, I was pretty good at it. But then I hit another level, when I came back to the U.S. Embassy. So I say if someone lives there and you immerse yourself, you'll be functional in 9 to 12 months. And then you'll be really developed after like 2 years, I think, is a good time frame. It's regarded by the State Department along with Chinese and Arabic. It's what they call a level 4 language. So they say it takes about 2,200 hours of classroom instruction to become, professionally competent in it, whereas something like Spanish or French may take 600 hours of classroom training, just to give you a context of a level 4 language like Japanese versus a level 1 language like Spanish or French. So during your time in the Marines, you opened your first E-Trade account. Yeah. How
did you go once you did that?
Not very well. This was during the Thai baht currency crisis, and this was when tech stocks were starting to rip. And I put like $5,000 or $6,000, and I lost it all, or most of it. It was, I was already saving money in mutual funds, and pulled out of there and just made a lot of, seemed to be buying at highs and selling at lows. And for as smart as I thought I was at the time, I had a horrific sense of timing in the markets, and that, didn't work out very well for sure.
Okay. So how long did it take before that money was all gone?
3 or 4 months.
Okay. So not very long.
Yeah. No, I mean, it was again, I'm working full time as a Marine. And so it's not like I'm like tick by tick and watching the charts. It's like, okay, this is up. And there was no process. It was like, oh, this looks good. I'll buy that, and just a lot of impulsive trading. And it's ironically at the time, like, I think I was so bad at it that I thought to myself, if I could just do the opposite of what I've done, which is actually part of what I've actually developed since then in terms of my own study and why I journal so much today and spend so much time understanding my own self-awareness, is because of what our emotions can tell us. So a lot of the things that I still implement today are from like early observations I've had, like, wow, there's got to be a way to harness my horrific timing ability to make money, which it was pretty bad. So yeah.
That's funny. So what was particularly difficult for you at that time? You mentioned there you were very impulsive. Was there anything else which was quite challenging and which you can maybe pinpoint as to why you were losing money?
No, impulsiveness and lack of process. You know, I mean, coming in and buying something, you know, because it's up or because it's down or because you think it's going to go down and just the classic stuff, taking profits really quickly. I mean, frankly, throw a dart at a wall. You know what I mean? Like money management can still probably save you. Okay. Even throwing darts at a wall and hitting something. If you're managing money well and controlling size, you know, you could probably still do okay in the long run. I don't know. But if you are consistently taking short profits and letting losers run against you, and I really like this company and you hold on to it. All right. And this seems like a good company. Yeah, this can grow. But then when it's up a little bit or it's up 2 or 3% on the day, you book out of it. You know, but if it's down to you 5%, you're cool with it because you can hold it for the long term. No, I mean, I was just classic. Any mistake that any of your listeners have made, I assure you, I have like just mastered it. And I've like done it in a much more spectacular fashion in terms of the mistakes that I've made. I promise you.
So how long did it take until you really began to get the swing of things and actually like see consistent results? Was this afterwards when you left the Marines and went working at a trading firm?
I was doing a concurrent situation. I got out of the Marine Corps in 2002 and I was working with a prop group, and that's really kind of where I came into my own. The first, I'd say that it wasn't one thing, but there were some important things. One, Joe DiNapoli's book, Trading with the Napoli Levels, I bought in 2000. That was really important. I attended a couple of technical analysis, just courses from traders. Rob Deal was one of them. This other guy was just like momentum trader. And so I started implementing candlesticks, technical analysis, having a process. And while I don't necessarily use those exact methods today, the process of using Fibonacci levels, I very much use DiNapoli stuff today. I think he's brilliant. His book is brilliant. So DiNapoli's Fibonacci levels really gave me an incredible amount of confidence. And I'd say I flipped the switch in late 99, early 2000 and definitely had some more bumps along the way. But that's where I get it, because discipline, once I understood a process, being disciplined, having been in the Marine Corps, was not the issue. Managing risk was not the issue. Making a laydown on a losing trade was not the issue once I understood the process. I had a process in place and can develop that. And for that matter, I mean, it's 2017 and I'm still always looking to improve that process. So this is, 17 years into it. And not every year since then has been a winning year. I've had a lot of winning years, but not everyone's been a winning year. And I've gone through some setbacks along the way, but, overall, I like betting money on myself in these markets for sure.
All right. Well, let's get into a little bit about your strategy. So first of all, what markets do you predominantly trade these days?
I'm a cross asset class trader, focused primarily on 35 main futures markets. For example, today, everything I did was not everything I did, but nearly everything I did was in the ag space: soybeans, corn, and wheat. Traded a lot of wheat, a lot of soybeans today. Traded a lot of options around those positions as well. We had a very big ag report that had all sorts of nuances to it. And today that was where it was at. I also traded some copper this morning, some silver this morning, traded some treasuries this morning as well. So there was a lot going on. It was more about where the opportunity for price discovery was. And that's kind of where I go. I have an 8, flat panel setup. I have some pretty sophisticated software, both off the shelf and that I built proprietarily, which helps me make this happen. And I'm very, concentrated on, what market regime we're in. And so as a result of that, I'm very protean. That's the word. I'm the protean trader. And the word protean means highly versatile, easily adaptable, able to take on many shapes and forms. And so for me, it's just about what time of the day the opportunities exist, what the underlying macro narrative is, what regime are we in, what markets are performing best, based on my netto number, which is sort of referenced earlier, and then following those markets and putting on trades. And fortunately the performance has been there to substantiate the process.
Sure. So if I was to ask you, how do you trade? How do you sum up your strategy? Just give us the quick sort of rundown and then we'll unpack it a little more.
Yeah, my strategy is a compilation of strategies. And in essence, what I do is allocate to a number of robust strategies based on the current market regime and their probability of success. So what I do is lever and gear various strategies based on how I think they'll perform in any given market environment. So one day I may have 3x exposure on mean reversion strategies. The other day it may be more on relative value. The other day it may be more on premium selling. The other day it may be more on long gamma. The other day it may be more, trend following. Other days momentum, or even within certain asset classes themselves. I'll take that philosophy and apply that. Again, it's all about understanding what the narrative is, and hence the name, the global macro edge. And so, are central banks driving things right now? Are we near, what fundamental overlay is happening right now? Like tomorrow, for example, and part of the trouble with this is we're on a podcast that you want to be a little bit evergreen, but, try not follow my logic here, and it may help sort of open some eyes to the process, and not so much about this one single event. But tomorrow, we've had a week where treasuries have rallied and undone some of this Trump trade. We have retail sales number coming out tomorrow. It's supposed to represent the flows of December. We have China export numbers as well. And these are things that, could potentially move things, and especially right now, given the short position. So market position is a big deal for me. So on fixed income, if we get weaker data, I'm going to lever up my momentum strategies. Okay. If we get inline data, I'm going to lever up my mean reversion strategies, because I don't think we're going to sell off in treasuries tomorrow. I don't think we're going to rally that hard either, given where we are technically. So guess what? I want more mean reversion strategies running in fixed income, given where gold is, or given where some of the ags are right now, both wheat and soybeans. I'm actually, given that the numbers today, going to lever up more momentum strategies tomorrow and trend following strategies tomorrow, and no mean reversion strategy, and lower the mean reversion strategies that go. So I developed multiple strategies, and I'm constantly tweaking them of where they're at. Then I also run a lot of event stuff as well. So today, there's those big agriculture numbers. I just know how to read and interpret. I have a great network that I can ping off of and develop incredibly complex contingency scenarios, or even not so complex contingency scenarios around these events: a Fed event, an ECB, a BOE, an ag number, a Trump press conference. But all of it requires a lot of preparation, a lot of work, a lot of diligence, a lot of study, and you got to have a process to do that.
Yeah, I was just about to say that, because it sounds like you've got eyes all over the place and you're monitoring a whole lot of things. How do you not miss anything?
You do. That's the reality. Well, I've done my best. I'm a pretty well thought out automation process, a way to enhance. And there's 3 keys to being a successful trader. Operations, analytics, and execution. Okay. And a lot of people focus on the execution, but there's the analytics and operations that are there. And by analytics, you just asked about, well, how do you catch all this stuff? Well, I've hired programmers to build me spreadsheets that make sure I catch all this stuff. If you're going to run, if you're going to have 300 strategies that you're constantly monitoring, or even more than that at times, you need to have a complete framework that allows you to catch all that. And if you use automation, you use technology, it's why I think there's more opportunities today available to a more diverse group of people. Because while there is a lot of information, those that can, aggregate, organize, and assimilate that information stand to benefit, and the technology is there to do that. So for me, it's a technology issue, and it's about committing time to the process of analytics and your operations. I spend a lot of time analyzing, my statements, but I can't just look at raw brokerage statements. Most of them are pretty crappy. You have to have a system that can import them and give you that framework and that skill set. Or that functionality. And that's, there you go.
Do you have someone who works with you full time? I know you're an independent trader and you're trading your own money, but do you hire anyone full time to help out with all of this stuff?
Not full time. Everyone I do is on a contract basis. My wife is amazing. She's incredibly organized. She, has access and sees everything and works with me very closely. I hire programmers to do one-off projects for me. So I've hired quite a few programmers and just, work that. I'm a little guarded about some of the stuff I do because, this is my livelihood, and I want to share it with you guys today. I can't, some things I sort of have to protect, but I definitely I outsource a lot of stuff. I'll just say that.
So how do you go about hiring a programmer? Where do you find a programmer to hire?
I'm a big word of mouth guy, because I have a lot of people try and, do that. But also I would say, do your own due diligence, look on the internet. A lot of software providers out there have APIs. And so you can ask your software provider, listen, who's been certified to program on this platform? Whatever your platform is, most of them have APIs. And so listen, I want I want to hire a guy to program a blank strategy for me, But even places like TradeStation, a lot of that stuff, I mean, you can do, there. And I mean, there's a lot of people that program in TradeStation you can hire. The question is what you want your programmer to see, how easily it is you can make the inputs and parameters tweakable, things like that. These are best practices that I spent a lot of time and have journaled and documented,
Yeah, that's a really good tip about asking your software provider who's like sort of certified or they know of who works with their software or their API. That's an awesome tip. And just to your later point, how do you address that concern about, not wanting to show your programmer the secret sauce? How do you safeguard some of the important things yet still work with them effectively?
Change the parameters.
It's as simple as that.
I mean, that's a good start. You can sign, work agreements and everything else, status of work agreements. And there's all these IP attorneys out there. I have a few of them. There has to be a trust factor. Spirit has to be good. And then the reality is that like, you're going to end up showing them stuff that's just going to be proprietary. And that's just kind of what it is. It's just kind of the cost of doing business. If you try and do everything yourself, yes, you'll have the benefit of safeguarding it, but then the reality is you're not going to tap into their knowledge and experience, and you'll be missing out on other value add that they could possibly provide if you have the right programmer. I have some amazing programmers that work with me that have some incredible skill sets that I could never even hope to replicate when it comes to their programming prowess. So I just tend to accept that it's just part of the deal. And ultimately, my biggest edge is how I interpret the information, use the tools that they're creating, not the tools itself. So they can make me an automated strategy. Great, make me 500 of them, 10,000 of them. It doesn't matter, because if they don't know how to lever them based on the market regime, which is what I spend an incredible amount of time developing qualitatively, not quantitatively, which I think is what the big key is to my edge. Is it's not that I can make a better moving average crossover system or a better RSI sell and buy system. I mean, come on, dude. Like, we all can make those. You can buy them off the shelf, but I've demonstrated success in terms of when to lever those up and lever those down. And that's that's the trick. Is when do you go to a mean reversion strategy in this asset class or this product or this part of the yield curve? When do you go to a trend fall? When do you go to, a breakout system? Like, that's more important than, let me optimize this so I can use this moving average instead of that moving average. I find that that's done very little. What's more important is what environment that they fix in. And that's, in essence, that's my edge.
Well, this is something that I wanted to ask you about is market regimes. So maybe speak to us a little bit about how you interpret market regimes and how you see them.
Market regime comes into three different areas: technical, fundamental, and sentiment. I measure things from a technical perspective, measure things from a fundamental perspective, and then measure things from a sentiment perspective. And those three right there are what ultimately shape my opinion of what a market regime is and how those three things influence, various asset classes.
We are live from Feddy's house.
Guests are gathering around the TV, even with a big storm outside.
Are we worried about the feed?
No, they have Xfinity Wi-Fi.
Get reliable fiber-powered gig Wi-Fi with Peacock included to stream the beautiful game this summer. Xfinity. Imagine that. Restrictions apply. New gig internet members only. Speeds vary. Use of fiber coaxial cable. Peacock offer for Peacock Premium with ads currently $10.99 a month value. Activation required to access content. Terms apply. Peacock must be activated within first 90 days. Manage existing subscriptions to avoid multiple charges. Third-party subscriptions continue until canceled.
Ever watch a stock rip and think, I could have nailed that if I had real capital? The truth is, many capable traders never reach their potential, not due to lack of skill, but lack of scale. Trade the Pool was built to solve exactly that. A firm designed for serious individuals who want access to the U.S. equity markets with meaningful buying power, up to $200,000 without committing their own capital. Get access to virtually every stock and ETF. Go long or short freely with the flexibility professional traders expect. You're evaluated on one thing: your ability to manage risk and execute with consistency. Meet the standard, and you trade at scale. No subscriptions, no ongoing commitments. Whether you're still refining your strategy, a trader with experience who hasn't yet broken through, or a seasoned professional simply looking for more capital, Trade the Pool is built to meet you where you are and take you that next step further. The markets have evolved, access has evolved, now so has the way traders operate within them. Trade the Pool.
So let's dig a little deeper into your research process, because I know that's such a big part of what you do. So what data is most important to you, and where do you spend most of your time doing research?
I read, 10 to 15 different qualitative sources, and then do a lot of bespoke proprietary research as well. I'm big into understanding, how can I say this? I'll just put this. I spend a lot of money on bespoke private research and researching certain ideas, certain themes, how they've played out. Bloomberg is a big part of that. The Bloomberg terminal, which, it's $26,000 a year for that. But it's an incredibly powerful tool to go back and analyze past narratives to aggregate data. There's a lot of, some other people use MATLAB and get data for that. But for me, use Bloomberg, use CQG. They both have backtesting functionality on there, which lets you, import items, particularly in Bloomberg in terms of economic data or custom-made indexes that represent certain trades. I'm always, I put together synthetic indexes that they represent what I think the macro theme is. It may be, long AAA debt, long copper, and long, and long the S&P and long dividend paying stocks. Could be a synthetic index that I create. And I'm watching how that performs and how that's doing on a P&L basis and what that message is saying. So I'm always tinkering, always playing around, and understand that most of the best trades that have a really nice asymmetrical return to risk profile, meaning that like you risk 1 to make 5 potentially, often come with a great deal of discomfort and come with very little historical precedent and require you to understand kind of the uniqueness or novelty of the situation that you're in.
And I read in your book that you estimate you spend around $80,000 per year on third-party research.
Sure.
Why do you spend so much on that? Like, is that such an added benefit that you couldn't come up with yourself, like, based on your experience?
So you read in my book that I made $80,000 a year. Did you also read my P&L in my book?
You spent $80,000 on research.
Right. And so if you read that in my book, then did you read what I make per year trading in my book?
Of course.
Okay. So what did I make trading per year in my book?
Well, I don't know off the top of my head. You can tell me.
Okay. So let's just say $600,000 a year. Okay. So if I'm spending $80K, all right, and I'm pulling down $600K, it's probably a good bet given the level of thought that I put into things that the research was paying good dividends. Seems fair. That's not totally unfair, right?
No, I'm just curious as to what if you didn't have that $80,000 of research, what would your P&L be for the year? You know what I mean? Like, how much does that actually contribute to your returns?
I think substantially. I mean, if I am not researching themes and topics and ideas and finding edges, that takes away a lot of the P&L, and that has a compounding effect. Okay. So if the research is important in my process. I would say the thing that I need to improve on, I guess we all need to improve is just the scale. A lot of people who make $5 or $10 million a year may only spend $80,000 to $100,000 a year on research. I spend that making $500,000 or $600,000 a year. So for me, it's about, okay, I spent that. It's a ton of, there's value on both an absolute basis in terms of what I get, because that research also contributes to my processes that I'm developing for the next 10, 15, 20 years. So that question is sort of like multi-pronged. It's, did you get the benefit of it immediately? And then what systems were you able to create for the long term that could be beneficial? And so for me, the annual money I spent on research and infrastructure, that has profound impact, not just this year, but in terms of the content I was able to produce for my book. All right. Like a lot of the book, came from, is obviously a byproduct of my experience, but that, some of the research made its way into the content of the book. So it's not just about immediate P&L. It's that research adds to the process, creates further trading ideas, creates a deeper understanding, a more profound impact, helps you make better decisions. And that's, and I think that my performance and P&L for my account, substantiate that.
Sure. No, that's a fair point. I mean, I was just asking because I think, for most people who are listening to this podcast, of course, spend nowhere near that much. So I just sort of trying to understand why you do this. You know what I mean?
Sure. And I'm going to answer short-term and long-term. Like short-term, because I see the immediate benefit, and long-term because I see a chance to build even more robust set of strategies and even more robust process. And that just takes money. It takes time. It takes resources. And I just wouldn't be as developed and have the knowledge base that I do if I didn't make that kind of investment.
Now, I probably should have asked you this question a little bit earlier, but you kind of, I guess, loosely categorize yourself as a global macro trader. When I typically hear the words global macro trader, I think of someone who's taking really long-term positions, but I kind of get the sense that that's not so much the case for you. What's maybe your average sort of hold time?
That's not global macro anymore, though. You're not correct in your interpretation of that. But the reality is that was the global macro of 10 or 15 years ago. Okay, that was the global macro of the Paul Tudor Jones and Louis Bacon's and et cetera. They would take these bets against, or George Soros would take these bets against these governments and take on this incredible risk profile. And ultimately their macro bet would come through. But that was a much different market, a much different, information was delivered and disseminated in much different ways. Now global macro, because of social media, because of, you're doing a podcast with me in Australia and I'm here in Las Vegas, Nevada, and we're connected by, technology that makes it simple. The way information is disseminated, global macro is now big trade ideas that permeate to the market and are processed in a 72 to 96 hour time frame. And so I'm a high velocity, I call myself a high velocity cross asset class trader that incorporates the macro narrative. Because if I understand how $1 billion manager thinks, which I do, and the people in my network do as well, and some of them are $1 billion managers, all right, then my ability to go after, a market like that, let's just face it, asset classes across the board for the last 3 years have seen, some of the lowest realized volatility levels in decades. And so if you're going to play those low realized volatility levels, that's not conducive for a pure, traditional global macro manager from 20 years ago. That is, however, conducive for someone that is adaptable like myself, who can follow a market, who can play a market and understand what the macro narratives are and what headlines or what themes would come out to possibly change that perception and cause a repositioning that would go on and benefit from that repositioning.
So with that being said, are you still taking any longer term bets?
I don't have to. So no, there's no reason to, when I can maneuver like I do and generate the returns that I do without taking on what I define lower Sharpe ratio components. We all have to trade our balance sheet. And I'm not running $1 billion fund, so I don't need to take on trades that face the same liquidity constraints. Now, people out there, and again, you have to find your own style. But if you have a very small amount of capital, people talk about, I don't have enough capital. Well, the people who have a lot of capital bitch and complain that they, face liquidity constraints and can't get out of their positions, have to hold them for a long period of time. If you have a small amount of capital, make your lack of capital your biggest strength. Okay. And the fact that you can maneuver, you can trade very small size, you can catch edges that bigger funds just simply can't go after because it's not cost effective for them.
Do you feel as though you do anything significantly different from many other modern macro traders?
I do a lot of things different. I'm going to take a lot of, in terms of how I structure them. I trade out of my apartment. I trade my own capital. Okay. Like structurally those are two things right there that, I should say my house. I don't have a New York City apartment anymore, but I trade out my home here in Las Vegas. Okay. I invest, a disproportionate amount relative to what they do into building my own proprietary systems and my own, software. I have a couple patents that, that most macro managers don't file for patents based on their process. Okay. So I've done that. Most macro managers don't go out and write a 580-page book. All right. And most macro managers don't, have a netto number they call for themselves that redefines investment performance and redefines what alpha is and exactly what to pay for it. So there's a lot of unconventional things I do that are very different from fellow managers. Doesn't make me better or worse, but I would say that I take a lot of non-conventional approaches and I'm open to doing a lot of things differently. And I think my P&L, substantiates that.
So when you say you have patents on your process, I think it was on your process, what are you actually referring to there? Can you expand a little bit more?
I can't actually. I prefer not to.
No trouble. So what do you think are some of the common misconceptions that less experienced traders have about global macro?
The risk management side, a lot of global macro guys are really, frankly, some of the sharpest, most brilliant people you'll ever meet. Where I think a lot of them have struggled, where there's been a lot of struggle, is on the risk management side. And, you have these great themes, you have these great ideas, but you throw in a dysfunctional central bank system, not just with the US, but with the ECB, with the BOJ, and risk management probably becomes the single biggest challenge to effectively executing a strong global macro strategy, because you're dealing with, like, in essence, an environment that's almost impossible to model in terms of from a longer term perspective, and dealing with, 2015 was a classic example of the year of misinterpretation. So if you're a macro manager, again, a long-term macro manager, and you look at how 2015 went in January, surprise from the Swiss National Bank in terms of removing their floor against the euro. Okay. Welcome to January. In March, the Fed comes out with one of the most dovish statements in a long time when they drop their set forecast by a ton. Fast forward to September, September 15, the Fed throws in that, China now is a risk in terms of, effectively executing their dual mandate of price stability and unemployment. Okay. And then throw in December when the ECB, when Draghi, basically tells everyone that they're going to be able to lower the deposit rate to minus 40 basis points, and then comes out and says 30 and says we're basically done. And the rest of the ECB members weren't going along with it. So you have this incredible environment of total misinterpretation. An environment where Fed communications and central bank communications are incredibly vexing in what they do. And then you throw on top of that managers that are trying to place long-term bets, are having to become more tactical, and it's just not a very good environment. So there's a lot of things that, people can misinterpret. And as a result of that, you've seen 4 years of macro returns that are just incredibly uninspiring.
Let's change gears here, John. We were talking a little bit the other day prior to doing the interview. One of the things you said to me was that you've got to step outside of your comfort zone. You've got to be uncomfortable. I'm really keen to hear your thoughts about why you think this is important to do.
Yeah, I like being in trades where I have a little bit of fear, a little bit of an edge, where in the back of my mind, like, disaster can happen somehow, or that something really bad can go wrong. Not that, like, you constantly need to be looking for the Grim Reaper out there, but, when I get too comfortable in a trade, it makes me nervous. That's kind of my saying, that I have up on a little sheet in my on my monitor. Kind of reminds me, like, listen, just be aware of your emotions, be aware of your feelings, be aware of your instincts. And that often the greatest trades, like, if you journal this stuff, and I journal extensively, okay, and I have what's called a qualitative self-assessment that, I put up all my, a score for the trading day. And I'll talk and I'll grade myself and say, listen, okay, what's my preparation like? What's my, how's my routine? Okay. How is my focus? All right. Then I do a post, qualitative self-evaluation myself, in terms of the execution. Did I execute the plan? Did I execute any contingencies? How did I roll? How did I adapt with the market? Things like that. So I'm always grading myself. And if you compile these qualitative notes, not just necessarily quantitative ones, you begin to get a sense of, like, okay, I'm not comfortable with this position, but man, I think this lack of comfort is what's going to create this outsized return. And for me, I try and, like, just be in tune, be in touch with that. And that's sort of, I think most people, they wait till they're comfortable before they get in, or they wait till they're comfortable until they do something. I'm not saying that's bad. I'm just saying it's probably not going to give the same sort of lucrative returns that you want. And to get the lucrative returns that you want, you need to kind of be on edge. Like, it needs to be uncomfortable to hold on to that winning position. It needs to be, uncomfortable to, like, I don't know, cost average into a position that you should cost average into to follow your plan. It should be uncomfortable to follow your plan. Okay. A little bit of, when I get that, and it doesn't stop, even my success, whoever, the, needs to kind of always be there. Like, yeah, go for it. Boom. Let's do this. Come on, power through that.
Can you share an example maybe of a recent time when you felt uncomfortable in a trade? Maybe it was as early as today.
Yeah, it was early as today. And actually, the soybean trade that I was in earlier today was uncomfortable. And I got out. I had a good move on it. The number came out. It was after the number. And it just blistered everyone. It caught them by surprise. I was more focused on wheat, actually. Even this morning, like, I was a little, like, I was kind of like hemming and hawing a little bit, like, there's a lot of people focused on a lot of stuff. I think there's gonna be a lot of opportunity. I think in the minutes and even hour that follow, there's going to be something going on here. And frankly, you know, I got long wheat after the number came out. I got long soybeans after the number came out. And was a little bit uncomfortable in it, and it felt good to get out, and I made a really nice profit. But soybeans, if you see chart right now, they are freaking screaming. and I sort of, you know, that's kind of where I thought, like, wow. And people kind of thought $10 beans was sort of the area, but now we're at $10.40, and kind of think we're going to $10.50. And so I need to now execute systems that are trend following on soybeans. And so this morning was an example where I had a little bit of where I had this confidence about how trading was going to go today, but like still had some uncertainty instead of some easiness. And I used that when I was in the position to ride it. While I didn't ride it long enough, I still got a very good move out of soybeans. And I did blow out, but I was in that. I felt a little bit uncomfortable, and like it was just like, okay, catch yourself, find your breath. You're good here. This matches your criteria. You're good. So I'm talking to myself at this stage and this success of the game. And there you go. I mean, that's probably not as coherent as you would like to hear, but that's just coming from the heart. Could this feeling of being uncomfortable be any way interpreted as being a lack of confidence in your approach? No, I'm pretty confident in my approach. It's more about just understanding risk and understanding that situations that aren't always clear, and more qualitative need to be appreciated and need to be respected. And it's that just this sense of you have an edge on something, you have a perspective on something that others don't have. Inherently being against the crowd or being early to something is not going to be comfortable because there aren't as many corroborating factors out there. And I would say it's more of the lack of corroboration to show that you're correct that we still invariably go through, because the markets can be noisy. You know, they can be very noisy, and you want to respect that noise as well, you know, as well as executing a process. And so I try and like not get overconfident or not, because to me, like overconfidence creates complacency. Complacency creates mistakes create losses. And so it's about trying to maintain that respect for the market, trying to maintain that even if you have an edge, you can do everything right, the process, but it still doesn't work. I lose money all the time. All the time. I mean, net, I make money, but I lose money all the time. Yeah, and that's something you said to me also when we were speaking the other day. You said you've really got to embrace your losses and also growing pains. So why do we need to embrace losses? Because if you're not losing money, you're not taking the kind of risk you need to be successful. Period, paragraph, over. You know, how are you? I mean, it's really simple. You want to find systems that compound upon themselves. All right. I mean, you want to create a smooth equity curve, not a lumpy one, because lumpy equity curves. What I mean by that is, if you gave me the choice to make 1% a day, all right, or make one day of make only 5% and nothing else, I'll take the 1% a day because I can compound that. Okay. If you give me the 5% upshot and zero the rest of the days, that's a tougher bet. Okay. That's a tougher prospect. And I can't leverage that as much because the downside lumps can wipe you out. But if I make 1%, then lose one, then make one, that's a very manageable equity curve. And that's far more leverageable than make 5, lose 5, you know? You may have already touched on this a little bit actually, but for many traders, you know, the psychological aspect is a really big challenge. How do you deal with this aspect? Is emotion an ally or an enemy to you? Emotion is a huge ally. You know, it's been an enemy in the past, but, you know, I've talked about this in terms of understanding the uncomfort, the discomfort that I have sometimes in holding to a position and categorizing those emotions from being discomfort or being outright fear, being outright, you know, difference between being anxious and panicking. Okay. Difference between, you know, being confident and being complacent. And so I try and spend as much time as I can, reasonably time that I can, just being aware of those, being aware of that skill set. And if I do find myself getting too complacent, because I do at times feel that I can feel my emotional pendulum sort of tilting towards overconfidence, and just having that self-awareness can be incredibly beneficial, because we all go through times where we question whether we're going to make money again. Even in the last, 7 or 8 years, I've had times where you go through a month or two and doubt creeps into your mind. It happens with all of us. And other times we're like, not that it's rational, but emotions aren't necessarily rational, where you think am I ever going to lose again? Like, this is so natural and obvious and expected. Winning is so expected, so it's about being aware of those things and being aware of what they may represent to your personal equity curve, and being aware of what they may represent in terms of my ability to discretionarily execute and assess what regime that we're in, and ultimately how to allocate the strategies around that.
John, you recently released a book titled The Global Macro Edge. What's the elevator pitch, man? What can listeners expect from reading it?
Yeah, conventional investing asks, what was my return? The Global Macro Edge asks, what was my return per unit of risk? And it's that process of identifying a market, a strategy, a manager, your own performance on a return per unit of risk basis that is a game changer, and not only assesses, how you look at markets, but how you assess where opportunity is, and ultimately how to go about taking on that opportunity.
And it's a huge book too. It's 580 pages?
580 pages, 8.5 by 11. It's all over Instagram. You can get a context from our website as well.
Excellent. And if listeners want to follow you on Twitter, what's your Twitter handle?
At John Netto.
Okay. Very good, man. Thank you very much for coming on the podcast, John. Let's talk soon.
Thanks a lot. Great being here. Enjoyed the interview. It was awesome.
You've reached the end of this episode of Chat with Traders. But rest assured, there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast on iTunes. And we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Hey, it's Ryan Reynolds here from Mint Mobile. Now, I was looking for fun ways to tell you that Mint's offer of unlimited premium wireless for $15 a month is back. So I thought it would be fun if we made $15 bills. But it turns out that's very illegal. So there goes my big idea for the commercial. Give it a try at mintmobile.com/switch.
Upfront payment of $45 for 3 months, $90 for 6 months, or $180 for 12-month plan required. $15 per month equivalent. Taxes and fees extra. Initial plan term only. Greater than 50 gigabytes may slow when network is busy. See terms.
What would your trading look like if capital wasn't the constraint? That's the reality for most traders. It's not skill holding them back, it's size. Trade the Pool changes that. Step into the U.S. equity markets with up to $200,000 in buying power without committing your own capital. Full access to stocks and ETFs, long or short, executed with the precision and freedom serious traders expect. Your performance is measured by one standard: disciplined risk management and consistent execution. Meet that standard and you operate at scale. No subscriptions, no ongoing obligations, just a clear path forward. For those ready to trade beyond limitations, this is the next level.
You're in your apartment alone. Then you hear something. You think, was it just the storm? You realize you're not alone. Your living room is not safe with Unhinged, the new immersive game experience brought to you by Netflix. To make it out alive, you must answer the phone. The question is, when your phone rings, will you answer? Tap the banner to play Unhinged now, only on Netflix.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
Well, guys, I'm not sure how to best say this, but my guest here on Chat with Traders, episode 109, is kind of a big deal. Not only in the world of financial markets, but he's also a household name amongst the gambling scene. The gentleman's name is Edward Thorpe, the man who beat the dealer and later beat the market. Let me explain. It was the late 50s, early 60s when Ed, a math genius and professor at MIT, took on the challenge of discovering a way to get an edge playing gambling games such as blackjack, roulette, and even baccarat. Long story short, Ed won, and he's now considered the father of card counting. From there, the next obvious move for Ed was to take on financial markets, which he also did with a great degree of success. Ed's first hedge fund, Princeton Newport Partners, achieved an annualized return of 19.1% before fees over a 19-year period, with 227 out of 230 months being profitable, the worst monthly loss being less than 1%. And his second fund, Ridgeline Partners, averaged 21% annually over a 10-year period. Now, I must say, full credit to Jack Schwager for these stats as I pinch them out of hedge fund market wizards. Now, throughout the interview, we mostly discussed the interesting path Ed has taken through life, but also his thoughts on having an edge and money management. I really wish I did have more time with Ed, as there were so many more questions I would like to ask him, but we did speak for about an hour, and I'm extremely grateful for the opportunity. One last thing, I would like you to make note, Ed has a new book which has just been released, and it's titled A Man for All Markets. It's available now on Amazon. So if you go to chatwithtraders.com/Thorpe, THORP, that will take you directly to A Man for All Markets on Amazon. Anyway, I hope you find this episode interesting. I'm Aaron Fifield. Please welcome my guest, the legendary Edward Thorpe. I'm on it pretty much every day, so I'm quite familiar with how it all works. But man, thank you very much for taking the time to speak with me. It's quite the honor.
Oh, thanks.
Ed, I've begun reading your book, and I got quite a kick out of hearing that your very first job was actually the same as my very first job. We were both paper boys.
Oh, yes.
I thought that was very cool to read about. And one of the other similarities, to some degree, which I also thought was quite interesting, is that you ran an independent radio station.
Yes.
What sort of things were you broadcasting? How long did you keep that up for?
Well, I got my ham radio operator license when I was just turning 13. And I was on 2 meters voice, and also I did a little bit of code. And so I used to play chess with people in my part of the country and just chat with people up and down the state. At that time, 2 meters was very short range with the equipment people had and the techniques they had. So you could only go about maybe 100, 120 miles. And then I was qualified to go on all the other bands and use code and talk around the world. But I mainly just had fun talking on 2 meters.
Okay. So it wasn't really a radio station as such, like we think about a radio station today.
Well, it was a ham radio station is what it was, or a transmitter and receiver. But it wasn't a radio station in the sense of having any commercial or public outreach.
Got it. Okay. What sparked your interest in that sort of thing? How'd you, like, you were very young. I think you actually said in your book you were maybe the youngest person in the class going for your radio license. What sparked your interest?
Well, I got fascinated by all things science when I was about 10 or 11. And so I just explored on my own. And electronics, as they were in that day, vacuum tube electronics, caught my interest. So I decided to learn about it. And when I did, I realized that there was this whole world I could potentially talk to if I got a ham radio license. So that was something I pursued.
Well, tell us a little bit about your childhood. Set the scene for us here. What was your childhood like? I know you're born in, I think it was 1932, which was right when the Great Depression was beginning. What was your childhood like during that phase?
Well, actually, I was born in August 32, and the Dow Jones hit its all-time low in the crash in July of 32. So it was all up from there, but it was a long hole for people to dig themselves out of. And I remember when I was 5 or 6, I was selling Kool-Aid to WPA workers in the street. I would buy a 5-cent pack of Kool-Aid and make 6 glasses out of it and sell them off for a penny a glass. And they were very happy to see me because they were working out in the heat for very little pay and very hot and tired in the summer. So I realized I could turn 5 cents into 6 cents over and over with a fair amount of work.
What was the drive to start working and start trying to earn some money? Like, you were very interesting, you know, as a young child. You were very kind of experimental, even quite the prankster in some ways. Like, where did this sort of come from? You were quite different from most kids at that age.
You know, I'm not sure. I think that a lot of it was I was an very early reader, and I got into books a lot. And I found out that I learned so much stuff that there wasn't a whole lot of commonality I had with other kids except playing, going out and playing games in the afternoon and that sort of thing. But the things I wanted to think about and talk about, nobody else seemed to be thinking and talking about except adults.
So where did that thirst for knowledge come from?
Well, I think partly it was my father. When I was not quite 3, I hadn't talked yet. And then one day I started talking in basically complete sentences, which seemed to amaze everybody. So my father then said, I wonder how much he can learn. So he started to teach me things, and I was very happy about that. So I learned to read, I learned to count, I learned to do arithmetic operations, add, subtract, multiply, divide. And that seemed to come very easily. And then I began to read more and more advanced books. So by the time I was 7, I was reading high school level books very comfortably.
And what do you think it was about particularly math and science that was so interesting to you?
Math and science, I didn't math I liked. I just enjoyed numbers. They seemed very interesting and they had rules. It was fun to learn what those rules were. Science came a little bit later. I think I started with a mineral set when I was about 10. And I learned the Mohs scale of hardness. They had a number of examples. Of course, they didn't have the top one, diamond, which has a hardness of 10, but they had everything up to 9 in there. And so that was pretty interesting to me. And then a little time went by, and I began to poke around with chemicals. I learned how to make gunpowder out of an encyclopedia. And that's kind of caught my interest. I made bombs and rockets and so forth. And from there, just one thing led to another. And so when I got a paper route at age 11, I started putting part of my money into science equipment.
Okay, now as a 10, 11-year-old playing around with gunpowder, did that land you in any sorts of trouble?
Well, things were different in those days. There wasn't any kind of regulation. And the corner druggist was very happy to sell me lots of things that would terrify parents now at a nice markup. Things like concentrated sulfuric acid and concentrated nitric acid, ether. I actually thought about knocking myself out with ether to see what it was like, but I decided it wasn't a good idea because I wouldn't be able to tell whether I had gone too far or not. So I decided to forget about the ether.
That was probably a smart move. That sounds quite dangerous. So, Ed, what did you do after finishing school? What was the next move for you from that point?
You mean after finishing high school?
Yes.
Well, everybody was poor in those days, and we went through the Depression and World War II. But I managed to save money for an education, at least for part of an education, by delivering newspapers and doing other odd jobs. So I went off to the University of California to study chemistry. And as time passed, I realized I was more interested in physics, so I changed to physics. And then finally, when I got halfway through my doctorate in physics, I'd done all the work except the last part of my thesis, I realized I had to learn a lot more mathematics to finish. So I went to the math department to take the courses, and when I got there, I found out that I would be able to get a math PhD sooner than finishing my physics PhD. UCLA was notorious then for keeping people around for 10 years in graduate school before they got out. So in 2.5 years, I was out in math, and it was a good decision.
Okay, and from that point, you went on to become a professor, actually teaching math, is that correct?
Yeah, I got a position as a CLE Moore instructor at MIT. That was my first position. That's kind of an honorary sought-after position. They have competition all over the country to get that job, and they appoint anywhere from 1 or 2 to 6, depending on the year and how much space and money they have. So that was a great experience. So I spent 2 years in Cambridge teaching at MIT. And then my wife said, no, we can't stand these winters anymore. At least she couldn't, tiny baby and all. So we got a really good relocation to New Mexico State, who had just gotten a whole lot of National Science Foundation money. So I went there and I had my pick of graduate courses, 6 hours a week, pick of top graduate students who they were paying to come in. And so after 4 years of that, I learned a lot of math and went on to UC Irvine when it opened up out in Southern California. And actually, I live not far from there now.
And just to put this in perspective for us, where do you kind of sit on the spectrum? Like, your understanding of math and that field is very advanced. I believe you competed in numerous competitions, maybe more so in your earlier days, but where did you stack up in those competitions?
Well, when I was in high school, I needed to enter competitions to get scholarships and to earn money. So I took the All Southern California Chemistry Contest, which had 1 or 2 top students from each high school. And I came in 4th in that. And then I took the Physics Contest the next year, and I came in 1st in that. And then I was a finalist for the National Science Talent Search. There were 40 winners out of 11,000 contestants all over the country. So I went to Washington, D.C. and got some money for going there. And then I got a scholarship from UC Berkeley, which continued as a scholarship when I went to UCLA. So piecing all these together went a long way toward helping me get through a college that I couldn't otherwise afford.
Just skipping forward a few years now, how did a mathematics professor become curious about blackjack?
Well, when I was a kid growing up in high school, I was left on my own a lot. My parents were working in defense, or in that case, war industries. And my mother had the swing shift, 4 p.m. to midnight. My father had the graveyard shift, midnight to 8 a.m. at another industry. And so I and my brother kind of took care of ourselves and grew up without any particular supervision. And that was good and bad. It was bad because I didn't have the opportunities that kids with more money and who went to a better high school would have. But it also taught me to think on my own about things. And so when I came across situations later in life, I often looked at them from a fresh viewpoint. For example, when I was finishing my PhD at UCLA, I was going to go to Las Vegas to have a nice vacation with my wife over the Christmas holidays. And I learned before I went that there was a way to play blackjack published in a statistics journal that would give you not quite an edge, but you come pretty close. Your disadvantage was less than 1%. So I said, well, I don't know anything about gambling, but I'll risk $10 and see what happens. And I was also interested in going there for a second reason, which was that I had figured out in the physics part of my career that roulette wheels might be predictable. And I had good reason to think that they almost surely were predictable. If you could measure the position and velocity of the spinning rotor and the position and velocity of the spinning ball, you could predict with enough accuracy, not perfect accuracy, but enough accuracy to actually get an edge in the casino. So one of the reasons I wanted to go to Vegas, besides a cheap vacation and to have fun playing blackjack, just as an experience, was to look at roulette wheels and see whether they were like I thought they were from just pictures and hearsay and so on, and reasoning. And sure enough, they were. And I set out to beat roulette by building a hidden computer, a wearable computer on a person's body. But when I played blackjack, I also stumbled across the knowledge that the people playing didn't know what they were doing, and the people running the game didn't know what they were doing. And there were certain obvious things that they were missing, and I said, I can beat this game too. So I set out to basically beat both of them at that point. And that was a distraction from an academic career and from mathematics, but not enough of a distraction to take me out of the academic world, just enough to be stimulating and give me one more great thing to do.
Now, that first trip to Las Vegas, how did you go playing blackjack and roulette?
Well, you mean, where did I go to observe them, or?
Did you do well? Like, did you make money on that first trip?
Oh, that's a good question, yes. Well, I had 10 silver dollars that I was willing to risk, and that was it. So I played for about 40 minutes, and I lost 8.5 of my 10 silver dollars. But everybody else at the table was smashed. And at first they thought I was some sort of screwball with my little strategy card, which I checked. And I was also playing rather slowly because I wasn't used to all this. It was all new. And then after about 20 minutes, there was a remarkable hand that I drew. I drew a 7-card 21, following the instructions on the card, which I had no intention of drawing a 7-card 21. It was just that the instructions led to this. It led to me sacrificing a pretty good hand and continuing to draw cards until I ended up with an unbeatable hand. And so at that point, the people watching me were kind of electrified at what had happened. And they thought that I did this on purpose, which is not true. And so I realized from their reactions that they didn't have a clue. That led me to go back and think about the game, and I very quickly reasoned out, in principle, how to beat it. And then the work began.
Okay, so walk us through that process. How long did you spend trying to work out and come up with a formula for beating the casinos at blackjack?
Well, I spent a substantial amount of time during the spring and summer of 1959 trying to do it by hand. And I realized as I made relatively little progress that the computation was so enormous that I was never going to finish in my lifetime, or actually 100 lifetimes. At that point, I learned that MIT had an IBM 704 computer, and as a staff member, I could use it. So I taught myself a programming, something called Fortran 2, and left groups of punch cards at a bin every 2 or 3 days to check parts of the program that I was writing, subroutines, and they would come back sometimes with errors which I had to fix, and sometimes they would run perfectly. When I finally built all my subroutines and put them together, this was probably early 1960. So I continued to turn stuff out from the computer through a large part of 1960. And then I got all the information I needed, and I saw I could beat the game. And I saw how to do it in multiple ways. So I would say that I spent overall about, maybe half or 2/3 time for a year and a half.
And once you'd come up with this formula or these various formulas for beating the casino at blackjack, correct me if I'm wrong, but you actually went public with that formula or your strategy. What was your thought process in actually going public with that? Did you have any doubts about doing that?
Well, to me, it was a math problem. And people thought that you could not beat casino games. And there was a lot of evidence to that effect. There were theorems, in fact, that had been proven as probability developed over several previous centuries. They proved theorems which said that most of the standard gambling games could not be beaten. No matter how you varied your bets, you would lose at a rate that was predictable. But blackjack didn't quite fit the assumptions that they'd used to draw that conclusion, which I observed later when I began to learn more about probability itself and the history of the attempts to beat gambling games. And what was different about blackjack was that as you deal through the cards, they don't reshuffle after every hand. So the composition of the deck tends to change as play continues. And with the changing composition of the deck, the odds for and against the player and the way he should play his hands, those things shift also. And so what I saw very early when I thought about the game was that the shifts would undoubtedly be large enough to give me a substantial edge during a fairly large part of the time that I was playing. And so then the next step was obvious. If you can tell when you have an edge, you bet big when you have the edge, and you bet little or leave when you don't have an edge. So you win a majority of the big hands, and you lose a majority of the little hands. And overall, you come out pretty well ahead. And I could compute how rapidly I could make my bankroll grow.
So what happened after you went public with this formula, this way of beating the casinos at blackjack? Did that attract the attention of quite a few people?
Well, I gave a talk at the American Math Society thinking this would be really interesting mathematics. And so when I sent in my talk, the abstract committee thought this is another crank who is sending in more garbage. He's claiming he can do something that we've already proven is impossible. And the mathematics committees that screen abstracts for meetings get a lot of this stuff. There are quite a few famous math problems that, there are quite a few famous things in mathematics where it was eventually proven that you couldn't do it. One of them is trisecting an arbitrary angle with compass and straight edge alone. It took, from the time the Greeks tried to do it and couldn't, it took almost 2,000 years before somebody came up with a mathematical proof showing, in fact, that it was not possible. There were some angles that were not trisectable. And so, with the gambling games, over the 17th, 18th, and 19th centuries, they developed a rather tight proof that nearly all of them were not beatable. So anyhow, I said, this is going to be interesting mathematics. The abstract committee said, this is some other wingnut who's sending in this stuff. And just by chance, one of the members of the committee was somebody from UCLA who knew me when I was there. And he was an eminent number theorist, and he said, no, if this guy says he can do it, he probably can. So the abstract survived and was published in the little notices that they had before the meeting, and then the papers got wind of it. And after that, it went kind of viral on the print media. And then I got a flood of people who wanted to either know the secret so they could get rich, know the secret because they were in dire straits and needed the money, or who wanted to bankroll me and go out and share the money.
And that's how you met the infamous Manny Kimmel. I'd love to hear the story about how you actually met him. And for those who don't know, describe a little bit about this character. Like, who was he?
Well, many people came to my talk, and afterwards there was a lot of publicity in both print and on television. And then I began to get people offering to bankroll me. And one very persistent guy kept calling. And finally I said, the casinos are scoffing at me. They're saying this is all garbage. They're saying they'll send a cab for me. And if I don't do anything, people are going to say, well, this guy is just a blowhard who claimed to do something but couldn't back it up. And I felt it was obligatory for me to show that what I'd done was actually correct and worked. So I finally decided to listen to Manny Kimmel, who drove up from New York. And so we talked for a while, and he got very excited. It turned out, although I didn't know all this at the time, that not only was he a wealthy businessman who owned 64 parking lots in New York City, among other things, but many years later, I discovered from Connie Bruck, who wrote a biography of Stephen Ross called Master of the Game, I discovered that Manny Kimmel had been associated with mobster number 2, a guy named Longy Zwillman. He was the mobster king of New Jersey in the 30s. So he probably made his original money from bootlegging, prostitution, and so on. Be that as it may, he actually was an important businessman at that time, as well as a knowledgeable gambler. He wasn't an educated man. He probably never got past 7th or 8th grade. But he'd been around the casinos. He'd been a big veteran in Cuba before it got shut down in 59-60. So anyhow, I showed him what I could do, and we had some practice sessions in New York. where he verified that I won pretty steadily against his dealing. So anyhow, we went out to Las Vegas and we brought a $10,000 bankroll. He wanted to bring a lot more, but I figured that I wanted to play with something that was small for him in case things went wrong. And we did a little better than double our bankroll in the 20 hours of serious play and about 20 hours of getting used to it play. So $11,000 win on a $10,000 bankroll doesn't sound like a whole lot, but it's a little more than you think, because money in that day, adjusted for inflation, was about 8 times what it is now. So think of it as an $80 bankroll and maybe a $90,000 win.
Yeah, I mean, that's a significant amount, especially in such a short time frame.
Yeah.
It's very impressive. And how long did your relationship last with Manny for?
Well, I was more interested in being an academic than a gambler, so what I decided was I wasn't going to spend a lot of time doing this. I might go occasionally if I needed money for something, but it was kind of an avocation. But the casinos continued to scoff, and I decided to write a book about it and see how they fared when thousands or tens of thousands of players came out to the casinos and started counting cards. And of course, the book became a New York Times bestseller, and tens of thousands of players did show up, and some of them were good card counters. So the casinos eventually panicked, and they, on April Fool's Day 1964, they announced from the Nevada Casino Resort Association, there came an announcement that they were changing the rules of blackjack. They were taking away some of the choices people had involving doubling down, pair splitting, and so forth. And I was asked what was going to happen, and I said, well, what's going to happen is the ordinary players from whom they make all their money are going to be very irritated by this, and they're going to lose a lot of business. So they're going to have to give in and change back, which is what happened. And so the tactic then was to do a mixture of things. In those days, there was a lot of cheating. I don't think there's much now. And at least not in the casinos that are run by the big corporations. And they also would shuffle up, they'd bar players, they had a blacklist of people when they identified them, and so forth. So this kind of battle between players and casinos really heated up, and the good players got very clever at disguising themselves, at inventing extra new techniques for winning more money, and so forth. And so this battle goes on. There are good players out there now who still make their living. They get together every January at the blackjack ball and kind of celebrate the blackjack life.
So this is very interesting. So during this time, you'd kind of worked out a way to, well, you had worked out a way to beat the casinos at their own game, yet you didn't want to really pursue it too much. You really wanted to stay doing your academic work. Why was that?
Well, I never had a focus on trying to make a lot of money. It wasn't important to me. I basically just wanted to learn things, be around people that I liked, especially smart people who knew a lot. And I figured the academic world was the place to be for that kind of experience. But I also had this element of not doing things the way everybody else does them, trying new things, and having a certain amount of adventureness as well. Probably from my childhood, the way I grew up, making nitroglycerin, shooting off rockets, and so forth.
We are live from Freddy's house.
Guests are gathering around the TV, even with a big storm outside.
Are we worried about the fee?
No, they have Xfinity Wi-Fi.
Get reliable fiber-powered gig Wi-Fi with Peacock included to stream the beautiful game this summer. Xfinity. Imagine that. Restrictions apply. New gig internet members only. Speeds vary. Use of fiber coaxial cable. Peacock offer for Peacock Premium with ads currently $10.99 a month value. Activation required to access content. Terms apply. Peacock must be activated within first 90 days. Manage existing subscriptions to avoid multiple charges. Third-party subscriptions continue until canceled.
Ever watch a stock rip and think, I could have nailed that if I had real capital? The truth is, many capable traders never reach their potential, not due to lack of skill, but lack of scale. Trade the Pool was built to solve exactly that. a firm designed for serious individuals who want access to the U.S. equity markets with meaningful buying power, up to $200,000 without committing their own capital. Get access to virtually every stock and ETF. Go long or short freely with the flexibility professional traders expect. You're evaluated on one thing: your ability to manage risk and execute with consistency. Meet the standard, and you trade at scale. No subscriptions, no ongoing commitments. Whether you're still refining your strategy, a trader with experience who hasn't yet broken through, or a seasoned professional simply looking for more capital, Trade the Pool is built to meet you where you are and take you that next step further. The markets have evolved, access has evolved. Now, so has the way traders operate within them. Trade the Pool.
So tell us a little bit about the other games that you were able to beat the casinos at. So we spoke about blackjack there quite extensively. You also mentioned roulette earlier as well as something that had piqued your interest. How did you go with roulette?
Well, roulette actually is the first thing I thought about in my life that was a beatable casino game. It was way back when I was in high school and studying physics. And what I realized was that the roulette ball orbited kind of like a planet, and the spinning rotor didn't really make any difference. It just changed the relative rate in which the ball orbited around whatever pocket it was going to end up in. So I thought of it mainly as a lot like a system that is so predictable, the motion of the planets around the sun. And I know there's friction, and there are a lot of other elements like little deliberate vane deflectors that are set in the side of the stator, which the ball hits on the way down to make randomness. So there are little things that make randomness in it that still seem predictable. And then time passed, and then when I was, after I got my master's in physics, I was having a chat with people one afternoon, and they were claiming that you couldn't beat any casino game. And I said, well, I think you can beat roulette. I argued that you could beat roulette, and the argument was fairly heated, so I decided that I would prove it. So I and a couple of other people set out to do it, and the other people dropped away very quickly. I continued. And then when I was at MIT, and I had worked on my blackjack ideas, I wanted to publish them quickly because one of the things that happens, especially in the gambling world, and sometimes in mathematics, people steal your ideas and claim that those ideas are theirs. So in order to get quick publication, the place to go was the Proceedings of the National Academy of Sciences. They took short papers, so you couldn't put most of what you knew in the paper, but you could at least make an announcement that you'd done something and describe it briefly. But you had to have a member of the National Academy send the paper in for you and basically sponsor you. And the only one in mathematics at MIT was a fellow named Claude Shannon. He was famous because he invented something called information theory, which is the basis of modern computing and modern communications. We wouldn't be talking here probably if it hadn't been for him. So Claude Shannon, I looked him up. They told me that I would maybe get 5 minutes if I was lucky. And he didn't really spend time with people unless he got really interested. So we went through my proposed paper for the National Academy, and he liked it and said, looks like you solved all the main problems in this area and have all the big ideas, so I'll send the paper in. Then he said, well, what else are you working on? So I told him about attempting to build a computer, a wearable computer, to beat roulette. And so he got very excited because, as it turns out, he was one of the most famous gadgeteers of all time. Built lots of different devices, chess-playing machines, maze-solving robots, and I could go on for quite a while here. So he got excited and wanted to work on this too, so we decided to team up. We spent the next 9 months. We bought a full-size roulette wheel, set it up in his basement, and used some equipment from the MIT labs to make really accurate measurements. And then we figured out how to build a small computer, which is now at the MIT Museum, incidentally, that you could hide on your body. And one person would stand with a computer and use the big toes to tap switches for inputs as the roulette ball and the spinning rotor in the middle went around. And then the computer would tell you where to bet on the wheel. And the other person, which was me, was sitting at the roulette table, not even able to see the ball, sitting at the far end on purpose. And when I heard the instructions from the computer, then I put money down on a few neighboring pockets. For example, 0, 13, 23, 36 is a little group that hangs together on the wheel. So we bet on 4 or 5 numbers that were neighboring, and a pile of dimes would blow up into a whole lot of dimes very quickly because we had, it turned out, a 44% edge, which is really huge. I mean, you almost never come across anything like that. But the equipment was fairly crude. We had little wires that ran up from the radio receiver hidden on my body up into my ear canal where there was a tiny loudspeaker. And that's where I heard the instruction as to where to bet. And those wires were very fragile, the size of a human hair. They would break quite easily. Copper just almost falls apart when it's that size. We had steel wires, and they were still too fragile. So I'd have to go back and get rewired periodically. And then I thought about it. I said, if they forbid us to bet after the ball is spun, then we can't predict. We need to use the motion of the ball to make the prediction. And characteristically, they let you bet until almost the end because they want to give people as much time as possible, and they want also to have more spins in a given hour. Anyhow, so I thought about it. I said, this is not going to go unless we're really clever. We spend a lot of time disguising ourselves and a lot of time, misdirecting the casino. So they think we're other than the kind of people we really are. Blackjack players got good at this. There'd be a big player betting huge amounts of money and wandering around from table to table with a beautiful companion on his or her arm. And that was a pretty good disguise for a while, a pretty good misdirection. Anyhow, I didn't want to spend my life doing that sort of thing. So I said, this is fun. It worked. It's a good idea. Other people, by the way, took it and made lots of money. But I'd rather continue with my academic life. So I decided to do that until I got deflected one more time into the world of real money and real action.
So just before we get into your trading venture, I've got to ask, like you mentioned a little earlier that, you knew of people who had been blacklisted from casinos and that sort of thing. Did you have any run-ins with casino owners and security during that time? I imagine, you probably had a target on your back to some extent. Like I've seen what they do to card counters in the movie Casino, and it's not pretty.
Well, the movie Casino was written about 10 years after I played, and the book and the movie. And things were worse when I played than they were in the movie Casino, to give you the way things were going. So the 50s were terrible. People like Bugsy Siegel got shot up. The El Rancho Vegas got burned down in a dispute, and so forth. In the 60s, people were getting beat up. One person was almost murdered that I know about. Another person was murdered. And then in the 70s, it was like the movie Casino. And in the 80s, it was better because the corporations were coming in and people were going legit. They realized there were certain benefits to going in that direction. Life in some ways was better than the mob life. So, yes, there was a lot of risk. And I didn't realize that initially, but as time passed, it began to become clear to me. One of the episodes in the book is about another thing that I discovered, how to beat the side bets when they were there in a game called Baccarat, the game that James Bond originally plays in Casino Royale, the first version of the movie. And it's one of the highest or the highest stake game in the world. People were betting just routinely $2,000 to $10,000 a hand. And the side bets, we could bet 5 to 100. And I figured out a way to beat them systematically. And so we came and did that night after night after night until finally they drugged my drinks and barred us from playing anymore. And on the way home, a strange thing happened to the car I was driving. The accelerator locked to the floor when I was coming downhill in Arizona, and nothing I could do with the brake seemed to be able to stop it. So I finally, it got to 80 miles an hour. I put on the handbrake, the foot brake, put it in a low gear, turned the engine off, and used the drag of the motor also. I was finally able to bring it to a stop. And then somebody came by and looked at the car and said, I've never seen anything like what's going on here with the connection to the accelerator pedal. So the person was able to fix it, but their opinion was that it had been tampered with. This is somebody who knew mechanics and I did not. And then we resumed our trip home, somewhat chastened. So they got serious.
Yeah, that's really heavy. And in your interview with Jack Schwager for his book, Hedge Fund Market Wizards, you mentioned that you later discovered that some of the casino owners were actually plotting to take you out. What's the story there?
When they changed the rules in blackjack, there was a big discussion, which only came out publicly about 30 years later when one of the people there wrote it up and published it in one of the Las Vegas newspapers. There was a big discussion about how to deal with me and the count counters. And so one of the proposals was to break knees or worse. And people explained that that wouldn't be a good idea. They needed to tone it down and do something else, so they changed the rules instead. But there was quite a mix of people at this meeting. This was the Nevada Casino, the Nevada Resort Hotel Association meeting where they decided to change the rules. So that was changing the rules was a good decision on their part. It wasn't effective, but it was better than what they might have come up with.
So tell us about how you got into financial markets. How did that come about?
Well, I'd made some money gambling and from book sales, and I started to invest it. And I didn't do very well. And when I don't do very well, I sit down and decide whether I should be doing whatever it is at all, or whether I'm going to change and do it very well. So I decided that I would learn what I could about investing. And I spent the summer of 1964, all summer, just reading books on investment. And then I decided to do the same thing again in the summer of 1965. And at the very beginning of the summer, I happened to come across a little pamphlet on something called a warrant, which is like a call option. Only it's issued by a company, and in those days it wasn't on an exchange, it was traded over the counter. And so it was a real pain to try to trade these things because you had to deal with people that were really greedy and had huge bid-ask spreads. In any case, I saw almost immediately that you could mathematicize most of the uncertainty in how a warrant behaves. The main thing that affected it was the price of the underlying stock. So then I saw an X that if I were to hedge short a warrant and buy the stock, or the other way around, I could get rid of the stock risk. So what did that leave? That left mispricing risk. Well, it's no longer risk if I can tell whether the warrant is relatively overpriced or relatively underpriced. If it's relatively overpriced, I can sell it short and buy the stock, get rid of the stock risk, because the warrant and the stock tend to move together. If the warrant is relatively underpriced, if it's cheap, I can buy the warrant and short the stock against it and get rid of most of the risk. And if the stock moves around, changes its price, I can change the mix of the warrant against the stock. So I realized that this was something that I could almost certainly solve mathematically. And so I set out to do that. And I happened to be moving to the new UC Irvine campus when it opened in the fall of 1965. And I was telling somebody there about this idea. And I said, wait a minute, we've got somebody else coming in who is doing the same thing. And it turned to be an economist named Sheen Kassouf. So we realized that we were doing the same sort of thing, only he had been doing it for real, with real money, for 2 or 3 years. And he'd written a thesis about trying to price warrants. So I said, well, if we put our two heads together, we can do better yet. So we started meeting, and I brought a lot of math to the table, and we evolved our analysis of warrants and warrant hedging, and we wrote a book called Beat the Market. That book inspired quite a few people. I was having lunch with Nobel Prize winner Harry Markowitz a week or so ago, and he was telling me that he spent 3 years co-managing an investment operation in New York, because he read Beat the Market. He wanted to follow up on those same ideas and do that sort of thing. And then he decided that he'd rather be an academic than get deflected off into the marketplace and financials and trading and so on. And then two academics, Fisher Black and Myron Scholes, were aware of Beat the Market. And that got them to thinking about the fact that you could make the hedge riskless in principle if you adjusted it in very small increments. So if you could do that, then you could figure out what the right discount was for the stock and for the warrant, two uncertain payoffs. And you could figure out what the right price was for the warrant. So they went ahead and did that. I had, coincidentally, sometime before they did that, guessed that because the warrant hedge is essentially riskless, that we might as well look at it from the standpoint of a person who is risk neutral. If we did that, then we get the Black-Scholes formula. So when I got their paper in 1973, a paper which said, yes, we were inspired in part by your idea and Beat the Market. When I got that paper, I already had the formula. I'd already been using it for 4 years because I had figured out with plausible reasoning what the formula must be. And sure enough, when I checked what I had with different notation against what they had, they were the same. So their paper came about the same time as the Chicago Board Options Exchange opened. And it was one of the reasons that exchange opened is because they had shown that you could price warrants, the formula for it. And so that made the warrants somehow, well, options, I should say, more legitimate than this by appointment only kind of trading that existed before.
You know, you've come from playing the games in the casinos, you've come into financial markets now. Was it easier for you to find an edge like you've just described here? Was it easier for you to find that edge in financial markets than it was to find an edge playing games at the casino?
I don't know if it was easier or harder. Probably about the same.
Right. And as I bring up edge, this is a question I'm really keen to ask you, and I've asked it a few times on the podcast, but I'm particularly interested to hear how you describe this. How would you describe an edge? Like when we talk about an edge, what exactly does that mean?
Well, the way I see it, if you're playing a gambling game, the gambling game is the easiest. And by the way, understanding gambling games like blackjack and some of the others is one of the best possible training grounds for getting into the investment world. You learn how to manage money, you learn how to compute odds, you learn how to reason what to do when you have an advantage. So what do I mean by an advantage or an edge? In a gambling game, it's an advantage or edge over your opponent, meaning that if you were to continue to play the game for a long period of time against your opponent, you would, in the end, win money at what might be a fairly predictable rate. For instance, playing blackjack, if I have a 2% edge half the time, and the casino has a 2% edge half the time, it looks like I don't have any advantage. But if I bet considerably more when I have the 2% edge and considerably less when they have the 2% edge, then in the long run, I'll tend to win 2% of my big bets. I'll tend to make 2% of the amount of my big bets, and I tend to lose 2% of the amount of my little bets. So my edge or my advantage is the difference between those two numbers. In a gambling game, you can often, but not always, calculate what your advantage or edge is. Now, mathematicians call this edge the mathematical expectation, and it's typically what you would win in the long run or in a specific situation, either if that situation were repeated many times, what you would win divided by how much you put up. I call what you put, the total that you put up, the action. So if I make $1,000 $100 bets, then it's $100,000 worth of action. If I have a 2% edge, I expect to make 2% of $100,000 plus or minus. So those are gambling games. Now, in the securities markets, it's harder because you're not able to calculate precisely what the payoffs are and what their probabilities are. You might know what the payoffs are, but you may not know the probabilities. You're unlikely to know both. For instance, if I were to buy a cheap call option, I know the stock is going to be somewhere or other in the future, and it'll follow some likely distribution that I can hypothesize that's fairly close to what's going to happen. But I don't know exactly what's going to happen. This distribution is just an estimate based on past experience. And the distribution might turn out to be somewhat different than what I forecast if I do it many times. What I do in the securities markets is I try to think through how good or how bad something might be compared with my most probable estimate. And if even the bad situation looks good, then I know I've got something worth playing on.
And now you brought up managing your bankroll, money management.
Well, that is the thing where gambling is a master teacher. Because when the odds are computable, like in blackjack, there's a solution, a mathematical solution to how much to bet in any given situation. And if you're only betting in favorable situations, then the solution is that you bet an amount, roughly speaking, equal to your expected edge or advantage divided by the amount of uncertainty there is in the bet, the standard deviation of it. That's a rough estimate of what you bet. There's an exact estimate, which you can compute using logarithms and probability theory and so on for all these situations. And I and two other guys have co-edited and written part of a book called The Kelly Criterion. So it's a treatise on how to apply this Kelly Criterion in almost any situation you can think of. And what the Kelly Criterion does is, if you apply it, it maximizes the expected growth you're going to get in your bankroll. So a guy using this is likely, after a period of time, to have more money than somebody who just does something significantly different. So anyhow, blackjack's a perfect training ground for that, because you get a lot of bets, and so you get into the long one very quickly. I mean, you're playing 100 hands an hour. In 100 hours, you've played 10,000 hands.
So what I'll do is I'll link to the Kelly Criterion book that you mentioned there, which you co-authored. I'll link to that in the show notes. So if anyone listening wants to find out more about that, but just as you bring this up, would you mind just explaining what is Kelly Criterion just a little more, just probably in simple terms, if possible?
Sure. Okay. Suppose that I have an infinitely rich adversary, and one of the Koch brothers maybe, and they say, look, bring your bankroll. We're going to flip a coin. This coin is in your favor by 2%. Bet as much or little as you want. You lose your money, you're gone. How much do I bet? Well, the Kelly Criterion, if you go through the calculation, says, with a coin toss, it's different for other things, bet 2% of your bankroll. And so at first, when your bankroll is small, if you bet 2% of your bankroll and your edge is 2% of that, you're basically expanding your bankroll by 4 basis points on average per bet. Not much. But as your bankroll grows, the expansion gets faster and faster and faster. Okay, so why is this intuitively sensible? Well, suppose instead of betting 2% of your bankroll, you decided to bet as little as you could, $1, let's say. Well, betting $1 all day long with a 2% edge, you're not going to make a whole lot of money. Suppose instead you decided to go for what mathematicians call maximum expected return. Well, if you bet the whole bankroll, your expected win is 2% of your bankroll on that one flip, way more than 2% of your bankroll. However, you're not going to win all the time if you keep betting your whole bankroll. Eventually you're going to lose, and then you'll end up with nothing. So the guy who bets his whole bankroll, if you have a whole lot of people doing that, one guy may end up with a gigantic amount of money, and all the other guys will be wiped out. And the one guy will be wiped out too if he keeps going. So the upshot is that it's too risky to bet your whole bankroll, even though if many, many people were all doing it at once, the group would win more money that way. So anyhow, the Kelly criterion is a compromise between timid betting, where you make very little, and way over aggressive betting, where you're almost sure to be wiped out. And it turns out you can show mathematically that it's the optimal compromise for somebody who's going to play for a long time. Now, critics say, yeah, but, not everybody wants to play for a long time. The answer is, well, then you may not want to use a Kelly criterion, use something else. Use whatever it is that you think is optimal for your situation. It's just a recipe for people who are going to make a lot of bets over a lifetime. Early on, that was my situation, so that's what I've done.
Yeah. Like I said, what I'll do is I'll link to the book you mentioned about Kelly criterion in the show notes, and I might also dig up. I know there's a couple of articles that flesh out the actual formula for this way of managing money. So I'll include links to those in the show notes at chatwithtraders.com. While we are sort of on the subject of edge here, I guess this is sort of just general advice and suggestions for some newer traders. How would you encourage newer traders to think about gaining an edge over the market, like putting the odds in their favor?
Well, there are two parts to making money as far as I can see it. One is finding a good situation where you have an edge, and the other is managing your money. The Kelly criterion and things like it take care of managing your money. But harder than using the Kelly criterion and figuring out how much to bet is finding the advantage situation in the first place. And that changes from time to time and from ability to ability. People have different knacks for doing things. There are guys like Warren Buffett who spend their whole life picking stocks and keeping track of companies and knowing balance sheets in their head and looking for bargains when they occasionally come by. There are people who, at the other end, who are high-frequency traders. They have computer algorithms, and they're wired into the exchanges, and they get to look at orders before other people. That's a different game entirely. So there's so many different games. So what you have to do is go find one that works and that suits you. But I can't really tell you which games would work for you, or even very many of the games that are out there.
Yeah, no, that's a really fair comment. Putting trading and gambling aside, I'd like to ask you just this one last question. Someone who has made a great fortune and done very well in life, how do you encourage others to think about money, wealth, and success?
I think that if your pursuit is money or your pursuit is success, you're looking at things the wrong way. I think people should be doing what they enjoy and what they love, and hopefully something they're good at. And if they do that, I think they're very likely to get money and success along the way. A lady I know wrote a book called "Do What You Love and the Money Will Follow." I think that's not far off.
And speaking of books, you've just released your latest book, A Man for All Markets. As we've mentioned you've written a number of books in the past. How is this one different, and what can readers expect from also reading this?
Well, A Man for All Markets, which will be coming out January 24th, actually, in the U.S., and probably about the same time in the U.K., a little bit later in China, Korea, Japan, and I think Germany, too. It is a memoir. It's also the story of how I got started in life, how I got into things like blackjack, roulette, and the stock market, and then what I learned along the way, different profit centers that I found, hedge fund, statistical arbitrage, advice to people about investing, what to do if you don't know anything. You can still beat 90% of investors without doing any work. What to do if you want to try to do better than that, what it's going to take. And then some general thoughts about what is really important in life. And I find that a lot of people don't get it. One person I know who's a billionaire is getting divorced because he just won't stop working. And he's got a wonderful wife. They've got along for several decades. But I think she finally said, gee, I'm growing old, and it's time to enjoy all this money we've made. But people just get hooked and they won't stop. And I would say, if you can never have enough, then I can't give you any advice, because you're just going to be driven to pile up more and more and more. And at the end, you'll end up saying, what was it all for? And you won't have an answer. I say, enjoy the people that you love and the people that are worth being with, and don't spend all your time just trying to pile up wealth.
Sound advice, very sound advice. And guys listening, if you want to grab a copy of Ed's book and just take a closer look at it, chatwithtraders.com/Thorpe, THORP, will take you directly to A Man for All Markets on Amazon. So, Ed, I just want to say what an honor this has been. I'm very grateful for your time. Thank you.
Pleasure meeting you and talking with you.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Hey, it's Ryan Reynolds here from Mint Mobile.